Oh, great.
Hi, everyone. Let's get started.
Yeah, I'll just restart.
Welcome, everyone. While we're settling some last-minute technical issues, let me welcome you all to the Macro Public Finance sessions. We're super excited for a great set of papers and discussions today. Just a few ground rules. You probably received an email to read the NBER Code of Conduct, so please do, so that we can have good and respectful discussions. Everything is live streamed, so that means two things. Pay attention to what you're saying, and please speak into microphones. So both for the presenters, obviously the discussants, but also when you ask questions, we'll try to bring the mics around. You can also walk up and speak on any of the standing mics as well. And if you can, please say your name as well for those who are on Zoom or on YouTube so that they know who is speaking. Try to stay in the camera when you're presenting. If there's co-authors who want to intervene, please try to also come to the camera at the end. So without further ado, we have 25 minutes for presenters, 10 minutes for discussants, and then 10 minutes for general questions. Please keep the questions during the presentations to strictly clarifying questions so that we give the presenter the chance to present, and then we will have more time for discussions and other questions. Wonderful. So with that, we can start? Yeah? Okay, wonderful. Perfect. So I'll give the floor to our first presenter on optimal climate policy with incomplete markets. Oh, Merle's, yes.
Oh, yes. Sorry about that. There you go.
Okay, Merle's and carbon taxation.
Yes, so thank you very much for inviting us. We're delighted to be here. My name is Alexander Kolas, and this is joint work with Andrea, who's sitting over here, titled Malaysian Carbon Taxation. So the motivation is as follows. There's an old idea in economics, and it is that the process of climate change ultimately results from an unpriced environmental externality. So the standard solution to this problem, the Pigouvian solution, which has gained quite a lot of prominence over the past 2 decades, is to advocate for a carbon tax which is equal to the social cost of carbon to internalize this environmental externality. But this approach, although popular, faces practical challenges when applied to firms. Firms emission vary widely because of differences in firms' scale, fuel mix, and the technology that firms use. And combined with the fact that emissions are private information, the calculations that are used to compute emissions are private information and often self-reported by firms, implies that the Pigouvian taxes themselves provide an incentive for firms to systematically perhaps misdisclose their carbon emissions. These kind of reasoning has led practitioners and policymakers over the past decade to become increasingly concerned about firms systematically misreporting their carbon disclosures. These concerns have been validated in part by some legally documented failures by firms to accurately disclose their carbon emissions. Most notably, there was the Brico case in the EU within the context of the EU ETS scheme. In response, policymakers have issued a lot of reports and suggestions on these issues, and these reports and suggestions have focused on tougher compliance enforcement, better disclosure standards, and independent insurances. But all of these solutions are ultimately quite costly and require relatively large state capacity. This is challenging everywhere, but particularly in developing countries where we're going to see most of the emissions in the 21st century. So instead, what we're going to do today is we're going to take a slightly different route. We're going to ask whether an incentive-compatible carbon tax can instead recover most of the potential gains that we could get from taxing carbon that goes into the atmosphere. In particular, what we're going to do in this paper is that we're first going to start off by providing some motivating evidence. We're going to show that firms contribute the lion's share of overall emissions into the atmosphere, that there's lots of heterogeneity in the emission intensity by which firms produce their output, and then we're going to show that self-reporting of firms of their carbon emissions is going to lead to relatively optimistic reporting. We're then going to lay down a macroeconomic model of carbon taxation in which firms are going to differ along 2 dimensions. Firms are going to differ in their productivity, and firms are going to differ in the emission intensity by which they produce the output. Crucially, in the model, the social planner is going to have imperfect information about the firm's emission intensities. And because of this information friction, the optimal tax is going to have to balance, on the one hand, correcting the climate externality versus, on the other hand, staying incentive compatible. We're then going to use the evidence that we're going to present to calibrate the model and quantify the potential gains from adopting this Milesian approach to carbon taxation. We're going to show that there are substantial potential benefits from a Milesian approach, and that this Milesian approach, across a lot of specifications, can attain around 3/4 of the potential first best welfare benefits from carbon taxation. Our work contributes to kind of important earlier work on the optimal taxation of carbon, and unlike this work, we're going to focus really on the incentive incompatibility, potentially, of this Pigouvian approach. Our approach is also going to rest on a lot of earlier work on Milesian taxation, of which many of the people in this room have contributed. And what we're really going to use, we're just going to incorporate some of these insights and use them to firms to show how we can restore the effectiveness of Pigouvian carbon taxation. Ultimately, the way that we're going to speak to these two strands of literatures can be seen by the optimal tax formula that we're going to derive. So the carbon tax that we're going to derive on a firm, I, at time t, is basically going to equal some Pigouvian social cost of carbon. It's kind of a standard carbon tax expression, multiplied with some Milesian adjustment term, which is going to ensure incentive compatibility and which is going to change with a firm's incentive emission intensity. The outline of the talk is as follows. We're going to start out by providing some motivating evidence. Then we're going to look at the model framework, the quantification, and then at the end, we're going to conclude. So here's the motivating evidence. We're going to start off by using data from the ISCE's ESG company database. And this provides us with individual firm level data on a firm's carbon equivalent emission. This data set provides the most comprehensive data set on public and private firms' emissions that we're aware of. We see roughly 47,000 firms over a 14-year period from 140 different countries, giving us roughly 403,000 observations. Crucially, in this data set, we see both modeled and reported emission disclosures, and we see if disclosures are validated or not, that is, if the disclosure calculations that the firms themselves do are validated by third-party entities. We see a firm's scope 1 emissions, that is the direct emissions that a firm does when it produces its output. We see the indirect emissions it gets from energy production, and then we also see the indirect emission that a firm has from consumers using its product. And because of data quality issues and to avoid double counting, we're throughout this talk going to focus on scope 1 validated disclosures. We're then going to supplement this data set with data from Compustat Fundamentals Annuals, which gives us data on firm level outcomes. And then we're also going to look at data from S&P True Cost, and this gives us a data set on firm level carbon emissions, but only for publicly listed firms. So using these data sources, we're going to document 3 stylized facts. The first is that firms really contribute the lion's share of overall emissions into the atmosphere. Okay? So what I do on this slide here is we just compute the total emissions of firms in the ICE data set, and then we divide it by overall emissions into the atmosphere, which you get from atmospheric measurements. And what you see is that firms in the ICE data set comprise around half of total emissions into the atmosphere. Okay? This is clearly like a lower bound to the overall importance of firms because we only see firms in the ICE data set. Addressing climate change is to a large extent a problem of addressing firms' direct production-based emissions. The second is that the emission intensity by which firms produce their output, however, varies quite substantially. So on the left-hand side chart here, what we plot is the distribution of log emission intensities. That is how many tons of carbon equivalent emission a firm makes per $1 million of revenue. And what we see is that there's quite a lot of variation across different firms, and that this firm's variation holds even after controlling for sector, country, and time fixed effects. That's what we see on the right-hand side chart. And it also carries over when you look at sectors that produce very homogeneous output, like the steel industry. Crucially, this heterogeneity is also relatively large if you compare it to other measures of firm heterogeneity, like productivity. And then finally, what we do is we use the kind of unique feature of this ICE ESG data set, and that is that we see whether disclosures are validated by third parties or not. And what we find is that firms who do not have their disclosures validated systematically report lower emission intensities than the ones that do have their disclosures validated. So what we do here on this table is we just regress a firm's log emission intensity on whether they have their disclosures validated or not, and then whether they have the disclosures validated or not, multiplied by this log 90-10 ratio, basically how dispersed the emissions intensities are within their sectors. And what we see is that all else equal, firms that do not have their third-party validation report lower emission intensities than firms that do have the third-party validation, and firms that have more dispersed sectors have more scope to misdisclose.
A choice?
Validation is a choice. So clearly, this is not causal evidence of the effect of validation, but this is consistent with policymaker concerns that firms are perhaps optimistically reporting on their carbon disclosures. Okay, so to summarize, firms' emission comprise a sizable share of overall carbon equivalent emissions into the atmosphere. There's sizable heterogeneity in emission intensities, especially when compared to other sources of firm heterogeneity. And emissions are mainly self-reported, self-computed, and we've also shown in the papers that they're relatively hard to predict. So the overall takeaway that we take for this is that there are potentially quite large climate and welfare benefits from taxing firms' emissions, but that any taxation presumably has to account for firms' reporting incentives. So let's see if we can lay down a model of incentivable compatible carbon taxation. So the model framework that we're going to show you is a slightly simplified version of the one that we have in the paper, and that it's a static version of the model. So in the model, there's going to be a set of firms. Firm IJ is going to be characterized by its productivity AI and its carbon intensity ZJ, where these pairs AI and ZJ are going to be jointly distributed so that with type omega IJ, the mass is summed to 1. Firm IJ is going to produce a homogeneous output in accordance with this standard production technology, where A here is going to be the environmental externality that we're going to describe on the next slide. F is going to be a standard neoclassical production function, K is capital, N is labor, and E is energy. To produce this output, firms are going to hire inputs from competitive factor markets, and they're also going to sell their output in a competitive output market. We're going to let R denote the price of capital and W the price of labor. And we're going to assume that energy is available at a fixed price P, that is, we're going to assume that there's roundabout production of energy. The environmental externality is going to be very simple. We're basically going to assume that aggregate TFP in the economy A is a declining function of aggregate emissions into the atmosphere G. So firm IJ here is going to produce emission because it uses energy in its production, and it's going to do so in accordance to this emissions production function. So GIJ here is a firm's emission, and it's going to depend upon a firm's carbon intensity, ZJ. It's going to depend upon if the firm does any abatement of its emission, which it can do at cost Q of X IJ, and then it's going to depend upon a firm's energy use, EIJ. And finally, to close the model, we need to specify the information structure on the household side. We're going to keep the information structure very simple to start with. We're going to assume that a firm's carbon intensity, ZJ, and thus its emissions are going to be private information to the firm. The household side is also going to be kept very simple. There's going to be a representative household with neoclassical preferences, U of C. And this household is going to supply capital and labor inelastically, and it's also going to choose consumption subject to this standard budget constraint, where capital pi here is aggregate profits in the economy. Here.
The abatement technology, do you need that?
No, we don't need it for anything. Well, I'll show you that quantitatively, the abatement is going to be an important margin in which firms can do it, but there's nothing conceptual about why we need abatement. But quantitatively, it's going to be an important feature. Okay. The definition of the decentralized equilibrium is standard. So let's see what a firm would do in a world in which there was no carbon taxation. Okay. In such a world, a firm would just maximize its profits, which is given by this expression. Okay. So a firm would choose capital and labor such that the marginal revenue products of capital and labor equal their respective factor prices, R and W. And similarly, a firm would choose energy so that the marginal revenue product of energy equals its price, and it would choose zero abatement as the marginal benefit of abatement is equal to zero. Notice that in this decentralized equilibrium, a firm is going to use energy until its marginal revenue product of energy equals its private cost P, and it's going to do no abatement. So the climate externality is not internalized at all in the decentralized equilibrium. Okay. Also note that all of these conditions here don't depend upon a firm's carbon intensity. They don't depend upon how clean or dirty a firm is. So a firm's profits are going to be completely independent of ZJ, its carbon intensity. So let's now take the complete opposite view. Let's take a look at what would a full information planner do. Let's take a look at what would a planner do who actually knew firms' carbon intensities perfectly. What would this planner do? Okay. This planner would solve the following problem. So the planner would maximize household utility subject to the market clearing conditions for capital, labor, output, and the planner would also internalize this environmental externality A. Now, the first order conditions from this problem are going to closely resemble those from the decentralized equilibrium for capital and labor. Okay. So the social planner here is going to choose capital and labor so that a firm's marginal revenue product is going to equal these constants, lambda k and lambda n, these Lagrange multipliers. Okay. But unlike in the decentralized equilibrium, the social planner is going to set a firm's energy such that its marginal revenue product equals the price, P, plus this firm's marginal social cost of energy. So what is this marginal social cost of energy? It's made up of two components. It's made up of the standard Nordhaus social cost of energy expression, the SCC here, and then it's multiplied by this term here on the right to convert it into firm IJ's marginal social cost of energy. Now, because we have a positive marginal social cost of energy, there's also going to be a positive marginal social return to abatement. So the firm here is going to also choose to do some, is going to be made to do some abatement. Now, in this full information allocation, there is going to be separation and profit differentials. Okay? So if you take two firms of the same productivity type, one is clean, one is dirty, well, the social planner here is going to decrease both firms' energy use because it's going to internalize the environmental externality, but it's going to decrease the energy use of the dirtier firm by more than the clean firm. Okay? All else equal, this means that the cleaner firm is going to have higher profits, but this means that the dirtier firm has an incentive to misdisclose its carbon disclosures to the social planner to attain higher profits. Okay? So let's now look at what would a Milesian planner do who internalizes these disclosure incentives. So this Milesian planner is going to solve the same problem as the full information planner, but with three additional constraints. The first is just the standard participation constraint. Profits have to be non-negative. The second is the standard incentive constraint, that the profits that the firm gets from choosing its own allocation of inputs at the prices have to exceed the profits that a firm gets from choosing a different firm's allocation, that is a firm with a different carbon intensity. And then finally, we're going to add this constraint here at the end. We're going to assume that there are no implied transfers. So we're going to assume that the prices that the firm uses when computing its profits are equal to the Lagrange multipliers. And that's because we want to abstract from this second theory of the second best thinking, where the social planner distorts capital and labor markets to fix an externality in the energy market. We're also later going to show that this condition doesn't constrain quantitatively the ability of the Milesian planner substantially. So this Milesian planner is going to...
Jerry, so I think it's a clarifying question, but it's maybe substantive, so we'll come back to it. Am I right that there's also, in terms of observability, the planner does not observe profits? It's supposed to sadly. Suppose that the planner did, could it then do something more? I'm just trying to understand what the informational assumptions are.
The informational assumptions are, it wouldn't be enough to observe profits, but you would not, you cannot observe directly a firm's emissions. Okay, so there is a system which is called a continuous emission monitoring system, which if we'll have time, we'll get to it. So there exists a system, it's just very expensive, that will for every single stack you can install and you can directly measure the emissions.
So I'm just, it's clear that the planner cannot observe the choice of emissions, cannot observe firm's type, and also cannot observe stuff like and cannot observe emissions and cannot observe profits. So those are the informational restrictions.
It can observe profits, but not the others. So the Milesian planner, the first order conditions to the Milesian planner problem are going to closely resemble those of the first best full information planner. But instead of equating each firm's marginal revenue product to the individual marginal social cost of energy, this planner, because of the information constraint, is just going to equate it to the average social cost of energy. It's like best prediction of the individual marginal social cost of energy given its productivity type, and similarly for abatement. So this Milesian planner is going to partly internalize the emission externality. It's going to, for instance, set the marginal revenue product of energy equal to its price plus the average marginal social cost of energy, but it cannot completely internalize the emission externality because of the information friction. Okay? Conversely, though, this planner here is going to choose, because it doesn't know the carbon intensity types, is going to set the same input allocations for each firm independent of their carbon intensity type, given their productivity. So there's going to be this bunching, which is also what happened in the decentralized equilibrium. So one way to show these planner allocations is in the following pictures. Okay? So here on the left-hand side chart, we have the energy allocations. On the right-hand side chart, we have the abatement allocation. And we see here the marginal revenue product of energy and the price. And in the decentralized equilibrium, this is what the social plan, what the firm is going to choose. And the firm is going to choose no abatement whatsoever. Okay? The full information planner is going to separate the types. It's going to throttle the energy consumption of both a clean and a dirty firm, but it's going to throttle the energy consumption of the dirtier firm more than the clean firm. And that creates this profit differential, which creates an incentive for the cleaner firm or the dirtier firm to misreport its carbon disclosures. And then finally, we're going to have this Milesian planner, and the Milesian planner doesn't know if the firm is clean or dirty, so it's just going to take some average in between and do this average policy in between. So one advantage of both the first best full information planner and this Milesian planner is that you can implement both of the allocations relatively simply with a carbon tax. And we can do so in the decentralized equilibrium. So in the decentralized equilibrium, the first order conditions for energy and abatement, if we had a carbon tax, would be the following. If we compare these equations to a couple of slides ago, we can see that in the first best full information case, the social planner would just take a tax, carbon tax, equal to the social cost of carbon, this expression here, which is constant and doesn't vary with a firm's carbon intensity. Okay? So that is, despite the fact that we have heterogeneity in this model, we recover this kind of standard result from Golosov et al. That the tax that you want to put on a firm's carbon disclosures is just equal to the social cost of carbon. Okay? But with the information friction, that's no longer the case. The Milesian social planner would set a tax which is equal to the social cost of carbon multiplied by this incentive realignment term here in green, this term here which really measures where the firm is relative in the carbon intensity distribution relative to where we would expect this firm to be given its productivity type. Okay. Notice that these Milesian taxes are still linear. Okay, it's still a linear tax that we're setting, but it's heterogeneous across firms and it declines with a firm's carbon intensity. So to keep incentive compatibility, the social planner here would put a higher marginal tax on cleaner firms. Okay? So having seen this, these carbon taxes, let's now turn to the quantification of the model. To do that, we need to step into the model that we actually consider in the paper that has dynamic capital accumulation, emission accumulation, and we also account for firmed age. To calibrate the model, we're going to use like a decade level calibration, and we're going to split the set of parameters into two. There are going to be some relatively standard parameters. There are lots of uncertainty about these parameters, but they're relatively standard. We're just going to take them from the literature. And then there are going to be these internally calibrated parameters. In particular, we're going to calibrate the distribution of carbon intensities to match the US ICE distribution of carbon intensities. And then we're going to set this parameter phi here, which measures the damages of climate change to match these DICE 23 estimates of the productivity losses 100 years from now from climate change. And then in addition to the full information and Milesian planners that we've already met, we're also going to introduce this naive planner. And this naive planner is the planner who simply sets the first best taxes and trusts firms' carbon disclosures. Okay? So without, enables misreporting. Okay? So here we see the consumption differences in steady state between these different planner allocations and what would occur in the decentralized equilibrium. And we've decomposed it into these 5 terms. Okay? So on the right-hand side, we compose it into differences in energy allocations, differences in aggregate capital allocations, differences in aggregate productivity, and then differences in this input elasticities, intermediate input elasticities, and factor misallocation. And what we see from this right-hand column over here is that on balance, this Milesian planner does reasonably well. The Milesian planner is able to extract 75% of the first best full information benefits, while this naive planner does comparatively worse, and it's just able to extract only 8%. Okay. Now, these main benefits arise because the Milesian planner is almost as good as the full information planner at reducing emissions and is therefore almost as good as the full information planner at increasing productivity. Okay. So why does this Milesian taxation decrease emissions relatively well? Well, it does so because, as we can see from this decomposition, here we decompose emissions relative to the decentralized equilibrium into changes in energy, changes in abatement, and then changes in how the planner reallocates energy and abatement across firms. And what we see from this table is that most of the effect can be explained by this allocation of abatement across different firms. So the reason that the Milesian planner does relatively well is because the Milesian planner is almost as good as the full information planner at incentivizing dirtier firms to do more abatement. And this brings us back to your question here. Similarly, the Milesian planner is not, there is some cost. The Milesian planner cannot allocate energy differently across dirtier and cleaner firms because the Milesian planner does not see who's dirtier and clean. But if we look at this column here, we see that the costs of doing so are not actually very substantial. And it's because ultimately in the first bed allocation, what drives a firm's choice of energy or what drives a firm's allocation of energy is not its carbon intensity, but its productivity. Its productivity is quantitatively the dominant driver of a firm's energy allocation. And that is ultimately why this Milesian taxation does relatively well at recovering the full information benefits from carbon taxation. Okay. So let us just briefly look. These are the Milesian carbon taxes. They vary across the carbon intensity distribution. We get average median carbon tax rate, which is relatively high. It's $800 per ton of CO2 equivalents. And we get a social cost of carbon, which is around $165. And these taxes here vary quite substantially. But despite varying substantially, the overall tax bill that we enact on firms is relatively small. We have less than 0.5% of a firm's revenue is what we're taxing them by. Okay? The Milesian planner combines relatively strong incentives with relatively modest overall tax bills. Okay? In the paper, we consider various extensions of the baseline framework, but our results hold. So let me just conclude. So in this paper, we've shown that there are empirically large self-reported emission intensity differences across firms. And in this context, textbook Pigouvian approaches can have limited bite. We've introduced insights from Milesian taxation into a workhorse macroclimate model, where we've shown that the optimal carbon tax that results is equal to the standard Pigouvian tax multiplied by this incentive realignment term. And then we've established the quantitative potential of Milesian taxation. And that's all we had to say for today. So thank you for your time and attention.
And our discussant is Dominic Sachs.
Thank you very much. Thanks a lot for having me. It's a pleasure to discuss this very interesting paper that Alexandre just presented. And, as economists, we often, I think, take for granted too quickly that, when we talk about carbon tax, we can actually measure carbon. And this paper challenges this view and also provides a solution, right? So the first point is that firms can misreport and they do misreport. So the authors provide empirical examples and also give further evidence, that gives us an idea that there can be quite some scope for more. And the solution they propose is Milesian carbon tax, as you've just seen. So overall, I think that's the paper, touches a really important and largely neglected issue. It really provides a nice framework to think about it, in particular to think about this idea of misallocation, which is something I really didn't think about much before in that sense. And my main suggestion today will be more broadly that, alongside the Milesian carbon tax, I think it would be nice to quantify more this trade-off between misallocation and maybe costs of monitoring. So motivation, Alexandre was very clear, right? There are these real-world cases that have been documented legal cases. And on top, the authors provide evidence based on data, right? So there are these ICE ESG data, and there they show basically that firms who are kind of verified, they on average report lower emissions, which is indicative evidence. And in particular, there's a lot of heterogeneity in emission intensity, even if you're conditional on quite some things like countries, sector and so on, right? Which shows that there's potentially a lot of scope, right? It's not like we see a firm, we know where it is, what it does. So we have an idea of the emission intensity, but there's quite some heterogeneity. But it's a strong comprehensive approach, I think, to motivate the analysis. So my only question or my suggestion would be here, it would be nice to get an even better idea of how severe the problem is, right? Can you kind of quantify either the upper bound, the lower bound, or both, right? Of how much of these emissions are then not correctly reported overall. Another thing about the empirical evidence and the connection to the model, that's generally hard, right? Because it's somewhat of an engineering problem. I don't know really how that works, but I learned, something about it also from reading your paper and the appendix. You're very detailed about that, right? And in the appendix, you also provide this equation that you say, we can somehow decompose emissions into these three components: overall amount of energy input, right? So I here captures different energies inputs like oil, coal, but also much finer details, as you explained, right? And these different input factors, different emission intensity. And then finally, there's also abatement, which matters. And as you argue, there can potentially be misreporting in all three margins, right? And you also provide examples. Now, when you mapped it into the model, right, we have seen this equation here, the G are these emissions that are unobserved, and they have three components, and only one of them is private information, so the Z, right? And E and X are observable. So I was wondering, should I think of Z then really literally capturing this average emission intensity factor? Or should I think of the Z like being a catch-all for all of these things? And so I think it would be nice to have a longer discussion or maybe some robustness checks with different functional forms, different ways of modeling to give us an idea like whether this is the way to do it and it's general or whether there are maybe alternatives that could give slightly different results. Now, as you in your slides, I also have now a simplified model. Mine is a bit simpler even because I killed the productivity, but I'm going to be quick now on that because we've seen that. So no dynamics, I have no heterogeneity in productivity. I also kill labor and capital, so there's only energy as an input, right? And like in Alexandre's presentation, like we see in the laissez-faire and the decentralized equilibrium, firms will not abate anything, right? And just produce. No incentive to abate. Now, the first best, is a classical problem and has, basically a simple implementation at the end of the day, which is a uniform carbon tax, right? That we as economists talk all the time about because we have implicitly in our mind that carbon emissions are observable. But, what happens if they are not? And that's really cool in this paper, right? To introduce this information friction. So emissions and this type, carbon intensity, or like baseline dirtiness, or how one can call it, right? These are unobservable, but E and X are observable. So I introduced something slightly different in the notation, which is kind of G hat, which I would call the imputed emissions, right? So the planner gets to report Z or Z hat, right? The planner observes X and E and then infers those emissions and then taxes those emissions, right? And then that's why I have an incentive to misreport. I tell that basically I'm cleaner than I am, right? I have a lower carbon intensity. Then the planner imputes lower emissions, and then I pay lower carbon taxes, which is why this first best is then not implementable, right? Because all firms would report to be of the low type to get a low imputed carbon emission, even though they emit more. Now, what do the authors do? So now I mix a bit up allocation implementation. I hope it's not confusing, right? But the idea is that the planner assigns carbon tax rates that are based on these reports, right? So C hat is the report, and now there are carbon taxes that are different depending on your report. And the taxes you pay there don't depend on G, because remember, G is not observable, but on G hat, the imputed emissions. And then you can define like a value function of a firm that is of type Z and has reported to be Z hat, right? And then this firm gets assigned a carbon tax rate and optimally chooses E and X. And what is then very important is that this, the true type is actually payoff irrelevant, right? It's actually Z doesn't show up there. And that means for incentive compatibility, it makes it very clear, and the authors argue that we therefore need some kind of bunching, right? Because the value function of all report has to be the same to achieve incentive compatibility. And it's also the same for all firms, since it doesn't depend on the type. So the Milesian carbon tax implementation implies bunching. All firms do the same in terms of E and X. And to implement it, as Alexandre has explained, right, you need these carbon taxes, which are such that the dirtier firms actually have lower carbon taxes, the cleaner firms have higher carbon taxes to achieve the incentive compatibility, which is, of course, a provocative result. Now, I want to talk about alternatives briefly to that, like alternative implementations of this allocation and maybe even the first best allocation. So the first implementation is something you mentioned as well in the paper, because you say instead of this type-specific carbon tax, one could have energy tax plus an abatement subsidy. You describe it as a bit of a more elaborate policy. I'm not sure. Maybe it's even a simpler policy, because if you apply your lemma 3, right, the bunching result, then my understanding is that you can have simple instruments like linear tax on energy and linear subsidy on abatement, which are the same for all, right? They would depend on ability, which I don't have here in the model. But I think it's also, an implementation which could, deserve a bit more attention as well. And the next one is then about this naive social planner, where I think maybe one could think of a slightly less naive version of the planner too. So, the planner is naive in the sense that they don't, understand the information problem. But on top of that, the planner is kind of naive that they don't realize, right, that the emissions are then very high in equilibrium, right? So you see this in this graph where the yellow line illustrates the implied effective carbon tax rates of the naive planner. But if you think about the real world, my understanding is we can, at the regional level, somehow measure aggregate emissions. So what would maybe this naive planner then do is kind of increase upwards, right? This schedule, which would maybe eventually lead us even to the Milesian allocation, if I'm not mistaken. So these are two alternative implementations of that. And now I'm not sure whether it's an early point or whether it's a useful point, but I think given the informational environment, you could potentially implement the first best if you allow for report the patent transfers and taxes, right? So, I mean, to see this just, define this value function which is associated with these first best decisions. We know this is not incentive compatible because cleaner firms are better off, but then you could just introduce these type-dependent transfers, and then the dirty firms, they pay a lot of carbon taxes, but they get a high transfer, but then have the full incentives. Then my other concern is kind of independent of the last one, is about misallocation. So you provide really nice decomposition, first of all, of emission reductions that policies achieve, right? Overall amount of energy input, overall amount of abatement, and then allocation of abatement and energy uses across firms. And but you measure this for each kind of policy compared to the laissez-faire or the decentralized equilibrium. And then if you compare like the first best and the Milesian, right? So the first best performs better, and then you nicely show that basically the differences mean that the Milesian solution is not as good, and it implies misallocation, right? Of abatement across firms and also energy reduction across firms. And you also quantify it, and I think then that's also my last slide then, a nice application would be then to go to the question. Yet on the first slide, we said monitoring is costly, but now you could kind of close the loop and say, how costly does monitoring have to be such that we prefer the Milesian carbon taxation over monitoring or like with these emission monitoring systems. And clicker stopped, but this. So the last question could then be, is Milesian carbon tax good enough, or should the planner go for something better with monitoring? Thank you very much.
Do you want to respond first?
Yeah, so.
Do you want to go there?
So maybe to just respond to this last point first. So we tried to compute this because from our numbers, we can try to compute like what is a ballpark estimate of like the cost of verification that you would need in order to make this Milesian thing actually a good idea. Okay? So you can compute that and we get a number. It's like around $1 or so per ton of monitored CO2. And then you can try to look at what does one of these CEMS systems actually cost. And the issue is that these systems are just very costly to implement. Okay, so it's like around $200,000 to $250,000 per stack. So most of these companies have multiple stacks. So I think the reason that we don't see a lot of adoption of the CEMS systems is simply just they're very costly to install and they're also relatively costly to operate. Okay? So now maybe there are other ways to generate kind of it's like a truthful monitoring system rather than these CMS systems, but the CMS system doesn't seem to be really kind of the way forward. That is a very costly thing. Then
does that also imply that random monitoring is?
No, this is like the calculation we do is like every firm installs a continuous monitoring system. We have people that check. Okay, you could do some more advanced thing like random monitoring, try to see penalties. Penalties have not been so successful. So there was this case with the Brickell company under the EU ETS scheme. So this Brickell company saved around 26.8 million euros in misdisclosed carbon. So it was claiming that it was burning a different type of coal than it actually did, saved 26.8 million, and it was fined a few thousand euros, and it's still debating the fine today. So I think that there's something in the legal code that makes this kind of. Can address that.
So a very interesting idea to sort of apply Milesian taxation to firms here. Now, one question I had in practice is that in contrast to households, like the boundary of the firm is very fungible. So, firms can merge, firms can break up. And in principle, you could decide the whole supply chain, you could decide to, outsource the dirty part of your production or do it in-house. And I was wondering, when you take the distribution of firms as given here, whether that is actually a robust assumption or whether firms here would actually have incentives, given your optimal policy, to do these kind of games and break up or merge strategically to reduce, their tax burden.
So this is a very sharp point. So there was a case in the UK. There was a case in the UK. There's a company called Diageo or pronounced something like that. It's the world's largest producers of, say, vodka or whatever. It's a UK-based company. And they were exactly playing around with, there's a reporting threshold. If you just have a small stack, you don't need to report anything. And they were playing a little bit around too much with what is the size of these stacks, like which firms, where did they get counted and so forth. Now, in our quantification, the total cost that we put on the firm is really very small. It's less than 0.5% of firm revenue. Okay, so I think that there are some costs to shifting around what is the boundary of the firm. And it's true that if we were imposing very, very large costs on firms, then that would be a concern. The firm could maybe shift around its allocation. But like if we take these numbers at face value for like 0.5% of revenue, that's less than 0.5% of revenue. That seems less plausible. But it is a fair point. Like if we crank up these taxes to very high levels, firms are going to have these incentives.
Hi there. My question is inspired by the middle 60% of Dominic's comments and by Chari's question. And one way to frame it is, I don't like the first two words in the title. So Merleesian doesn't mean Merleesian in the optimal tax sense. It means mechanism design. And carbon, the model, not the analysis and the application, but the model just has to do with enforcing any regulation whatsoever. So in the history of thought and literature and models, a lot of the early mechanism design work in the 70s and 80s was on regulating firms when the regulator doesn't have information, second best instruments, whether to do auditing, what's incentive compatible. There's a whole literature in economics of enforcement, law and economics on auditing, on self-reporting, optimally inducing self-reporting to be incentive compatible. So on the core question of what are the instruments and what are the information assumptions? And given that, what does one do? There's a whole sea there that I think both the word Merleesian and carbon make us, not really see as much. Now, which subsets of that would be most interesting and relevant to apply to this problem, the way different kinds of enforcement are actually done and contemplated? Some of the environmental economics people do things with this. So they say, no, don't tax the firm's emissions at all. We can tax the energy things, the different types of coal at source. We get all that perfect, and we don't need to do any of this stuff down the line. Those are more mechanical things, not in the theory part. But I do think that the core of this is what is the instruments and information, and the literatures on that are not really the ones engaged, and there might be things to usefully draw from them.
Yeah, so on the instruments, we're just looking at, these are the plan allocations, and these are the ones that we want to implement, and this is one way to implement them. Like Dominic said, we also show that there are multiple ways to implement them, and you can argue which is the easiest. Now, carbon taxes have a lot, there's a lot of history that's already gone into carbon tax proposals, creating ETSs and so forth. So there's like a reason to look at carbon taxes. Then there is like on what informational assumptions, and on the one hand, we assume, like in the baseline, we just assume the carbon intensities are not known. Then in some extensions, we assume the planner knows, whatever share of the carbon intensity that you want, and you can trace out what the Milesian planner does in that case. So, we go from not observing anything to observing very close to all of the carbon intensity. But on the other hand, we also make quite like assumptions that the planner observes a lot, right? Planner observes the energy use, it observes the capital, it observes the labor. So we also make a lot of assumptions, which in a way make it harder for the Milesian planner to do well. Okay, so it's like, in this sense, it can be hard to know whether we're like doing a very conservative or optimistic estimate. We ran by the title. We also had a slightly the same concern. We ran by the title with Paul Klemperer, who is the executor of Merlees's estate, and he claimed it was okay. So that's.
One question or maybe comment that follows up a little bit on Florian is there's one thing is about the boundary of the firm, but one maintained assumption is that the distribution over A and Z's is exogenous and policy invariant. And that might have to do with the boundary of the firm, but presumably a lot of that is technology choices, right? I mean, you're a dirty firm because you built a plant that is dirty or clean. So is your perspective that this is a very sort of short run analysis, and in the long run, the carbon tax system, the main benefits perhaps are inducing cleaner technology adoption, which currently is taken as constant?
Yeah, like, so in the model, the main quantitative force is really this investment into abatement, which is really an investment into technology that makes the firm cleaner. Now, it's true that we don't have any, like, there's lots of evidence, like Andrea has some work that shows, there's lots of evidence that newer technologies are both more productive and cleaner, and we don't allow for that by simply having this like fixed distribution of carbon intensities and productivities. And then your abatement investment makes you cleaner, but it doesn't also make you more productive, right? We don't have that margin.
But it doesn't change the Z.
It doesn't change the Z.
Oh, I think this is an essential first step, and there are obvious improvements that you can make. I would encourage you to follow Dominic's suggestion more closely in terms of implementation. The most obvious way, if you think about taxes, of implementing things is through taxes on things that you can see, like energy, and in your case, abatement. If you can't see both of those, then it seems as though that implementation is more natural. But there's another implementation that might be worthwhile thinking about, which is related to his comment about what with lump sum transfers. What happens if you allow some allocation of property rights and then some trading on that? Main reason for doing that is we've seen how successful that has been in the acid rain, the sulfur dioxide thing. So that's why that's a natural thing. But certainly, I think you're taking the right step. In terms of the title, I've got a limited number of gods in our profession. One of them is Jim Merles. The other two are Leo Hurwitz and Roger Myerson, and a few more. So maybe you can make it complicated. Merles, Hurwitz, Myerson. But I think we should focus on the substance. Title's fine.
Any other questions? Okay, wonderful. Thank you so much. We continue on the topic of climate policy with optimal climate policy with incomplete markets.
Yeah.
Okay, thanks to the organizers for putting the paper in the program. This is joint work with Thomas, who is here, Albert, Jan, and Marcelo. It's going to be a Ramsey approach to optimal taxation, but the first sentence in the presentation is actually very similar to the one that we just saw. With no other distortions, the carbon tax equals social cost of carbon, and that's what we typically think about is the Pigouvian tax. What we're going to consider is incomplete markets where you have inequality in risk and distortionary taxation, and in that case, the carbon tax potentially interacts with these outer wedges. So the question we are after is, should the carbon tax respond to inequality, risk, and fiscal constraints? The way we're going to tackle that question, we're going to develop a model which is a merge of climate models and standard incomplete market models. Within that framework, we're going to solve Ramsey problem, characterizing carbon tax versus Pigouvian principle, calibrate the model to the US data, characterize quantitatively optimal climate policy, and make a statement about welfare. What we find falls into three categories. In terms of theory, we're going to demonstrate that distortions of intra and intertemporal margins introduce a wedge between the Pigouvian rule and the optimal carbon tax. Quantitatively, though, we're going to show that optimal carbon tax closely tracks social cost of carbon. Therefore, these wedges quantitatively are not that important. In that sense, the key finding from the quantitative model is that the Pigouvian principle is robust and holds regardless of fiscal constraints on the planner, which is going to be true even though these constraints yield or relaxing these constraints move allocations a lot in the economy. And finally, we're going to link these findings to policy relative to the Intergovernmental Policy Panel on Climate Change. They have high emissions scenario, which we're going to compare ourselves to. The optimal policy yields substantial welfare gains of 4.7%. The welfare profile we're going to show is very asymmetric. Postponing carbon taxation is much more costly than overdoing it. Where do we fit in the literature? Very briefly, three strands of literature that we think we contribute. First, there is a large literature on optimal climate policy with complete markets. We bring in complete markets to the table. Second, there is growing literature on the distributional consequences of climate policy, What we do, we study time-varying optimal policy, analyzing transitions and accounting for welfare benefits of mitigation. And third, there is, of course, a big literature on the optimal fiscal policy of incomplete markets. What we bring to the table in here is introducing climate module and study climate policy within these frameworks. Okay, to the model. This is the environment. Briefly, time is discrete, population is denoted by capital NT, grows at rate and small nt. There are going to be two sectors in the economy. There is going to be exogenous TFP growth in these two sectors. Initially, households are going to be heterogeneous in their initial productivity, E, and then assets in initial equilibrium. And I'm going to kind of discretize the whole thing, meaning alpha I is going to denote a set of households with asset EI and AI. So productivity EI and assets AI. This idiosyncratic productivity, of course, follows a stochastic process, and I'm going to denote the history of these realizations, but by EIT with probability pi IT. I think this works. Households save, of course, in a risk-free asset. This is standard incomplete market model subject to the borrowing constraints. Two productive sectors, production sectors, final goods and energy sector. Government levies distortionary taxes, issues debt, and sets climate policy. That's kind of environment in brief. I'm going to work with these preferences where households have derived utility from consumption and labor in a standard way, and then there's going to be entering in a separable way a component associated with damages from the climate. Think about climate as a temperature. That's how I'm going to use it today. Importantly, this component is increasing and convex. There is a per capita. This is at the household level. Per capita assets are evolving according to the standard budget constraint. Next period asset adjusted for the growth of the household size are equal to a return on assets after tax, lump sum transfers, labor income, and net of consumption. So what is to see in here is there are three fiscal instruments which enter to the budget constraint of the household, which is the tax on capital, tax on labor, and lump sum transfers. Production of the final goods is standard, constant returns to scale, takes three inputs, capital, labor, and energy. And the second place where the damages for the temperature/climate are entering is via this damage function, dz, which is at a multiplicative with respect to productivity. And this again is going to be, by assumption, increasing in convex function. Firms rent capital and hire labor and energy at factor prices, respectively. And there's this second sector, production of energy. Energy is produced using two inputs, capital and labor. And here is where the CO2 carbon dioxide emissions are happening. Okay? So reading from the right, if I produce ET of energy, I can abate some of the energy production. This is going to be mu T, share of energy generated using clean technologies. Effectively, my emissions are ETM. This is what we're going to call CO2 emissions in the model. The firms are, of course, maximizing profits. Here, two things to be seen. First, this is where the carbon tax is entering. Okay, so the carbon tax is on emissions. And second, there is abating technology, but it's, of course, costly. So you can abate your emissions using this technology capital theta, which takes as inputs share of energy that you're abating, share of emissions that you're abating, and your energy production. Finally, the government has a standard budget constraint where the revenues from taxes are on the right-hand side. The government can issue new debt in order to cover exogenous government spending, lump sum transfers, and payments for government debt. The climate variable has its own law of motion, which is this J function. So the ZT, think about this again as a climate/temperature, is going to follow the law of motion, where the current Z depends on the history of emissions, some initial conditions, and then some exogenous drivers, which we're going to take from the literature. So what matters for the current temperature is the history of emissions. That's important. The temperature is going to be cumulative with respect to the past emissions. Okay, that's the model. Let me jump into a theory. Okay. We're going to study Ramsey problem in this environment. So first, we have to take a stand on what is the objective of the planner. We're going to stick to a utilitarian planner. Right? So the utilitarian planner is going to maximize this objective function W as a function of T, where T is the sequence of policy instruments. Remember, we start from some equilibrium and we kind of roll time forward. So this capital T is the sequence of infinite sequence of instruments for instruments, capital labor, carbon, and transfers. Given the set of instruments, we have the set of individual allocations, aggregate allocations, and prices. And the Ramsey planner in this environment is announcing and committing to policy at date 0, the policy which solves this problem. Maximize welfare by picking the sequences of these tax instruments subject to the constraint that these allocations and prices constitute a competitive equilibrium induced by these policies. This is what the problem that we're going to solve. And first, in order to present the key result in theory, we need a benchmark.
Just a clarification, it's positive population growth, right? So writing the utilitarian planner that way, it sort of puts extra weights on the future because there's more people
that's
around.
correct. Yes. That's correct. That's a good point. Yes. Okay, so first in order to characterize the solution to the problem, it's useful to have a benchmark, and this benchmark is going to be the Pigouvian tax, which I'm going to define as follows. I'm going to read that equation from the right-hand side. Think about the marginal effect of an increase in emission. That would be this object, how it translates to the temperature. Okay, so on the margin, the temperature is rising. That enters into the economy via two channels. First, through this utility channel, that's this piece, where WZT is just marginal utility damage from higher temperature. And second, on the production side, remember production is multiplicative with respect to the damages are multiplicative with respect to production function. So it creates damages on the productivity side, and then you have to translate these damages into object relevant from the household standpoint, and the object which is going to be relevant from the household standpoint is going to be the marginal utility of consumption averaged across households, types, and histories. Okay, that's this WCT at a period T plus J. So this is on the margin, and then of course you roll things forward. So this is the present value of the damages, and you need to convert it to the current period. So divide it by the, again, marginal utility of consumption average across households at date T. Okay, so period by period, this is what we're going to call the Pigouvian tax. Right? Interpretation is just the welfare cost of an extra unit of emissions at date T in the units of date T consumption evaluated at a competitive equilibrium allocation. That's important. The right-hand side of this object can be evaluated at any allocation. And what we're going to do, we're going to evaluate it at a particular competitive equilibrium allocation, which we're going to consider. Okay? This is the main result of the paper, of the theory side of the paper. The Ramsey carbon tax is going to satisfy what we call a modified Pigouvian rule. This is a superscript S best stands for second best, but since Chari is in the room, I'm going to refrain from using these second and third best language. So this is the optimal carbon tax. Again, if you compare it to the formula in the previous slide, most of the components are identical. What is different is this is how do you convert the damages into utilities, and what is different is this multipliers VT in here. What is VT is the multiplier on the resource constraint for final consumption good, which satisfies this relationship. So we go to the previous object, we had this capital WCs in here. Now we have the multipliers in here. They are still, the WCs are in here, but then there are some residuals. Okay, let me focus on these residuals. These are these wedges that I said at the very beginning are differentiating Pigouvian tax from the optimal carbon tax, which comes out of the Ramsey problem. What are those? Okay, so remember, this is evaluated at the solution of the Ramsey problem, meaning all the other instruments are optimized. Okay, given that these objects reflect the impact of distortionary taxation. We have two of them. One is SDIT. This is a saving distortion. So this is, think about a margin increase in consumption at the household level, how it changes the distortion at the intertemporal margin. And then LD is a marginal change in the intratemporal distortion. So think about an increase on the margin in consumption, how it changes the intratemporal distortion. Two interesting cases is where these two collapse is if household is constrained in borrowing in two consecutive periods, this would collapse to zero. And second case is if there is no income effect on labor supply, there is no connection between consumption of the household and its labor supply decision, and therefore this is going to also collapse. Okay, so these are kind of two edge cases which are somehow interesting, where these two distortions are going to disappear. Now further constraints on those sequences of policies, there are going to be additional terms showing up on the right-hand side of this equation. Okay, so as we move away from the optimum of the Ramsey platter towards more constrained policies in terms of those sequences, there are going to be some additional terms in here. Okay? That's the main result of the paper. Now let's take the model to data and think about quantification. I'm going to be very brief given the time constraint on how we calibrate the model. There's a lot of parameters we need to take a stand on. Very briefly, these are the preferences that we are going to work with: non-separable in labor and consumption, and then separable with respect to temperature. 4 key parameters in any macro model. We're going to discipline with capital to output, average hours, intertemporal elasticity of substitution. We're going to impose a number on that and aggregate friction elasticity. This number, alpha z, we're going to follow Borash, a well-known paper by Borash, and we're going to set it to so that 26%, roughly 1/4 of damages in the economy, are going to be on the utility side. 75% are going to be on the production side. That's the stand that we do. The model replicates wealth, earnings, and hour distributions fairly well. On top of that, we match also the properties of labor income, variance, skewness, and Morse kurtosis. So not only cross-sectional distribution, but also the dynamics of labor income are in line with their data counterparts. And finally, on the production side, we follow very closely the literature, the parameters. One thing that I want to focus on is this abatement technology. 2 objects in here which are relevant. The first is this PT back, which is the backstop price. This backstop price reflects the marginal cost of abating the last unit of the CO2. So it controls the marginal cost of abatement. This we are going to take directly from the DICE model already mentioned today in the first talk. It's a technology parameter that is time varying in DICE. And we're going to feed it into the model directly. I will show you that line and the figure in a couple of slides. And second thing is that the energy enters in here in a linear fashion. Therefore, profits are going to be of the firm are going to be zero in equilibrium. Okay, results. So first, let me walk you through what kind of policy experiments we are doing. We study a government that chooses, remember, time varying carbon taxes. And now we're going to do it under 3 different fiscal regimes. The first regime is going to be, I'm going to go from the most fiscally constrained regime to the least fiscally constrained regime. The first regime is going to be fixed debt to GDP and fixed other taxes. Transfers are going to adjust the budget of the government. The second is going to be flexible debt to GDP, fixed other taxes. Transfers are going to follow a flexible path. It's going to be optimal to front load them. So that's we relax debt to GDP. That's in that scenario. And third scenario is flexible debt to GDP, optimal but constant labor and capital taxes. And it's going to be optimal to increase both of them. So as you move down in this slide, we relax the fiscal constraints imposed on the plan. Even that, let me just say, even that problem is not that trivial to solve on the computer. As we move down the road, we need a lot of flexibility on the time variation in here in order to characterize properly that economy. So this is kind of a non-trivial computational problem. We use techniques which I used in the previous paper with Marcelo to solve that problem. Okay, to the results. Let me start. I'm going to present these results in the same order. I'm going to start with this economy and then move towards these 2. There are 3 lines in here. The first is this technological backstop price line. This is the black line in here. Remember, this is the cost of abating the last unit of the CO2. Once the cost is low enough, at that point, we're going to produce energy fully, not emitting anything. Okay, so that is what we are fitting into the model. Then there's a Pigouvian tax. That's this, call it pink, upward sloping line. Why is it upward sloping? Remember, damages are convex. Temperature is cumulative. As we roll time forward and the economy produces, the temperature rises. Convex damages mean that as we evaluate the Pigouvian formula that I showed you at a competitive equilibrium allocation, the Pigouvian tax is going to come upwards. Okay?
Can I ask you a naive question? Is it more like a balanced growth path?
Yes, we start with the balanced growth path, and then
you-
then it's kind of like an MIT shock, and then we roll transition forward, imposing the growth rates, and then we end up in the balanced growth path at the end.
And at that balanced growth path, temperature is constant?
No, because the
Z.
Z. No.
Then how could it happen?
Yes. Sorry, but the balance graph for the temperature is going to.
Yeah, so
Yes.
whenever you're gonna hit backstop price, then your economy is fully
Fully
balanced, right? And it doesn't go.
Yeah, even in the balance graph. But if we don't change any, I think I misunderstood the question. Yes, if you don't change anything, at some point you're going to hit the balance, the backstop price, and no, the temperature is no longer going to rise. That's the proper answer to the question. Yes, thanks to. Okay, and then the key result is how far the optimal carbon tax in the most constrained fiscal environment is from the Pigouvian principle, from the Pigouvian tax. And you can see it's very close, okay? And I will try to explain why that is in a couple of minutes, okay? This is the most fiscally constrained economy. I'm going to move now towards less fiscally constrained economy. What I want you to see is that the line is going to get closer and closer to the Pigouvian, okay? As I make that flexible and make taxes flexible, I'm basically going to sit on the Pigouvian tax. That transfers and income taxes, however, the fiscal side is relaxed. The carbon tax tracks the social cost of carbon, right? The Pigouvian. Why that is? What's going on in here? I think the useful thing to explain this result is to walk through an impact of the carbon tax through the equilibrium of the model, okay? And the way to start is, imagine I'm going to set the carbon tax exactly to price the social cost of carbon, which would be to set it exactly to the discounted marginal damage on the right-hand side. That's the formula for the Pigouvian. And now consider a deviation as we move with the carbon tax away from that. That's going to change an allocation, okay? Abatement is going to go up, and emissions are going to translate into the temperature changes, but it's also going to create a fiscal flow, okay? From the perspective, this is happening kind of at the production level. From the perspective of the household, these allocative changes as well as the fiscal flow are going to reach the household through 4 objects that matter for the decision making of the household, which is after-tax wage, after-tax interest rate, transfers, and temperature. Okay, the Z lag is priced above, so the first order effect from that deviation is fiscal residual. Okay, it's fiscal. Sorry. Now, in the world with the free instruments, so the true solution to the Ramsey problem, okay, you just set after-tax prices and transfers directly. There is no welfare. I mean, welfare gains are exhausted. This is just an envelope argument in here, right? In a fiscally constrained environment, potentially the envelope can fail, okay? And the planner is going to try to manipulate factor prices as well as transfers in order to mimic the solution of the free instruments. The value of these factor prices is multipliers on fixed instruments plus the quality of the mimic. The quality of that mimicry depends on the elasticity of factor prices with respect to the carbon taxes, and these are extremely low in the quantitative. Okay, but this is to say that if I deviate with my carbon tax, to what extent I'm able to manipulate household behavior through the factor prices? Almost not at all. Okay, and to quantify that welfare gain from optimal tax over Pigou in the baseline, which is the most fiscally constrained environment, is 0.008%. And as I make instruments more flexible, I'm basically decreasing it by almost an order of magnitude. Okay. So this is to say that the carbon tax, in a sense, is not a substitute for other instruments that the planner has its own disposal in order to affect whatever the welfare criterion we're going to impose on the planner. 5 minutes.
Yeah, in the case where you're constrained, or the instrument are constrained, still you transfer the flexibility.
Yes. So we start with a case where transfers are constant. Then we allow the transfers to vary over time. And then we add on top of that variation in taxes. And this is true despite the fact that allocations across these economies look drastically different, right? I'm comparing here the red line, fixed debt to GDP, flexible debt, flexible transfers, that's the blue line, and the yellow, flexible debt and flexible taxes. You see very different patterns of transfers, drastically different patterns of debt, of course. Capital and consumption are very different. So despite differences in allocations, aggregate allocations, the result that the Piguvian principle holds is robust. And in the final 3 minutes or 4, let me just throw in one result that highlights what's important in this logic is also that the revenues are not lost in a sense, but used in a productive fashion. Okay, I'm now going to consider the most fiscally constrained economy and compare it to the case where instead of transferring resources to the household, I'm going to throw them away, and they're going to, in a sense, I'm going to finance government expenditure, which is not useful from the standing of the drop bombs or fireworks, exactly. And you see that once we do that, the optimal carbon tax deviates significantly from the Piguvian tax. Okay, with revenue wasted, every dollar collected is a pure cost. Okay, so revenue is going to kind of follow a carbon Laffer curve, peaking at intermediate rates. The planner waits at 0, and then, like in a bank fashion, is going to jump to the backstop price. 2 minutes, welfare analysis. Very briefly, what we do, we take a SSP5 scenario. This is the one of the scenarios around by this imposed by this panel or studied by this panel. This is the temperature that this scenario imposes. So it's like a high emission scenario, and we are going to compare it to our optimal one. How do we get that temperature in the model? Basically invert the temperature to implement the temperature using the carbon tax. So this is the carbon tax that implements that temperature relative to our optimal one. The key exercise in here is now I'm going to consider a variation between these paths. Okay, as you move to the left from the optimal, you're going to front load carbon taxes. As you move to the right of the optimal past the SSP5, you're going to backload carbon tax. We're going to look at the welfare profile across these variations to see how costly it is to backload carbon taxation. That's what comes out. Okay, is this asymmetric welfare profile where to the left of SSP5, that's associated to the right of that line, I'm backloading, postponing carbon taxation. The profile is very steep. Welfare-wise, it's very costly to postpone carbon taxation in this economy. To the right of the optimum, this is our optimum, the welfare profile is fairly flat. So overdoing carbon taxation by front-loading it, that's movement to the left of the blue line, is fairly cheap in terms of welfare. And that's kind of a key finding from the welfare analysis conducted. Okay. Welfare decomposition just points to what are, again, the trade-offs in the planner's objective function. By varying the carbon tax in here, you see that what moves is actually the efficiency, what we call the level, and the utility damages. Redistribution and insurance don't move that much, which is again an evidence that carbon tax is not a great tool either to provide insurance or redistribute resources across households in this economy. Finally, to conclude, there are 3 insights I think that we want to convey. First, in terms of theory, the optimal carbon tax deviates from Pigou with the wedge driven by savings and labor distortions. Quantitatively, the Pigou principle is alive and robust in the standard incomplete market model with climate module, regardless of the fiscal constraints. In terms of the policy prescription that comes out of this exercise, it's better to overshoot with the carbon tax, since welfare losses are very steep to the left of the optimum. Postponing it is very costly welfare-wise. In the paper, we have extension to Stone Geary and some other stuff that is work in progress. Thank you very much for your time.
Thank you. And our discussant is Alessandra Peter.
Great. Thanks a lot to the organizers for inviting me to the session. Up until a few weeks ago, I knew very little about taxation and very little about the climate. So this is going to be all the pros and cons of like a complete outsider coming to this literature. So one thing I got out of doing this discussion is kind of carefully reading also Hassler, Krusal-Savinsky. It's a beautiful paper. And I think in many ways, this is a very natural extension of their framework. So basically, what does GHKT do? they write the first kind of full-blown DSGE model with climate change and conceptualize kind of carbon, or the problem is like an intertemporal elasticity. So in their paper, carbon emissions today reduce output tomorrow with a representative agent. The name of the game is how do we want to allocate over time? And then if you make a bunch of kind of assumptions we often do in the literature, some on utility, damages proportional output, constant savings rate, you get a very simple formula for the Pigouvian tax, which equal to the social cost of carbon, that is just proportional to output. The only thing we need to know is output today, and then some parameters, gamma and delta, that have to do with how bad is carbon, how long does it stay in the atmosphere. Now, PER used to joke they solved this model in Excel. Now come in kind of from GHKT DDHP, which is basically the first model on steroids. This was not solved in Excel. In fact, there's a companion computational paper that's and what are they going to do? They're basically going to add 3 features. First, they're going to do an Iagari-Imrohologu model that adds idiosyncratic risk and constraints. They're going to consider a planner with restricted instrument, only linear taxes and lump sum transfers. And in addition, they're also going to allow carbon emissions to induce amenity damages, which is going to also imply an intra-temporal trade-off. Okay? And the headline finding of the paper, to some extent, is that heterogeneity and uninsurable risk don't matter. Relative to the social cost of carbon, this kind of second best tax basically is almost identical, and the welfare gains for moving to the full-blown kind of Ramsey thing are less than 0.01%. So what I want to do kind of in my discussion is think about kind of what's the benchmark against which we're going to conclude that heterogeneity doesn't matter. And I think I have a slightly different interpretation of kind of why they find the null results that I'm going to go to. Okay, so first we're moving to heterogeneous households, so we have to choose how to aggregate. We're going to do a utilitarian planner with equal weights. But importantly, that's also what we're going to evaluate it against. So the Pigouvian planner was going to have, as if Pigouvian planner is going to have the same weight. So the benchmark, and that kind of took me a while to wrap my head around that we're going to evaluate things at, is taking the Pigouvian principle or formula and just applying it to the second best allocation. It's not actually the solution to any other well-defined problem. And for sure, in their framework, it'd be worse to do. But that's kind of the comparison we're going to do. So it's the same consumption, hours, and prices, and everything that go into both objects. So the difference really is just the valuation. So in the Pigouvian benchmark, damages are valued at the average marginal utility, whereas in the second best, damages are valued at the shadow value of public funds. And those two might kind of differ. Okay, so it's important to keep in mind that that Pigouvian valuation benchmark already includes all these distributional concerns, like average marginal utilities may be high or low because of convexity. So then basically, Sebastian talked a little bit about this wedge that I have down here, but I want to think about kind of more broadly, when does the wedge matter for the taxes? And they basically show in the paper, and then with a little bit of tweaking around, that as long as something is optimally chosen, like the fiscal margin, then you can write the wedge between the second best and the planner as consisting of 2 components. One that I'm calling the static component. That's basically what is the level of the marginal cost of public funds. I'm told that's a term people use in public finance. It's basically the exchange rate between the marginal value of public funds and just average marginal utility. And a dynamic path, like how does this exchange rate vary over time? Those are 2 margins. I'm going to discuss them both in isolation. So first, the level of this distortion really is only tied to amenities because they're the only thing that kind of affects things within a period. And they're calibrated here to be about 26% of the problem. And then there's the path of that marginal cost of public fund. And that's really what's going to be driving different valuations of production damages. So let's take the static piece first. That I think is a standard public good provisions problem that's not really necessarily about climate change. So first notice that production damages can never create a static wedge in this setup. Why? Because both the damage and the abatement is in units of output or in units of goods. So the same marginal value of public funds applies to both. It cancels out. No wedge between Pigou and Ramsey. Amenities, however, are in utils, and here they're linearly additive. So if I convert amenities to goods, that exchange rate is different between the 2 problems. In the second best, we do it at this new, in the first best, just average marginal utility. And now you get a wedge that is kind of related to this concept of the fiscal leak. In some sense, it's the exact same mechanism as thinking about should we finance parks with labor taxes. And the idea is, well, relative to giving people lump sum money, which reduces their labor supply, which kind of erodes the tax base, there's no adverse effect on labor supply by providing parks. When could that fiscal leak be big? Either if we're in a very distorted steady state where there's lots of redistribution or there's strong income effects. Okay? So that's the static piece. Now let's think about the dynamic piece and when that could be large. So to do that, I'm more in the kind of solving things in Excel category. So I wrote down a minimal 3-period toy model in which there's only production damages and very simplified. And basically, what I learned from this is that any sort of stationary, quote unquote, level of inequality in the population may affect the level of the marginal cost of public funds, but it leaves the Pigouvian kind of result completely intact. So I kind of, as best as I could in that simple model, replicated the main finding here of a wedge of about kind of less than 1%. You see that the path of that disagreement between planner and Pigou is actually very large at 17%, but it's constant here. So it's not going to affect at all how we're going to tax carbon, which is an intertemporal thing. Now, what are some things that could maybe break it? One thing, not saying that's what you should do in the paper, but just to get an intuition of what could break it, is movements in this uninsured dispersion. So if in like period t equals 1, we get a permanent rise in uninsurable risk, then all of a sudden this wedge is going to change and we get kind of, the MCF path is going to change and we get a significant wedge. So concretely, what I would love to kind of see in the paper is a little bit more of a discussion of what exactly drives the flatness of their results over time. In particular, Sebastian nicely showed that they also decompose it into the savings and the labor supply wedge. Are each of them flat over time? Do they cancel each other out? There's also this like small technical term that maybe Dirk got at, that we assume that in the very long run, things are stationary, because we know from some of like Adrian's work with Ramsey, otherwise we might run into issues. Is that what's driving the I don't think so, but it might be nice to see if that's what's driving it. Okay. 2 more quick points. So far, everything I've done is assuming that the fiscal system is optimal. But of course, all these wedges could also be very large if redistribution is underprovided. Then we could use the climate tax to substitute for redistribution. Why would that be useful? Because incidence is proportional income, but the rebates are uniform taxation. That could potentially be big. In the current calibration, it's changed, I think, maybe since I read the paper, but lump sum transfers are about 15% of GDP, so we're doing tons of redistribution already. Could you do some kind of robustness to that? That also relates a little bit to a separate request, which is your main policy result, that undertaxing is much worse than overtaxing, the asymmetry. Is that the heterogeneous agents or the convexity of kind of the taxing and the climate damages? Okay, this is kind of my last slide, which is mostly asking kind of for next step. Papers aren't already econometric, so I don't think much of this will make it into the paper. But I think what we really learned is that given the current transfer-rich system, adding in heterogeneous agents per se doesn't really change conclusions. But I think now it's a beautiful laboratory to use that machinery to really kind of study incidence more carefully. And here I think the 2 natural next steps are 2 things. One, to think a bit more about who's hurt by climate change. This is kind of uniform in their paper, which maybe within the US isn't that important, but for sure globally. And who is hurt by the taxes? And we both have some evidence that poor household incomes are more affected by carbon prices, by carbon taxation, and also that poor households consume more energy intensive goods. You have that in a paper with Stone-Geary. I would advocate using kind of Pigel or Timo Bopart's preferences, because with Stone-Geary you still have linear angle curves, and so the quantitative mechanisms maybe not so strong. So those are my thoughts. Very much looking forward to seeing the final version come out. And then I think it's a very nice laboratory to kind of study some more degrees of heterogeneity.
Wonderful. Thank you. Sebastian, you want to very briefly respond so we can take some questions too?
Thank you very much. This is a very thoughtful discussion. I mean, most of the points are well taken and valid. We certainly need to investigate more quantitatively what drives the flatness. We do have transfers, lower transfers to GDP sensitivity analysis. All the results do hold. They're not yet in the paper, but we run them on the computer. And we do have an extension to Stongiri, but the point is well taken that it's on the to-do list to use other preferences.
Although it's idiosyncratic risk, you don't have perfectly linear RNA curves, and that's because of precautionary savings. But yeah, point taken. Yeah.
Okay, happy to answer any questions.
Yeah, sorry, I'm just gonna really investigate.
On the question I had earlier, sorry, I'm trying to understand what's exactly balancing the budget here for the government. Is that when you're changing the carbon tax, you're effectively having an extra source of revenue, and then something has to change in the budget constraint, so you're giving that money lump sum by transfers. Is that what's happening?
Yes, in the most constrained scenario, yes. Then in the
most constrained, that's the one I'm interested in,
yeah.
because that's the one you would see the most effect theoretically, right?
Yep.
So, but then here you're kind of providing by this kind of what's the name of it? But you're providing extra money to the poor household who could have been potentially affected
yes,
by
the
the
marginal
carbon tax.
effect for the poor households of the
Right, so
dollar
you're
is very
kind of
different.
canceling one of the redistributive effect of the carbon tax, which is kind of here already a little bit muted because you only have like representative firm, right? Is that right? So could it be one of the explanation of why the effect is so small?
So if I understand correctly, your question is if we were to close the model fiscally with different instruments and lump sum transfer, would the results survive in the most fiscally constrained economy? That's a good question, which I think have to we have to check. I don't recall that we have the answer to that.
We could do more, but I remember we experimented at some point to instead reduce the labor tax, and the effects were really similar. Because I mean, if you're close enough to an optimal tax system, from the envelope, the two are gonna lead to similar welfare effects.
And sorry, a second follow-up question. Here also, most of the action is happening through this abatement function, and here it's doing most of the heavy lifting. If you're doing something like without that weirdly calibrated abatement function that's coming from DICE, and that's many people like not very comfortable with in the climate literature, would that change things as well? Maybe.
So if we assume a different abatement function?
No, if you're using the firm is changing their energy choices.
It's just entire adjustment would go through the energy. It's like it would be a higher effect on amount of energy produced in the economy.
Exactly.
And that would like follow through the factor prices to the household. That would be, I think the effect would be only quantitative.
Okay. Yeah, but that's...
That's a fair point.
Exactly. Thank you.
Just a brief complimentary restatement of something Alessandra said that I thought really rung home. I liked the parks point. So we often forget that there are many goods, say, that have no externalities. The optimal Pigouvian tax is 0. And if we were looking at such a good over time, we could then ask the question, would we want to deviate in taxing it from the Pigouvian optimum, which is 0? So it could be, capital, it could be popcorn, it could be really anything. So if we're getting a flat result, it seems to me that we're getting the product of two things. One is what is the empirical magnitude of the various wedges that we have, which is a question that has nothing to do with carbon, climate, or anything else. And then the second question is what is, in a sense, the cross-elasticity interaction between whatever the good happens to be. It could be parks, it could be climate, it could be popcorn. So if we're getting something near 0, it has to be based on an empirical result having nothing to do with carbon in particular, on either the wedges are small and or the empirical interaction from whatever other work calibrates that. And if I knew at the beginning of the paper that one or the other of those two numbers was very close to 0, then I would know what the result roughly was going to be independent. But it's a little like my comment in the first session. It's really not about carbon. It's really about a good with an interaction with another wedge that happens to be there.
Right. Yeah, right. So one way to state our results is that we get a modified Pigovian rule where the modification occurs through the marginal cost of public funds. And you're right that there is nothing fundamentally climate about the marginal cost of public funds, and we could fill in any kind of externality and we'll have the same adjustments. That's correct. Yeah.
So just for the online audience, not that they're listening, VV just for them. This is great. I mean, this is just a tour de force, just computationally. You guys have excelled yourselves. This is wonderful. So I hate to ask you to do more, but I'm going to anyway.
Go for it.
No, I think rather than utilitarian welfare weights, I think what might be more instructive at some level is Negishi-like weights. So start with a comparative equilibrium where the Ramsey planner ignores all the climate stuff and just solves out what the optimal policy would look like. That implies, at least in a steady state, some distribution of marginal utilities. Use those perhaps to weight things. The argument for that is pretty straightforward, right? You don't want to confuse two separate things. The planner wants to do some things for redistribution, which even ignoring climate change, the planner is not doing, presumably for some good reason. Then you want to ask, what's the added effect, right? So go more Negishi rather than utilitarian might be something useful to do, right? You could, of course, do Rawlsian stuff, but I hate that stuff, so don't do it.
No, yeah, that's an excellent suggestion. We haven't thought about that actually. So that would be kind of capturing the marginal effect of adding to the planner's objective the climate stuff given the weights out of. Okay, got it. Yeah, it's doable, and yeah, we'll give it a try.
Yeah,
definitely.
I mean, theoretically, we do it in a previous paper where we have complete markets, and there you can characterize analytically the optimal carbon tax with Negishi weights, and you get perfectly Pigou. Right, and you're gonna at the optimum deviate from Pigou to the extent that the Negishi weights are different from the Pareto weights. But with incomplete markets, theoretically it's a bit more tricky.
So it's not really Negishi, but it's sort of similar to Negishi in the sense of taking the equilibrium.
Thank you very much.
I think this might be just almost an expositional point, but I would really start with the complete markets world. Forget about all the heterogeneity, all the idiosyncratic risk, and show what you get there under your fiscal constraints, right? Because if you don't have fiscal constraints, we know what we're going to get. But under those constraints, show that as a benchmark. And then I think state very clearly why we would expect that market incompleteness and potential redistribution, why would we expect to get anything different from Pigou? I mean, I understand why we would get something different if one or two, what Alexandra mentioned is present, but in the absence of that, my prior would have been that you don't find very much, and then you don't find very much. And in a way that would have confirmed my prior. I would have liked a stronger argument why ex ante I should have expected that heterogeneity and uninsurable idiosyncratic risk would matter for the environmental.
Yeah, it's a good point. So the paper we base our analysis from, it's the Barrage paper. It's a representative agent model, and there she finds substantial deviation from Pigou. And the idea is that you have a representative agent, so in theory you have no reason to tax labor and capital, right? So you're gonna get it unless you're not gonna get it unless you put some restriction in the tax system. And we show that within free markets you actually want to tax labor and capital, right? So you have a rationale for these taxes. And that's why we get kind of an envelope argument. And so essentially with representative agent and distortion in taxation, you tax below Pigou. Once you rationalize these taxes, you are back at Pigou. So.
Yeah, good exposition point.
Well, thank you so much. This was a great first session. So we have a break and we reconvene at 11.
And I put my side.
Let's get going. I cannot start the session beyond time. That would violate my German proudness. Next paper is by Philip Wagner and Alexandre Gaillard, Inequality, Business Cycles and Growth. 25 minutes, all yours.
Thanks so much. Hello, everybody. Thanks so much to the organizers for having this paper on the program. So this is a revised version of a paper that has been out there for 3 years. So I'm really happy to present this today. So what's the motivation of this paper? Text finance stimulus programs are a key central policy tool to stabilize economic activity during economic downturns. The typical design or typical financing design in the United States of such policies lean on a progressive financing design. That means like the tax burdens falls overly on high income or high wealth households. That's not only a historical pattern, you can also see this in more recent debates. Think about the financing discussion of the Build Back Better proposal after the COVID recession, for instance. So in the literature, there are two opposing and often politically heated views on this policy design. On the one hand side, it's often argued that this financing design goes along with important and sizable short-run gains. Okay, so if the tax burden falls on households with a relatively low marginal propensity to consume, that stimulus program can implicitly redistribute to households with a high spending propensity that's going to crowd in consumption and hence aggregate demand. On the other side, it's often argued that higher income taxes or higher progressivity of income taxes lowers entrepreneurial investment, innovation, and growth. So the gap in the literature is that those two opposing views are often studied in isolation. Okay, think of, for the first view, the short-run gains of the traditional Hank model a la Kaplan and Corfers, and some of you in the audience has worked on this as well. On the second view, think more about a long-run model, like an endogenous growth, Ageo-Howitt type of model. So hence what the objective of this paper is to integrate those two opposing views into a comprehensive framework and try to understand the short and the long-run propagation of tax-financed fiscal stimulus programs. In particular, we're going to ask two questions in this paper. Question number one, is there a trade-off between short-run stabilization and long-run output growth? And if there is such a trade-off, question number two will say like, well, can we alleviate this trade-off by reforming the tax incidence and the tax design, and perhaps can we also improve welfare? And in the next 25 minutes of my talk, I'm going to convince you, I'm trying to convince you that the answer to both of these questions is yes. So how do I do this? This paper proceeds in 3 steps. So in the first part of the paper, we're going to develop a novel framework, which we call the Heterogeneous Agent Nucleation Growth Framework. Why do we need that framework? Essentially, we need a framework that allows us to think about the redistributive effects of tax-funded stimulus programs, both in the short run and in the long run. So that framework is going to have 3 main building blocks. The first block is a heterogeneous agent block. Essentially, those stimulus programs are going to be shaped by household heterogeneity through the joint distributions of propensities to consume and propensities to innovate and invest. The second main building block is a new Keynesian building block. Essentially, that building block will allow me that demand-driven fluctuations will have real economic effects. And that is the last building block. We're going to have an endogenous growth block, and here we're going to assume that innovative investment is going to be the engine of growth. We're going to develop this framework in 2 parts. So in the first part of the paper, we're going to almost have a very simplistic analytical version of that model that allows for many degrees of realism, but really concentrates on the main trade-offs. And here we're going to show that there are 3 regimes in this economy when I think about the propagation of tax-funded stimulus programs that have potentially opposing short and long-run responses. There will be a regime where this progressively financed stimulus is going to be good in the short run and also good in the long run by increasing innovation. There's going to be a regime where it's bad in the short run because the aggregate demand is going to contract, and it's also bad in the long run because innovation and growth will be lower. And then there's going to be a third intermediate regime where the stimulus program is good in the short run and bad in the long run. In particular, we're going to show that the existence and the characterization of those regimes will rely on 2 main policy parameters, namely the degree of monetary policy, how aggressive central banks are going to fight against the stimulus program and the resulting inflation and output, and the tax incidence. In the final part of the paper, we're again going to build a more quantitative version of that model, and we're going to study the propagation of a typical progressively financed US government spending shock. We're going to show that this regime where we have this short versus long run stabilization trade-off is going to be a robust outcome. To give you some numbers on this, we're going to find output multipliers on impact in between 0.95 and 1.3 after 1 quarter. We're going to find 0 multipliers of a time horizon after 2 to 4 years after the shocks. And we're going to find long-run negative multipliers of an order of magnitude between 0.25 and minus 0.1%. Okay, relative to a 1% government spending shock. We're then going to ask, or the answer to the second question, well, is there a welfare improving tax design? And here we're going to slightly have this provocative result, perhaps that a tax incident on the middle class household is going to alleviate and avoid this trade-off. And it's also going to be a Pareto improvement relative to the existing tax schedule. That means all of the households, in particular those who are targeted to finance this policy, will be better off. In terms of the structure of this talk, I'm going to proceed in 4 parts. First, I'm going to have the analytical model, I'm going to show you the main theoretical result, then I go briefly over the quantitative analysis and the calibration, and then I'm going to conclude. Okay, analytical model. So in that model, there are going to be 5 actors. First, there are going to be households that consume, work, save, and invest in a setting of incomplete markets. On the production side, we're going to assume a final good firm and a continuum of intermediate innovative firms. There's going to be labor unions, so they are going to be responsible for the stickiness on the new Keynesian block of that economy. They're going to set nominal wages for differentiated labor varieties under Rotenberg adjustment type of costs. There's going to be a government, and the sole objective of the government here is to finance a wasteful government spending shock. So in the core part of the paper, government spending is wasteful. I'm happy to work you through the intuitions later on when we relax this assumption and allow that part of the government spending is essentially productive. The job of the government is pretty simple here. It only allocates the tax burden across different households, okay? And in the simple model, that's going to be non-distortionary, okay? Finally, we're going to have a central bank that sets the nominal interest rate. So let me go block by block briefly. On the household side, we're going to assume that there is a continuum I of households that work an amount LTI and consume an amount CTI. There are going to be 2 types of households. There's going to be a mass lambda of hand-to-mouth agents. They consume their disposable income in every period. Then there's going to be a remaining mass 1 minus lambda of entrepreneurs or savers, and they're going to have an important portfolio choice, which is they can choose between holding liquid bonds, BTI, or illiquid innovative capital, AT+1. Importantly, those households, they transit across 2 states, okay? So there's a probability S that an entrepreneurial household will remain entrepreneurial household in the next period, and then there's going to be probability 1 minus S that the entrepreneurial household is going to lose its entrepreneurial ability and move to the hand-to-mouth state. So you can think of these transitions as idiosyncratic income risk. So hence, there's going to be a precautionary self-insurance motive across households, and that's going to be key when I think about the portfolio allocation of those households. On the insurance side, we're going to work with the standard 0 liquidity bond market equilibrium. We're going to relax this assumption later in the quantitative model. That means our households are going to pool the resources at the beginning of every period once they have transitioned to their new household state, okay? That means I'm going to have full insurance within a household type, but not full insurance across households type. So essentially my income, consumption, wealth distributions are bimodal. That also means that every household is going to make equivalent consumption and saving decisions for the same type. So let me briefly show you the value functions of an entrepreneur. So the value function depends on 2 states, on aggregate bonds and on innovative capital. And the household is going to maximize over consumption and the probability of transiting or staying on the entrepreneurial side in the next period and moving to the hand-to-mouth side. Importantly, in the value function of my hand-to-mouth agents, there is not going to be innovative capital because the asset is illiquid. That means once households are forced to transit across states, they're going to lose this innovative capital, okay? Think of it, if you have a patent and a new firm is entering the market that drives your value of the patent to 0, so you cannot use it to self-insure. So entrepreneurs are going to maximize this objective function subject to a standard budget constraint that says consumption plus investment plus bond savings equals total income. So what is total income in this economy for my entrepreneurs? It's the sum of labor income, capital income, bond income, minus government taxes. Okay, I'm going to specify government taxes, tau s, in the next period. The second constraint where households are going to maximize this problem over is the law of motion of innovative capital. That says next period innovative capital equals today's period of today's value of innovative capital plus today's level of investment. So psi, you can think of the Greek letter psi as kind of efficiency units. How efficient is going to raise one additional dollar of innovative investment going to be the stock of innovative capital. What you can see importantly is that there is no depreciation. That means any change in innovative investment today will have a long run effect on the stock of innovations. Then we have two law of motions of the bond holdings. That means the aggregate family bond holdings of all savers is just the sum of the bond holdings of the savers that are going to remain savers plus the ones from the hand to mouth that are going to move into the saver state, and vice versa for the hand to mouth bond holdings. And finally, we have two negative constraints. So bond holdings are weakly positive and also innovative capital is weakly positive. On the production side, we're going to have a final good firm that is representative. That means it's going to produce output with two inputs. First, we have labor, and then we have intermediary inputs, xjt. And each of those intermediary inputs, xjt, has a certain quality, HJT plus 1. So think of HJT plus 1 as a standard quality ladder in a vertical innovation type of model. My final good firm is going to choose the demand for labor and intermediary inputs as a price taker. Okay. On the intermediary good firms, I'm going to assume a continuum J of intermediary good firms, and they're going to use or transform the final good based on a one-to-one transformation to produce their intermediary good. Okay. Each of those intermediary firms J, they operate as a local monopolist and set their price PTJ as a markup over the intermediate, as a markup over the marginal costs PT. And once I solve that problem, that essentially gives me an innovative investment return RT that is a function of aggregate labor or aggregate demand and a positive scalar shifter. So that kind of term is important to understand because this is essentially where all the market size effect from the innovative literature is going to come from. Okay, so whenever I have a high market size, think of it as a redistribution to hand-to-mouth households with a high MPC. Those innovative returns are going to go up. Hence, I have a cyclical innovation premium, and that may drive in innovation or drive out innovation. To conclude the model, I need to briefly talk about the rigidity. So here we're going to assume that we have sticky wages. That's going to be important because it gives me the right cyclicality of profits, and that gives me the right cyclicality of my innovation response, and I assume flexible prices. On the fiscal policy side, as I said, this is very simplistic for now. I'm going to assume that the government is going to finance a government spending shock, GT, with balanced budget. How does it do it? Well, it's going to split, it's a cake splitting problem. It's going to split the tax burden between my hand-to-mouth households with a fraction tau and my entrepreneurial households with the corresponding fraction 1 minus tau. Government spending follows the standard AR1 process with persistence rho. And what we can see is that the splitting rule opens the door for 3 possible tax regimes. The first regime is where tau equals the hand-to-mouth share. That means the corresponding share on my entrepreneurial households is 1 minus lambda. That means every of those 2 households groups bears the tax burden according to its share. So it's a uniform tax allocation. The other case is where tau is larger than lambda. So in a world of regressive financing, that means my hand-to-mouth households have a higher tax burden as compared to their share. And the other case is the progressive financing. To conclude on the model, I'm going to assume a real interest rate rule that specifies the nominal interest rate as a function of expected inflation and output deviations to the power of phi. So you can think of phi as a degree of hawkishness of monetary policy. The higher phi is, the more aggressive central banks are going to fight against output deviations. The lower the value of phi is, the more dovish the economy is. Okay.
Just to clarify, the only source of business cycles here is the G-shocks?
Yes, in the simplistic model. Okay, so now you have to think of this is a full endogenous growth model. Okay, so I have an endogenous balanced growth path. So hence what I need to do is I need to detrend that model by the stationary balanced growth path level. So my solution concept is going to be a stationary balanced growth path equilibrium. What I then do in the second step is I follow the standard DSG kind of new Keynesian textbook rules. Okay, so I'm going to log linearize that economy. And what I obtain here is that it's going to summarize all of my equilibrium dynamics in 4 equations. So I'm going to have a DIS equation, I'm going to have an endogenous growth equation, I'm going to have a new Keynesian Phillips curve, and this Taylor type rule. So you can think of this 4 equation representation as a generalization. I'm going to extend the standard 3 equation model from the Henk literature by endogenous growth, or you can think of it, I'm going to extend the 4 equation model from the endogenous growth side by household heterogeneity and a lot of more whistles and bells, okay? So I'm not going to press any of those buttons because those equations look a bit heavy, but for those who are interested, they're in the paper. Okay, before I proceed to the main theoretical result, let me briefly define the output multiplier mu y. So that's going to be the output response to a government spending shock, and my technology growth multiplier is mu g. Okay, so let me go to the main theoretical result of this paper. And that main proposition is about the sign of both impact output multipliers of output and technology growth. So on the output multiplier, I'm going to find that regardless of monetary policy, the sign of the output multiplier depends on a cutoff of the tax splitting rule with respect to a certain cutoff tau y. Okay, so only if tau is sufficiently small, that means only if the tax allocation is sufficiently progressive, output can go up in the short run. On technology multiplier, I have a case distinction. That means whenever monetary policy is sufficiently hawkish, my technology growth multiplier is always negative. In contrast, when monetary policy is sufficiently dovish, I again obtain a tax splitting cutoff tau g now that is smaller than tau y. Okay, that means monetary fiscal policy now needs to be even more progressive to also increase technology growth. So what you can see from this proposition, let me just summarize and then I go to the intuitions, is that what's really key to think about the short run and the long run response is the joint design of fiscal and monetary policy. So I'm going to have labor unions. Okay, so there is no endogenous labor supply, it's sticky wages. So my households are going to supply whatever demand is asked by the labor unions. What I did not show you is in the paper we work with the incidence functions, a la Patterson and so on and so forth. I did not show that here, but those results can be extended to those things. Okay, so let me give you intuitions on those 3 regimes, and then let me do this in a plot. So on the x-axis, I'm going to have my tax incidence tau. On the y-axis, I'm going to have the degree of systematic monetary policy. So first, there is this cutoff phi y. Above this cutoff, I have sufficiently hawkish monetary policy. Below this cutoff, sufficiently dovish monetary policy. If tau is larger than lambda, as I have explained before, I'm in the regressive financing scheme. If tau is smaller than lambda, I'm in the progressive financing scheme. I need to ensure a certain minimum level of phi to have a locally determinate and stable equilibrium. Then I have my first regime. In that first regime, that's essentially just combining the theoretical cases of my proposition. I find that output is negative and all technology growth is negative. So this stimulus package is bad in the short run and also in the long run. What's the intuition for this? In this regime, a huge part of the tax burden falls on hand-to-mouth households. So essentially, government spending goes up, aggregate demand goes up, but at the same time, my private households are going to cut their consumption one-to-one. Okay? But then there's a second effect, which is my entrepreneurial households are going to internalize in their portfolio allocation decision that, well, when the tax burden falls on hand-to-mouth households, then if I need to self-insure myself against transitioning to that state. So hence, they're going to cut the innovative asset, and that leads to a permanent decline in technology growth and innovation and long-run growth at the same time. In the second regime, in the bottom left, well, I find exactly the opposite. Short-run output goes up and long-run innovation also goes up. Here, the reasoning is exactly the opposite. So now the financing is done by my entrepreneurial households. That means an increase in government spending crowds in aggregate demand that redistributes implicitly resources to hand-to-mouth households that additionally increase their consumption, and aggregate demand goes up further. And on top of that, now the self-insurance effect is just mooted, because here my entrepreneurial households are going to have all of the tax burden. That means they're kind of happy to transit to the hand-to-mouth state. Hence, they're going to invest even more into the innovative illiquid asset. And then finally, there's going to be an intermediate regime where short-run output goes up and technology growth goes down. Okay. So what's unique with this intermediate regime? Well, that regime implies in the short run I have benefits, in the long run I have costs. So that means my tax finance fiscal stimulus program is good above a certain time, before a certain time horizon set, and it's going to be contractionary after a certain time horizon set start. Okay, so I really have a regime where I have a trade-off in terms of the output level in the short and in the long run. So the question now is, which of those three stabilization regimes is quantitatively relevant? And this is what we're going to address in the second part of the paper. Okay, so here we're going to extend that analytical model by some further degrees of realism. Yes, there's a question.
Why doesn't the boundary of that region depend on monetary policy? So whether law I is, as long as tau is greater than the tau y, then that is.
Why does?
Why does the
Good
regressive
regressive
trend not depend on the monetary policy parameter?
So what the monetary policy parameter does is essentially it controls the market size effect. Okay, so once you're in a regressive regime, you're already cutting a lot of the market size effect by construction, okay? Because hand-to-mouth households, they cut consumption so much. So in that sense, monetary policy is inefficient. You already have weak aggregate demand. So if you change monetary policy, that's not going to do the job. This is why this regime is independent of this.
That's direct impact of fiscal policy is actually negative.
Yeah. Okay. Quantitative model, we're going to enrich that model by some more realistic layers. We're going to have discount factor heterogeneity, labor productivity, employment status, earnings incidences, entrepreneurial type, and innovation risk. And what we're studying is a typical US finance government spending shock as our policy. So here we're going to have now distortionary tax and transfer schedules and the standard Taylor rule. And the financing is going to rely both on higher income tax progressivity and also higher public debt now. In terms of calibration, we have some short-run moments that we want to target and also some long-run moments. On the short-run moments, we want to get right the labor market exposure, the distribution of the propensities to consume, and the NKPC slope. In the long run, what's really important for us is to get right the income and wealth distribution. Then our key parameter is going to be the tax innovation elasticity. And here we're going to build on Stephanie's work to get that.
G-shock is contractionary? Or negative G-shock is contractionary?
Yeah, positive G-shock is going to be expansionary. I mean, it can be contractionary according to those three regimes. I'm going to show you now in which regime we are. Okay, so what are the numbers? In our heterogeneous age and Euclidean growth model, we are going to find a short-run multiplier of 1.07. That means the government spending shock is going to be expansionary, and the progressive financing is extremely effective in the short run. However, my technology growth multiplier is negative. That means progressive financing is ineffective in the long run. That means I get sizable permanent output losses in that economy from that financing of roughly minus 0.12%. And that also means that the switch time is roughly about 8 quarters, okay? So before 8 quarters, that government spending shock is expansionary. After 8 quarters, it's going to be contractionary. So what we're going to do then is, well, we do a lot of robustness and kind of a meta-analysis around all of our parameters and NKPC slope and so on and so forth. And what we're going to find is that this short versus long-run stabilization regime is essentially pretty robust. So that trade-off usually occurs in between 6 to 18 quarters. In the next part, then, we're going to ask, well, which tax design can avoid that stabilization trade-off and improves welfare, please?
The shock is always an equity shock.
Yes. And here what we're doing is essentially we work with an HSV type of tax schedule, okay? And we're going to use a Gaussian perturbation. That means we're going to allow that tax schedule to target particular income quantiles, okay? And we're then going to compute utilitarian consumption equivalent variation as a function of this tax incidence, and we're going to look on which income decile should the tax incidence fall to maximize welfare. And what we're going to get is this plot, okay? So that's an inverted U shape. And the welfare is maximum around a quantile of roughly 0.7, okay? So you can really interpret that inverted U shape essentially as a composition of our framework. So on the bottom, on the top arm, essentially, I have the endogenous growth part that is really working. So here, whenever I put the tax incidence there, innovation goes down. On the bottom part, I really have my short-run aggregate demand hang type of mechanism that is active. And those two forces are going to offset each other, and this is going to generate the inverted U shape. So if I compare now the multipliers from the optimal tax incidence with the one that has been implemented from the data, which I call the typical tax incidence, then I can see three things. Number one, the short-run multiplier is larger. Number two, the technology growth multiplier is positive, so I'm avoiding this trade-off. There are positive long-run output gains now. There is no switch time, and I roughly increase welfare by 60 to 70%. Okay. The final question is, well, who benefits from this new tax design relative to the existing one? What I'm doing here is on the x-axis, I'm plotting again my income deciles. On the y-axis, I have my consumption equivalent welfare variation. And I'm going to see here that, well, essentially all of the households are benefiting from it, okay? So here it's a U-shape here. That means the high income households benefit equally much than the poor income households, and the middle class households benefit a little bit less. What you can also do is that you can essentially decompose those short-run gains, those welfare gains into short-run gains and long-run gains. The short-run gains is the blue shaded parts of the bars, and the long-run ones, the gray shaded ones. And you can see that most of the welfare gains essentially really come from the reverse response of innovation, okay? So that's really key in this model. So let me conclude. So what did we do in this paper? We are studying tax finance fiscal stimulus programs in a novel heterogeneous age and Keynesian growth economy. We showed analytically that there are three regimes with potentially opposing short and long run effects, that a joint design of tax incidence and systematic monetary policy is really key to characterize all of those three regimes. In the second part of the paper, we then documented that this short versus long run stabilization trade-off is a key and robust feature of that economy. The fiscal multiplier in the short run was in between 0.95 and 1.3, and the long run losses were sizable, in between 0.1% and 0.25%. Remember, it's a 1% government spending shock, so those numbers are not small. In terms of the policy sign, we show that a tax burden on the middle class household is going to avoid this trade-off and is going to be in a Pareto improvement. And then for the next steps, I mean, with that framework, many things can be done. We can think about optimal automatic stabilizers, go more to the data, get local projections done, think of Ramsey type of policies in that framework. So I think the door is open to many future things. Thanks so much for your time and your attention.
Thanks a lot. The discussion is Thomas.
Okay, thank you very much for having me in the program to discuss this amazing paper by Philip and co-author, where I think it was a job market paper of Philip, so it's about inequality. I mean, you saw the first presentation. I'm gonna go very quickly on the summary, where this paper analyzes the trade-off of tax finance fiscal expansion, and the trade-off is between short-run stabilization and long-run growth. And this comes from the observation that most of the spending shocks in the US have been financed by tax progressivity, at least until a couple of years ago. And then there's two opposing views in the literature that has been very well described. Then in the Hank literature, in the New Keynesian literature, you want to tax the top earners that have typically low MPC, so you're not going to affect too much the aggregate demand, and you're focusing on the one who have high MPC, like the poor household, to be able to get fiscal multiplier to be above than 1. In the second view is that you use innovation and growth that could be dampened by this taxation, in particular because of crowding out effect of investment, and that would cause weaker growth in the long run. And so here the contribution in this paper is to unite and provide a general framework. And so it's kind of a tour de force in my sense to, go from 3 equation New Keynesian model, but on top of that, like we do the three equation that's been in the literature, 3 equation Hank model, but on top of that, like a 4 equation Hank plus growth model that has these 3 components together. And those 4 equations, you learn a lot from diving into that. And so here in the theoretical framework, in the toy model, you see that there's 2 opposing forces, and the first is that when you're doing a fiscal expansion, this high MPC household increase aggregate demand, and so you have this market size effect that Philip described, that like investor want to see disaggregate demand increase the return of innovation, and potentially that's going to increase their incentive to invest and to potentially increase long run growth. But on the contrary, when you're taxing the rich entrepreneur too much, you can potentially crowd out innovation. And which one of those two forces dominates will be depending on two parameters. In the toy model is very clear. That depends on the monetary policy reaction. And that's kind of something that's very common in literature, like the strengths and the aggressiveness of the policy, the monetary policy, and the path of interest rate will be key here. But also in this Hank model, when you have heterogeneity in marginal propensity to consume, the tax incidence will also be key. And so here is going to uncover three regimes. So you saw the picture before, but then in the case where the monetary policy is not reactive that much and the fiscal policy is very progressive, you're in a win-win situation. You're increasing the fiscal policy, you're increasing the crowding in investment, and you're both stabilizing, increasing output in the short run, and you're promoting growth in the long run. In the contrary, in the third case here, the third bullet point, you're in a lose-lose situation when the monetary policy is very hawkish and you're doing the regressive policy. And the case that's interesting is going to be policy of empirically relevant is the trade-off case, the case where you're doing a short-run policy that's positive in the short run but negative in the long run. And so it's going to extend a model with very many bells and whistles, matching the MPC heterogeneity, having this innovation tax elasticity that comes from this literature on growth and innovation, and match many moments. And so he's showing that we are in exactly the trade-off regime that we talked about, where the short-run policy is positive, but in the long-run growth is going to be negative, and the fiscal multiplier on long-run growth is negative. And you just need to wait 8 quarters, which is not much, to get this positive effect. And after that, you're losing. But you still have this consumption equivalent variation that's going to have positive welfare effect because you're putting a lot of weight on the poor household. And so the welfare gains of those poor households are very positive. And so that's a result that's going to be robust to many different variations, and I'm going to propose, I'm going to suggest more exercises to do. You should not do all of them, but because you already did a lot, and there's so many appendices that I didn't read. Because it's a very long paper, so there's definitely some stuff that I missed. But the very important part, and I think that's very also important in that framework, is that he's doing the welfare maximizing policy that in a class of progressive taxation functions, he's going to choose the one that's maximizing both the short-run effect and the long-run effect. And so that's a Pareto improvement across the wealth distribution, which is very interesting and very novel. Okay, so I'm going to go quickly on what's the trade-off here and diving a little bit more on the innovation part, which I think if you had to modify or do maybe more robustness checks, could be to dive into this innovation literature and this growth literature, because here the model is a little bit simple in the sense that here growth depends just on this investment that this one agent is investing. And if you have crowding out of government spending, that's going to reduce investment and reduce growth. In the toy model, that's very simple, and I think that's clean and very nice, so you should keep it like that. But in the quantitative model, you basically have the same thing, and then it's a little bit too simple according to many papers in the innovation literature, and here also most of the heavy lifting is done by this one parameter. I mean, in part, for that part at least, is done by that one parameter that's calibrated by this paper by Stephanie and co-authors, where he's doing a robustness check. So when you change this elasticity of patent or innovation to the change in the tax rate, the top tax rate, you can potentially, if you make it lower, so people are not reacting to taxes and they're still innovating, you can potentially get a positive effect. When you put this reaction function to be higher, you get a much larger negative effect. And so, and here this parameter is estimated with a permanent tax change. That's what this paper is based on. I didn't dive in too many of the appendices of that other paper neither, but here you can think of a permanent tax change, but the paper we are talking about is experimenting with transitory tax changes. And I think that could be something that could be looked upon and be changed, or maybe thinking a little bit about that in a more robust case. And there's three other things. I'm going to go quickly on that. You can think about government spending here. That typically this expansion, they arise in a recession. You want to sustain aggregate demand in recessions. And here, I think that's the case, one of the questions you had before. Here, most of the business cycle is coming from this government spending shocks. And you could think of a case where you're already in a recession. This government spending shock can potentially crowd in investments and potentially not have this detrimental effect for growth. And so that's something that's I think very easy to do in this framework. The government budget, I think there's a lot of stuff that's been done there. You could think of an active fiscal policy instead of a passive one. You could think of to resolve the trade-off, to go in the other direction of the trade-off. Suppose instead of using that government spending just on goods, you can just use a little bit of that money and give R&D subsidy. Potentially, you would change the growth effect, and that's something that would completely change the direct. That would have a direct effect, and there's a lot of evidence in the literature. That's the end of the sentence here. And this growth literature has basically, if I had to summarize the whole endogenous growth literature, you could think of innovation coming from firm entry or incumbent firm doing R&D, increasing innovation, and that's going to change TFP growth. And taxation would come in two places, both on the entrepreneurship case or the financing of this incumbent and this growing firms. This large, I made a big literature review just to cover all of this, and there's some of those papers, but I'm going to stop here. That would be maybe worth to thinking about what are the different channels instead of that one equation, but having something a bit richer. Okay, thank you very much. Sorry for going over time.
All right, you first want to respond briefly and then.
Okay, thank you, Thomas, can you hear me? For that great discussion. So I briefly want to comment on 3 points. The first one was your disconnect between the analytical model and the quantitative model in terms of the innovation process. So I agree that we are certainly not having the most involved or evolved innovation process in the analytical model. The key difference for now is that we're kind of having a version of constant returns to scale in the analytical model and a version of decreasing returns to scale in the quantitative model. We could easily extend it to the decreasing returns to scale in the analytical model as well. That's done in the online appendix by Benino Fornaro, for instance. And we can do a robustness on the regime changes. I totally take that. On your second point on the elasticity or the sensitivity of the innovation elasticity, yes, we take it from Stephanie's paper so far. What we could do is a more kind of a Monte Carlo analysis. So we are looping over all of the parameter changes together instead of one parameter at a time. And then we could see kind of what's the likelihood of those 3 different regimes across all of those Monte Carlo experiments. I do want to emphasize one thing. There is also this evidence on the business cycle frequency. Think about the Cloyne paper who uses local projections of temporary variations in taxation on innovation, patenting, and so on and so forth. And then your point about the R&D subsidy, that's a point also Xavier has raised before. And the state dependence, yes, I totally agree. And I briefly have to disappoint you because, I mean, I said to you, we only have 3 regimes. In fact, there are 4 regimes. And the reason why we only have 3 regimes here is that I restricted my tax incidence to be interior between 0 and 1. So the assumption is that every of my household types bears at least weekly positively some financing burden of the government spending shock. Now I could relax that and I could have tau negative or tau larger than 1. So if tau is larger than 1, that means all of the tax burden goes to hand-to-mouth households. And on top of that, I pay a subsidy to my entrepreneurs. And in that case, I obtain this 4th regime, which is technology growth goes up, short-term output goes down. So I have the reversed trade-off regime. So it's very bad in the short run and it's good in the long run. Okay. So that's perhaps the way how I can think of the subsidies, at least in the analytical model. Then I agree in the more quantitative model, things would likely change. Okay, yes, and all the other points, all the robustness, active, passive monetary policy, well taken. I think many things can be done in this framework, as I said before. Thank you, Tuma.
Just have a couple of comments. I was a little confused by the title. The current understanding in the policy circles is that if you provide stability, that promotes growth because it's going to moderate the long-run interest rates and lower the cost of capital. And when you look across countries, stable economies have lower costs of capital. And when you look at countries like Argentina and Turkey, they have higher borrowing costs. And so I'm not sure how relevant the trade-off is in practice. And I'm wondering if that has something to do with the assumption that the government budget balance is satisfied in each period, because the current practice of stimulus policies is you run deficits now and then you borrow from the future and you kind of worry about the tax incidence later. So those are the elements that I think are missing here, and I'm wondering how robust your conclusions are to those assumptions.
So I have to briefly clarify a point that was a bit short during the presentation. So yes, in the analytical model where I spent most of the time, it's budget balance in every period. So it's only the tax incidence that's going to adjust. In the quantitative model, essentially, we take the fiscal adjustments from the data. So we're going to have a part that adjusts through public debt. That's roughly 50%. We're going to have the other part that adjusts through higher income tax progressivity and then through the average level of taxes. And those responses are consistent. They have been empirically estimated in the data. So we're going to plug that into. And in that version of the model where we take into account the public debt, the crowding out effects, and so on and so forth, we robustly find the short versus long run stabilization trade-off. So now how relevant is this in practice? For now, we find it's extremely relevant across all of our different model alternatives that we have used, calibrated, and simulated. As I said before, what we could do much more is kind of going to a Monte Carlo analysis, or we could really go to the data and kind of do a version of state-dependent local projections. So you take a government spending shock, you condition on high progressivity or low progressivity regimes. That's done, for instance, in the paper by Axel Ferrier and Gaston Navarro. Why we did not do it for now here? Because it's kind of a double state dependence. So remember, our two key policy parameters is really systematic monetary policy and tax incidence at the same time. And if we then go across the US history and we really do kind of this double classification, we are losing a lot of regimes and a lot of identification power. So this is why we're leaning more towards a Monte Carlo type of exercise for now to answer that question.
Can you maybe briefly comment on what identifies that trade-off in the data? Like what aspect of the data that gives you that trade-off?
So here, what is really key, and this is the way how it is calibrated in the model, is on the short run, we have this aggregate demand expansion. That's essentially the distribution of the MPCs and the earnings exposure to the business cycle. How strong is this market size effect? Because that's good in the short run. It can be good in the long run if the market size effect is so strong that the innovative returns are going to rise. On the other hand, what we have is higher income tax progressivity lowers the ex post returns to innovation. That's going to drive down innovation activities and going to lower growth. So you have a horse race between those two forces, right? And we really find that quantitatively the horse race is on the side where the distortions on the innovation part are too strong and the market size expansions are too weak to overcome that.
Thanks. Great paper. Simple question. You are shocking an economy which is not kind of the fiscal system is not even optimal in a sense without the shock. So the shock maybe brings you to a better steady state fiscal system, transitory, and then you lose this part. And we know it's a big problem because when you are shocking, you cancel first order inefficiencies in your economy. Would it be possible to first have an idea of what would be the steady state stationary good first best optimal fiscal system, and then you shock around it to have really the transitory effect of your financing? Because otherwise here you are capturing a steady state distortion, which we would like to understand first before shocking this economy.
I fully agree with you, Xavier. In the quantitative model, we have this idiosyncratic entrepreneurial risk, right? That's pretty similar to an Anceletov type of risk, so that leads to underinvestment usually. So clearly the steady state or the stationary equilibrium is inefficient, and part of the welfare gains are precisely coming from this because the government spending shock is correcting for this. In the analytical model, we have started to work on this. So we can have corporate tax or subsidy to correct for this, and then we can do a second order welfare approximation. And, in the spirit of this rank literature, what we're going to find is 4 terms in the welfare function: productivity gaps, output gaps, inflation gaps, and inequality in redistribution. And we can make that system before complete, and then we could do optimal stuff in that. That is the way I would think about it. Yeah.
Question, in the you said that in the calibration, you target the average tax innovation elasticity, but I'm curious, what does your model imply for the heterogeneity of this elasticity? So specifically the difference between star inventors and like regular inventors, if you can also replicate the gradient in the data, from the data.
So we haven't done that. What we did is the 90 percentile exercise that was one of the appendices of Stephanie's paper. What I want to emphasize here is only 10% of the economy are entrepreneurs. 5% of them choose to be active innovators. Okay, so some of them have the entrepreneurial status, but because of being financially constrained or having high enough precautionary income risk, they're not going to be active innovators. Okay, so I really think in the model it's only 5% who are active. So I do think that, you know, this just looking at the top 90 for now is not a bad first order pass, but definitely we could compute it and check the robustness.
Last, maybe it's just a remark in terms of framing. I mean, the simple model, the tax is not really about progressivity at all. It's about taxing workers versus entrepreneurs, right? And even in the quantitative model, what you don't want to tax, you don't want to tax high MPC people because of the short run, and you don't want to tax entrepreneurs because of innovation. And that's the only people that are left are sort of the people in the middle because they have low MPCs and they're not entrepreneurs. Isn't that sort of the right way to interpret the results? And then it just so happens that if you go to the data, it just happens that the middle class has low MPCs and are not entrepreneurs, and that's how you translate it then into tax progressivity. But fundamentally, it's don't tax high MPC people and don't tax entrepreneurs. Isn't that the robust sort of public finance insight?
Okay, so two things on that. On the analytical model, that terminology of progressive versus regressive is borrowed from the literature. So it's really which fraction, it's a bimodal distribution. So if the upper part is having a higher tax burden, so I would call that progressive. If the lower part is having a higher tax burden, then I would call that regressive. So that's the terminology used in this literature. Then I fully agree with you that inverted U shape is essentially coming from the trade-offs you said. I do want to emphasize one thing again. Ex ante, it's ambiguous. I showed you the regime where progressive redistribution of financing and an extremely dovish monetary policy will expand aggregate demand so much that the market size effect is going to crowd in innovation, even though I have lower ex post innovative returns from the pure tax distortion. Okay, so it's not like that. I understand, like, you know, we have those two arms, the inverted U shape comes there, but it could have been quantitatively different. And the main job of the quantitative model is to really put a number on this and whether we are really in this intermediate regime or whether we are in this, you know, progressive sunshine today, sunshine tomorrow regime, and we are not, unfortunately.
Okay, thanks a lot. Let's move to the second paper of the session. Thanks a lot. Paper's about a lost decade of fiscal misallocation. All yours, 25 minutes.
Okay, thank you very much. First of all, I would like to thank the organizers for giving me a chance to present our paper, A Lost Decade of Fiscal Misallocation. I'm Ippei Fujiwara at the Keio University and the University of Tokyo. And this is the joint paper with Kosuke Aoki and Michael Son and Michael's two PhD students, Zheng Helin and Chendo Won. It's a pleasure to work with them because they are really nice people. It's always nice to work with the nice people. Yeah. Okay, so today, as the title implies, you know, this is about the Japan's lost decade. Some of you may know that the Japan enjoyed a rather high growth, 4% GDP growth between 1970 to 1990. But in the 1990s, GDP growth rate became lower at around 0.8%, from 4% to 0.8%. So the people talked this phenomenon as the lost decade. But actually, this low growth continued for another 10 years. So some people say it's like a lost 2 decades. And this low growth continued for another 10 years. And some people say it's like a lost 3 decades, or to be honest, I don't know whether we have lost anything or not. But okay, today's focus is the lost decade. So about 10 years after the burst of the bubble economy. In the lost decades, decline in interest rate increased the government of fiscal space, And this increased the fiscal space induced the spatial misallocation of government investment. We're gonna show this with the data, and we're gonna show this with the simple model to show how misallocation did happen. And we use a quantitative model and conduct a counterfactual simulation to show what if the government did not increase the fiscal space. That's what we are going to do in this presentation. Okay, let me start with the data. Okay, this figure shows the government to private investment ratio. In the figures in this presentation, oh, there's no shaded area. Oh, somehow I can see this. It's a shaded area here. Okay, shaded area here. So it's corresponding to the lost decades. You can clearly see the significant increase the government to private investment ratios. And the next figure, again, I cannot see the shaded area. So please imagine the shaded area. Okay, so this shows it compares the rate of return of the government investment and the private investment. Red line shows the rate of return of the government investment, and the blue dashed line shows the rate of return from the private capital. And the rate of return from the private capital has been consistently higher than that of the government investment. These two figures already talks about the macro level misallocation. During the last decades, investment went to the government capital, so whose rate of return is lower. But this macro level misallocation is not so surprising, because it is coming from due to the counter-cyclical fiscal policy. So what we focus in our paper is spatial misallocation of the government investment. These figures shows in the horizontal axis is the rate of return from the government capital. Vertical axis shows the investment over the government investment over the government capital. So it's an investment rate. So in the left panel, this is about the 10 years before the lost decades. We can't observe any significant relationship between the rate of return and the investment rate. In the middle panel shows the lost decades. We can observe the clear negative relationship between the rate of return and investment. So this tells, government investment went to the region where rate of return is lower. This shows the significant misallocation. And a misallocation, such a spatial misallocation, disappear in the 10 years after the lost decade.
Is it the case that even a flat line suggests misallocation in the sense that?
Yeah, it still has a misallocation. It should be positive. It should be positive.
So in a way, the misallocation has gotten worse in the loss.
That's right. There should be some misallocation. It should be positive. Positive. So indeed, you are right. Focus is why this slope significantly negative. That's the main part of our paper. And this is a regression result between investment rate and the rate of return. You can clearly see the significant negative relationship between investment and the rate of return in the lost decade. We can't find any significant result in other decades. Then we need to think about what could be the potential cause behind the spatial misallocation. Then we think it's coming from the declining interest rate. Left panel shows the nominal interest rate, and the red line shows the short-term interest rate, like a policy interest rate. And the blue dashed line shows the government bond, the 10 years bond yield. And the light panel shows the real interest rate. So you can see from all the four lines, we observe, again, please imagine the shaded area of the lost decade. And you can see the clear, significant decline in interest rate in the lost decade. And as a result, of course, this is not the sole reason, but the government debt GDP ratio increased massively in the lost decades. In a flow measure, government borrowing over GDP ratio also increased massively in the lost decades. And if we decompose the government budget constrained by decades, left-hand side shows the expenditure. CZ is the government consumption, IG is the government investment, and 5G is the government residual spending. Right-hand side shows the revenue. NB is the government non-borrowing income, B is the government borrowing, RD is the interest repayment. This must be subtracted. And if you look at the table, in the last decades from 1993 to 2002, there was a significant increase in the borrowing. Even though the borrowing increased significantly, you can see at the left column, interest repayment didn't increase. Okay, so what we do in this paper and what we'd like to show in this paper is low interest rate relax the government borrowing constraint, which leads to easy borrowing. And we offer a simple model to show fiscal cost of easy borrowing. So that is more resource, more misallocation. And because there's a time limitation, so that I'm gonna briefly explain a quantitative result. With the quantitative result, we're gonna show relax the government budget largely explain the deterioration is fiscal allocation during the last decades. And consuming the extra borrowing revenue, then aggregate TFP increases by 0.43% and welfare by 1.51%. That's a roadmap of my presentation. Okay, then let me talk about the simple political economic model of spatial government investment. This is really a simple model. This is embarrassingly simple model compared to the models presented so far. And this is the two-period model with exogenous government borrowing limit. And through this simple model, we would like to explain a fiscal cost. Okay, so regarding environment, we have N regions or N prefectures, and the production function for each region I is in a decreasing return to scale functions. And the regional government capital, GI, I denotes the region, is allocated in the first period, and the production takes place in the second period. The representative household preference is a very much standard one, and U satisfies the another condition. And the resource constraint is also very standard one. Left-hand side is expenditure, and the right-hand side is the income. And the W is exogenous initial wealth. And here in this model, R is exogenous. R denotes the exogenous interest rate. We are assuming a small open economy. Okay, then let me talk about the first best allocation. First best allocation is choosing C1, C2, and the GI to maximize household utility or welfare subject to the resource constraint. Then we got the first order condition with respect to government investment. Then we get the return from the government investment must be equal to the exogenous interest rate. Then aggregate TFP is maximized by equating the rate of return across regions. It's a simple result. Then we get another first order condition. First order condition with respect to consumptions is a standard Euler equation. This is the first best solution. And these are not so exciting at all. Then we're gonna incorporate the political economy in this model. So government chooses debt and the government investment to maximize this government objectives. Government objective is the sum of household welfare plus political incentive. That is denoted by blue some kind of the variables. And this V is a standard concave increasing function. And a kappa I denotes the local lobbying capacity, whose importance has been emphasized by the studies on Japan, for example, Sato and Ihori. In particular, according to the Ihori's study, he connected this local lobbying capacity to the ruling party's presence and the local interested group. And the government budget constraints are again, very standard, but in the first period, government borrow, D. In the second period, government needs to repay the debt and the interest rate. And government is constrained by the maximum debt level, D bar. So there's a borrowing constraint to the government. Then we get the new first order conditions, and we get the modified consumption Euler equation. So the consumption Euler equation now involves lambda, that is the shadow value of the borrowing constraint. And we have another first order condition with the government investment, but we have kappa terms. This is the distortion from the government objectives. So these two are the lambda and the kappas are new addition to the first order condition under the efficient allocations. Then let me talk about the two distortions. We have two distortions in this economy. So one is the intertemporal distortions, which comes from the first order condition with respect to the debt. So this equation tells, due to the borrowing constraint, the lambda is positive, C1 consumption at the first period inefficiently low. So the marginal utility is really high. That is the shadow value of the first period resources becomes higher. Then we have an intratemporal distortion, which comes from the first order condition with respect to the government investment. And you can see if the left-hand side is 1, it's efficient. But left-hand side can be larger than 1 and lower than 1. So this creates the aggregate distortion. Depending on the tension between the denominator and the numerator, there might be too much or too little aggregate government investment. But also, our focus, there is a spatial distortions because kappa I, local lobbying capacity, is not aligned with the technology in the region R. So as a result, rate of return from the government investment is not equalized. Okay, so these are the summary of the distortion. Then let me talk a little bit about these conditions from a different angle. If we don't have no political incentive, that is corresponding to the case kappa I for all I equal to 0, then we get the first order condition. If this term is 0, we get the efficient. But if the borrowing constraint is binding, then we end up with the underinvestment due to the borrowing constraint. When the borrowing constraint is slack, that is lambda equals 0, we can rewrite a condition like this. Then, because this is a positive, return tend to be higher, so we end up with overinvestment. Then as long as we have a kappa term, which is not aligned with the technology at the region, then we have a misallocation due to political incentives. And we can transform these two first order conditions into the capital wedge. So this is the equation. Then these are the capital wedge. And the second term is the local lobbying capacity. This leads to the overinvestment. And the third term is the borrowing constraint. This leads to the underinvestment. Okay, so now this is the main slide of our presentation. So therefore, it's so crowded. So sorry about that. So let me now talk about the fiscal resource cost. So I changed the first order condition for the government investment slightly, just dividing everything by U prime C1. Okay, that's what I have done. Okay, then first order condition with respect to G1 is represented by especially for the right-hand side, some of the return motive, which is efficient, and political motive, which is inefficient. Okay, so let me explain now about the fiscal resource cost. For that, let me define W under bar. This is the lower bound of initial wealth ensuring an interior equilibrium. So as wealth decreases to the lower bound, then we get the result. Government investment converges to the efficiently driven allocation rule. That is, the government investment in each region is proportional to the technology level in each region. So let me explain the mechanism behind that. Because you borrow the first period, you need to repay the debt. So there's a debt obligations, which is expressed by the 1 plus RD bar. So we need to have positive output in the second period. So G must be positive. So then if we look at the second term, even as C1 is getting a smaller and smaller and smaller, G1, there's a limit. So this term disappears. As wealth is getting smaller and smaller, and our budget is getting smaller and smaller, this term disappears and it ends up with efficient allocation. Okay, then On the other hand, if the wealth is bigger, or if you are rich and if you are abundant, if you are rich in resources, then you have spent your money so not so productive stuffs. And if the wealth is increasing, then government investment allocation to converges to the politically driven allocation, which is purely pinned down by the lobbying properties. So mechanism is as follows. If the wealth increases, marginal utility of consumption declines, so the second term is bigger. Then in a region where political lobbying activity is very high, this second term becomes larger. So that means the rate of return in that region must be smaller. So that means those regions must have a more government investment. So which leads to the spatial misallocation. The larger GI, the lower RI. So high kappa I regions, so that is high local lobbying capacity regions receive more government investment until their marginal productivity falls, then which leads to the politically driven allocation. So we can talk this mechanism in another way, so that debt service acts as a subsistence level. The allocation is non-homothetic in a fiscal space, and a politically driven investment is like a luxury goods. So let me explain this. So from the second line, this 1 plus RD bar is an inelastic obligation payable only from output. So that's like a subsistence level inside the constraint. So here comes the hierarchy of the claims. Then a consumption, then a politics. Then we have something like a stone geary structure. Debt service works like a subsistence level. Resources first meet the obligation, and only the surplus is allocated by preferences. Then a political investment becomes a luxury good. But unlike the textbook stone geary, the committed bundle is endogenous. It's not just a choice. And bundle is endogenous. It solves the cost minimization problem. So in order to produce debt obligation with minimum resources, then its composition becomes efficient. Yep. Okay, then in proposition 1 in our paper, we summarized these findings. Then what is the implication from the proposition 1 is if we assume initial wealth plus the debt limit is larger than the government investment on the first best, and the local lobbying capacity is sufficiently large, we have over-investment of the government investment relative to the first best solutions. Then we have spatial misallocations. So that if the wealth increases, shadow price goes down, allocation tilts from the technology-driven to politically driven. So dispersion of the rate of return of the government capital increases, then aggregate TFP goes down. Then this is we talked about the story, how the increase in the wealth leads to the higher spatial misallocation. But we need to connect this story to the lower interest rate. So that is the fiscal cost of the easy borrowing. So let's assume an endogenous debt rule is like that. Then a binding borrowing constraint. We have a fiscal cost of easy borrowing. Aggregate TFP decreases monotonically with cut of interest rate. Then we have a proportion 2. We have a spatial misallocation. Lower interest rate, so sorry, this is not the W. Debt limit increases and the shadow price goes down. Allocation tilts from the technology driven to the politically driven. As a result, dispersion of the rate of return increases and the TFP goes down. And we also have in this economy overinvestment, and the gap between a G and its first level increases as the interest rate falls. I think so that I wanted to at least finish the simple model. So from now on, let me briefly talk about the quantitative exercises. This quantitative exercise is to show quantitatively that decline in interest rate caused the fiscal misallocation. So let me briefly talk about the sketch of the full-blown model. The central government at the T facing an exogenous probability of the political turnover and allocate the C government consumption and the debt and the government investment. We have an overlapping generation of the household choosing the region I at the birth. And we assume a small open economy with mobile private capital across regions and the regional specific and the time varying the political lobbying capacity and the capital wage and amenity calibrated to match the data for the government investment and the capital and the labor. And we assume MIT shocks. And the household preferences and household chooses these subject to the budget constraint. And farms are having a Cobb-Douglas production function and maximizing the profit. And fiscal institutions has similar objectives like a simple model. They try to maximize some of the household utility and the political incentives. Okay. Then these are the government budget constraint. We assume this type of the debt of fiscal rule. The reason is this kind of fiscal rule can track the data very well. So we assume this kind of the fiscal rule. Then regarding expectation, we assume a perfect foresight for the aggregate TFP, but the MIT shocks on the interest rate, because what we would like to know is how the surprise declining interest rate affect our result. And for the internal calibration, we calibrated the time varying parameters to match the data. Okay. Then first counterfactual simulation is that you may wonder the time variation is local lobbying capacity may explain everything. So we set the lost decades local lobbying capacity as an average between a decade before the lost decades and the decades before the lost decades. Then let's check the spatial misallocation figure. Again, a horizontal axis shows the rate of return from the government investment. Horizontal axis shows the investment rate. There's almost no changes. So this doesn't mitigate the misallocation problem. Then, in a second exercises, in the counterfactual simulation, we suppose the situation transferring the fiscal stimulus. Government commits to using a windfall perceived during the lost decade for consumption, while keeping the shadow price of the fiscal budget intact for the government investment. Then we get this result. Red line is what we have shown before. So there's a clear negative relationship. But if the government uses this fiscal resources to the government consumption, still remains a misallocation, but a negative slope disappears. Okay. So let me conclude. So the low interest rate induced misallocation is an understudied channel. And this study is complementary to the literature on low interest rate and the stagnations, such as zombie lending by Caballero, Hoshi, and Kashyap, and overvalued intangible asset, Kiyotaki and Zan, misallocation via financial frictions. And this paper has a potential fiscal misallocation and the welfare losses by debt swap and the low interest rate. Thank you very much.
All right, discussant is Chari.
Great. Where's the clicker? Ipe, did you walk off with the clicker? No, you didn't. I was wondering. Okay, so yeah. Okay, two things before I start. It's always fun to be in this group. And it's also fun because I've got to discuss this paper. So two things about it. First, this paper addresses, I think, one of the most important questions in economics, that lots of us should be working on. Second is it's actually lots of things to like about the paper. So I'm going to talk a little bit about things that I think the paper could improve on, but that shouldn't take away from the fact that this paper deals with an important question and has lots of interesting things to say about it. So what is this paper about? I was trying to think, what is this paper about? And then it finally occurred to me what this paper is about. This paper is about this picture. Say, what is this picture? So let me tell you what this picture is. This is a picture of a bridge. I think it's in Kyoto. I'm pretty sure it's in Kyoto. Anyway, this is a bridge. And where does the bridge end? It ends in a cliff. There's no tunnel, nothing. No tunnel was ever built on the other side of that bridge. This is the bridge to nowhere, one of many bridges to nowhere that was constructed in Japan in the 1990s. To me, it's an example of the disasters that Keynes has wrought, right? Because all the complaints were about insufficient aggregate demand, whatever those words mean, they mean something. And so therefore you had to do stuff like this, dig holes and bury them again, stuff like that, and build bridges, which just end at the cliffs. But so that's what this paper is about. So what happened in the 1990s? Why do I think that this topic is one of the most important ones that we as economists should be addressing? I'll show you some pictures on this. There was a fairly dramatic slowdown in growth rates in Japan starting in 91, 92 onwards. The Japanese government ran very large deficits. It spent like crazy on infrastructure, like the bridge to nowhere, primarily to protect local employment. But the hidden secret, those of us who know about Japan, IPEC will do this. Why did they do all this? They did it for a very simple reason. So the LDP, the Liberal Democratic Party in Japan, is a coalition of lots of interest groups. And that coalition was doing fine as long as the economy was going like that. In the 90s, it slowed down because they were able to redistribute to keep all the factions happy. And you've got to remember, these factions range from people who think that the Meiji Restoration was a bad idea back in 1860 to people who are close to being communists. So it's sort of a big coalition of people. You got to keep everybody happy. It was a huge problem. And the problem got worse because the economy wasn't growing. And so what do you do to keep all these guys happy? They found the perfect solution. They channeled a lot of money to construction companies who then returned a lot of that money. All right. So it was a complicated kind of thing. Over lunch, I'll tell you a joke about it, which goes back to India. It's almost a true story. But anyway, that's what was going on. They were spending like crazy to stay in power. Eventually, 20 years after that, this coalition broke up, but that's a different story. In any event, that's what's going on. And what is their contribution? I think this is a very important contribution. They document the government investment using Ali Pakis kinds of methods. They document that government investment was high in prefectures in Japan with low returns. They quantify the role of government investment, and they find that it reduces TFP by 0.43% and reduced welfare. I thought it was 0.31%. IPE had a slightly different number in his slides. So that's kind of what the paper is about, and I think a lot of the stuff is interesting. So let's start by thinking about what we should do. But before I do that, what do I think they should do? Not surprisingly, I'm going to suggest that they pursue a business cycle accounting-like approach. Formally, what they describe as misallocation is simply preferences in the model. I think the mapping between the model and the data needs a lot of work. And this is actually a plus for the paper. I'll show you the TFP in the data falls by about 17% relative to trend in the 1990s. And the contribution of their paper paradoxically is don't look at inefficient government investment, bridges nowhere as a big contribution to that TFP. It is, but it's fairly modest. So let me I'll come back to this. What are the things in the model that I don't like? And I have some suggestions about how to fix it. They have an exogenous interest rate in the model, and I'll suggest ways that they could perhaps improve their model. So let me get into our discussion. By the way, Connor Bayless, who's a great student at Minnesota, is going to be on the market in a couple of years. Everybody should hire him. Was sort of the main guy who thought of this discussion. I'm just relaying Connor's thoughts. All right. So a lot of this stuff is taken from a very, very important paper by Fumio Hayashi and Ed Prescott. And so this is a plot of GNP, that's what Ed like to use, per working age person, relative to trend. So what's trend? Trend is 2% a year. So you want to imagine that the economy is growing on average at 2% a year. Going back to 1945, I've done it and students of mine have done it. It grows substantially faster than 2%. And then in particular from the early 80s to early 90s, grows substantially faster than 2%. And then falls, GDP per capita or GNP, they're almost the same, falls by about 13%. Okay, falls by about 13%, which means that effectively in level terms, there's no growth. It is true that the labor input fell a lot, and that the capital output ratio grew. So it doesn't look, so the capital output ratio is growing, labor input is falling. What's the main thing? I should say something about government purchase investment. Government investment overall, which is the bottom line that you see over there, did rise, but not very much. So bottom line from Hayashi Prescott's analysis is, if I focus on the last row, you can see that the economy grew at about 0.5% a year. Effective TFP grew at 0.3%, substantially lower than in the post-war era. Capital intensity in the work week roughly offset, and capital intensity in the work week and employment roughly offset. And so therefore, the real puzzle for Hayashi Prescott is this versus that, 0.3%. Why did TFP stop growing? Can't be serious about that. All right. I'll briefly suggest papers that I think they should look at, which would help a lot. So Suparna Chakraborty was a student at Minnesota, a student of mine actually, who applied business cycle accounting, one of the first applications to Japan. And Keiichi Kobayashi also did. And their main findings were that the efficiency wedge, which is basically TFP, and the investment wedge are important. The labor wedge is not important. I think it would help to go back to that. Let me skip over their findings. I'll send these slides to Ipe so that he can get it. But let me tell you what their model is. Their model is basically at the prefecture level, you have a production function where government capital enters as an input. KI is private capital, LI is labor input at the level of the individual guy. And they have a two-period model, but even the dynamic model, that's basically what they have. They basically add government capital to the production function. And they want to call this a distortion. It could equivalently just be, because this is a public good, be thought of as the preferences of households. The Japanese people, for example, wanted to build a lot of capital. So what is really needed, and I think would help a lot, is if they can relate this kappa I to some of the numbers in Ihoro and others to say this is a credible way of capturing political factors rather than just a preference parameter that happens to fluctuate. I think that will add a lot to the paper. I don't think it's that difficult to do. And I think that will give the paper weight in terms of interpreting the political factors. The second thing is they assume an exogenous world interest rate, and that's sort of important in their model. I don't think they need to do it. And let me suggest what they ought to do. Why don't I like it? This is the Fed funds rate. I could plot other measures of interest rates. Yeah, it fell, but for a few years early on when the US was going through a recession, it doesn't really fall that much. It's very high. We know the Japanese interest rates fell. That by the 90s, by the way, are the birth of the carry trade, where you borrowed in Japan at low rates and lent abroad. So thinking about Japan as perfectly integrated with the world economy is probably a mistake. And so how can you generate a decline in the interest rate? What would be the natural way of doing it? The natural, simple way of doing it is think about this paper rather than a paper that says, oh, interest rates caused increased misallocation. Think of it rather as when TFP growth rates decline, naturally interest rates will fall. How much will that lead to increased misallocation? So think about it as this. I would like to see this paper rewritten as a multiplier paper rather than a reaction to the exogenous interest rate paper. But it deals with a very important topic and allows us to make some progress on it. The bottom line findings are that this source is not that important, but it's useful to have documented that. Okay, thank you very much.
All right, thanks a lot. You want to briefly respond?
Yeah. First of all, Charlie, thank you so much. And the last time I presented in front of you I was a graduate student. So I'm glad I can show something. Otherwise, I would have regretted what I have done for many years. But thank you so much. And yeah, you are indeed right. So that we need to have a more like a tangible empirical evidences for kappa J. So that there are several studies on Japan researching on the local lobbying capacity. So we need to maybe the kappa may be proportional to the number of the parliament member in the rural party or something. We need to do that. And you are absolutely right about the exogenous real interest rate assumption. So yeah, so because we are kind of assuming a small open economy, but definitely, it's not a fully integrated global economy. So maybe we need to incorporate how TFP affect the real interest rate, or maybe an overlapping generation to structure, so that maybe the people are saving for the future retirement, something. Definitely, that's what we should do for the next step. Thank you very much.
Is this on? Oh, good. So I have a paper that's joint with Hana Lustig and Yili Chen that looked at, it's called What About
Japan?
Yeah, okay. Yeah. So we're guilty of that. So, but if you look after, I'm going to get the facts slightly hazy, but after 2010, Japan, if you look at the consolidated balance sheet, does something absolutely wild. You said carry trade. They basically borrow one GDP's worth at very low interest rates using reserves and yield curve control. And then they go long one GDP in domestic and foreign equities. And the earnings on that is tremendous. And so one question for you is to think a little bit about, and maybe it's outside the range that you want to think about, is suddenly you have this other alternative of what to do with, the borrowing capacity of the government that is an interesting challenge to just spending it on the bridge to nowhere, and whether that shows up as pressure.
Yeah, thank you so much. But as you know that this paper is focused about the lost decade. 1990s, you are talking about there's so many changes after the lost decade and consolidation. Or now 2010, you are saying the government is like a investment banker, so that getting a cheap fund and getting more risky investment. So yeah, maybe we may be able to explain using this framework. I haven't thought about it, but definitely that's what, this is just for the lost decade, but this framework can be applied to other period. Thank you so much for your suggestions.
So it seems to be that one of the key moments for you is correlation between this regional return and region political lobby.
Right.
You didn't really show a lot about quantitative model, but can you tell us a bit more where does the discipline for that comes from?
So the data or?
No, in the quantitative model, you have to discipline that correlation somehow in a quantitative model. And where does it come from?
Okay, so right. So I showed the two counterfactual simulations. So one is we keep there's not that much time variation in local lobbying capacity, then it doesn't reduces the misallocation. The second one is we have an MIT shock. When you enter the loss decade, the government got a surprise lower interest rate. Then they have a surprise increase in fiscal capacity. Then in the model, in the baseline model, it was used to the government investment. But in the counterfactual simulation, we use it for the transfer to the consumption. Then negative correlation disappeared. And that's the second counterfactual simulation. It's a complicated stuff. I'm happy to talk with you over the lunch or something, if you are interested. Yeah.
Right.
Thanks a lot. At the risk of losing lunch, we should stop here. I should relay that lunch is in the Monteverdi restaurant, which is basically you go out, go past the NBER desk, and it's that restaurant. That's where we're supposed to have lunch. We are back at 1:30 with 4 other papers. Thanks.
Yeah.
Actually, the line format. Started my first question, but super. Even if it's part of the point. I really know.
Right, let's get started again. It's 1:30, so let's be on time. So we have another session on optimal taxation and redistribution. Leah is the next speaker. You have to keep in mind that you have to stand in front of the camera for the online audience.
So today I present our paper with the title Carbon Pricing and Redistribution, which is joint work with Dominic, who is also here, and Clemens Fust. As we all know, fighting climate change is a central policy challenge of this century. And at the same time, a uniform carbon price, whether implemented through a carbon tax or an emission trading system, is widely seen as an efficient instrument to cut carbon emissions. But in practice, the implementation often faces strong political resistance and public backlash. So a well-known example is the Yellow Vest protest movements in France in 2018, following after a fuel tax increase. And the key reason for this resistance is distributional. So the carbon pricing burden is passed on to citizens and its incidence is regressive. So low-income households face a relatively larger relative burden of a carbon tax compared to high-income households. And a straightforward way to address the distributional conflict is to return the carbon revenues to its citizens. And the key point here is that a carbon tax is a Pigouvian instrument aimed at changing behavior by making carbon-intensive goods relatively more expensive, rather than raising revenue for the government. So how should carbon pricing revenues be actually returned to citizens? And a popular proposal is a so-called carbon dividend, where all households return equal lump sum rebates. And this approach has also gained traction among economists. So for example, the well-known Economist statement on carbon dividends was signed by almost 4,000 US economists. Let's look at how a carbon dividend can actually offset the regressive burden of a carbon tax. And for this exercise, we take the consumption baskets of German households and assign the corresponding emission intensity of each good to the consumption basket. And then we compute the overall carbon footprint embodied in household consumption. And we then assume a carbon tax of 150 euro per ton of CO2, and we compute the carbon tax burden and the received carbon dividend. And then finally, we compute the relative burden of this overall policy. The relative burden is defined as the carbon tax payments minus received rebates, expressed as a share of overall consumption expenditures. And a negative burden means that the household is a net beneficiary of the policy. And this is exactly what we see here. So low-income households receive more in rebates than they pay in carbon taxes, while high-income households pay more in carbon taxes than they receive in carbon rebates. So the combination of a carbon tax and a carbon dividend makes the overall policy progressive. In other words, equity increases. But as macroeconomists, we all know that this is not a free lunch. So so the carbon policy increases the effective marginal tax rate at all income levels. So while equity increases, efficiency declines. In other words, carbon policies entail the classic equity efficiency trade-off in redistribution. And the natural next question is this lump sum rebate actually the optimal way to return carbon revenues, or should the rebate vary with income? And this question directly motivates our paper. So in this paper, we analyze the optimal design of income-dependent rebates. More broadly, we analyze the implications of carbon policies for the equity efficiency trade-off in redistribution. And to do so, we develop a static optimal income taxation model. And a key feature of our model are non-homothetic preferences, which give rise to heterogeneous consumption baskets along the income distribution. And as goods differ in their emission intensity, this naturally gives us heterogeneous carbon footprints along the income distribution. And then importantly, we hold the preferences for redistribution fixed, which gives us a clean comparative statics analysis of the optimal tax transfer system with and without carbon policies. And then in our second part of our paper, we take our model to the data in a quantitative application for Germany. And specifically, we compute here carbon emission intensities of 107 different goods and services using an environmentally extended input-output framework. And we estimate a two-tier non-homothetic utility function based on German consumption expenditure data. So very briefly on the related literature, we contribute to 3 strands of the literature. So first, we contribute to the public finance literature on carbon taxes. We contribute to a more general literature on non-homothetic preferences, and we also contribute to the macroeconomic literature on the distributional effects of climate policies. Let's directly start with our theoretical framework. So we consider a continuum of households that differ in their productivity, denoted by theta, which is distributed by a probability density function H. And then households make 2 decisions. So first, they make a consumption decision over I goods, and second, they make a labor leisure decision. And then we assume that all households have identical preferences, which are characterized by this utility function. So households obtain utility from consumption and this utility from labor supply. And this utility function allows for non-homothetic preferences over consumption, which gives then rise to heterogeneous consumption baskets along the income distribution. Let me now turn to the environmental side in our model. So in our model, we adopt a consumption-based framework of carbon emissions. So consumption entails carbon emissions. And each good is characterized by a baseline emission intensity, which captures the amount of carbon emitted per unit consumed in the absence of abatement. And then firms can reduce the emission intensity by undertaking abatement, but doing so is costly. And the resulting emission intensity is then simply given by the difference between the baseline emission intensity and the amount of abatement. We then define the household carbon footprint as the sum over consumption across goods weighted with the emission intensity. And the household carbon footprint measures the overall amount of carbon emissions embodied in household consumption. And then we identify the so-called marginal propensity to pollute out of expenditure, or short MPP, as our key object of the theoretical analysis. So the MPP measures the change in the household carbon footprint that is associated with a change in net income. So put it differently, the MPP just maps 1 additional euro of expenditure into carbon emissions. And then lastly, we come to the government in our model. So the government chooses a policy consisting of a nonlinear tax transfer system and a carbon tax. And the government needs to generate government revenues to finance an exogenous revenue requirement. And government revenues are given by the sum of the labor income tax and the carbon tax revenues. Yes?
Because here you have a fully nonlinear tax schedule. Because you have a fully nonlinear tax schedule, you can achieve Pareto efficiency or Pareto optimum.
Yes. So like in our setting, it's like a standard second best optimization problem. But yes.
Okay, thank you.
So we are just have like except the emissions part, it's like a standard optimal income taxation framework. And then the effective marginal tax rate in our economy is defined as the change in overall government revenues associated with a 1 unit increase in gross household labor income. And besides the marginal income tax rate, the effective marginal tax rate also accounts for the increase in carbon tax revenues resulting from an increase in consumption due to higher labor income. And intuitively, earning 1 additional euro leads here to 2 effects. So first, you pay T prime in income taxes. And from the remaining 1 minus T prime, you increase your consumption, and this increases carbon emissions. And this change in emission is captured by the MPP. And on those additional emissions, you have to pay the carbon tax. And this additional labor supply disincentive is summarized by the red term in the effective marginal tax rate. So in short, in our model, the effective marginal tax rate exceeds the marginal income tax rate because additional income also generates carbon tax revenues. And then to derive our key theoretical results, we use a simple thought experiment. So first, we start with a pre-Paris Agreement world where the government has no carbon concerns. And in this case, the optimal policy is given by a nonlinear tax transfer system. And then second, the government suddenly faces a binding exogenous limit on aggregate emissions. And the policy under the carbon cap is then given by a revised nonlinear tax transfer system and a carbon tax. And our question is then whether the optimal policy under the carbon cap is more redistributive than the optimal policy under the status quo. And equivalently, we can view the new tax, the implementation of the new tax transfer system as the old tax transfer system plus our carbon tax rebate, which is defined as the difference between the tax transfer system and the status quo and under the carbon policy. So now let's start with the optimal policy analysis. So the government is now forced to implement the binding carbon aggregate emissions and chooses the optimal tax transfer system and a carbon tax. And to do so, the government maximizes the standard social welfare function, subject to the usual constraints, the government budget constraint and optimal household behavior. And in addition, the government has to obey a carbon cap constraint, which ensures that aggregate emissions below remain the aggregate limit on emissions. And before I move to the characterization of the optimal tax transfer system, let me briefly introduce you our key mechanism behind our theoretical results. So with a carbon cap, lower labor supply reductions have 2 effects on welfare. The first is a standard fiscal externality. So when households work less, the government collects less government revenues, both through the labor income tax and through the carbon tax. And then on top, there's an environmental gain. So a lower labor supply reduces consumptions and thereby carbon emissions. And this relaxes the carbon cap, which is welfare improving. And we summarize those 2 effects in the so-called welfare relevant labor wedge. And this wedge is defined as the overall welfare effect from a reduction in labor supply, accounting for both the fiscal externality and the environmental gain. And the key point here is that the welfare relevant labor wedge is smaller than the effective marginal tax rate. So part of the distortion of labor supply is here offset by the fact that a lower labor supply implies lower carbon emissions. And this creates a gap between the effective marginal tax rate and the welfare relevant labor wedge. And we call this gap the carbon redistribution gap. And this gap measures the additional scope for redistribution created by the introduction of a carbon cap constraint. And the gap increase is larger, the steeper the income gradient and the household carbon footprints is. So in other words, the carbon redistribution gap increases with a higher degree of carbon inequality. So let's move on to the optimal tax transfer system. And to analyze the impact of the carbon cap on the optimal tax transfer system, we use our simple thought experiment. So first, we look at the government in the status quo where no carbon cap is effective. And then in a second step, we move to the case where the government faces the binding limit on emissions. So in the benchmark case of water carbon policy, the optimal tax transfer system is given by a balance between distributional gains and the corresponding efficiency costs. And this gives us the optimality condition, or like the familiar optimality condition D equals E. So the distributional gains term here measures the gains from redistributing income from rich to poor households. And in the figure, this is illustrated by the black curve, which is declining with the effective marginal tax rate. So if the effective marginal tax rate is already high, the additional gains from redistribution are small. And on the other side, the efficiency cost term here measures the efficiency costs of redistribution arising from labor supply distortions. So the efficiency cost curve is illustrated by the red line in the figure. So with a larger effective marginal tax rate, labor supply becomes more distorted, implying a higher efficiency cost for the government. And the optimal tax system is then simply given by the intersection of the D and the E curve. And now we move to the second part of our thought experiment where we introduce the carbon cap. So introducing a carbon cap does not change the distributional gains term. So in the figure, the distributional gains curve does not shift. However, what changes is the efficiency costs term. So the efficiency cost term depends now on the welfare relevant labor wedge instead of the effective marginal tax rate. And as the welfare relevant labor wedge is smaller than the effective marginal tax rate, the efficiency costs of redistribution are smaller compared to the status quo tax system. And in the figure, this is illustrated by a shift of the efficiency cost curve to the right. And the new tax transfer system under the carbon cap is then given by the intersection of both curves. Yes?
Sorry, I think I missed something quite important. Can you tell me again how the carbon tax or the tax and transfer that you said that are lump sum are going to affect labor supply? Because here you're saying that the policy will affect labor supply and the labor wage. So that's why I'm confused. Thank you.
So I have not talked about how we compute the optimal carbon tax, but in our setting, the Addison-Stiglitz assumptions are fulfilled. So the optimal carbon tax is uniform and follows the first best rule. And then for the optimal tax transfer system, so the government sets a nonlinear labor income tax in addition to a lump sum element. So there's both, and the effective marginal tax rate leads to the labor supply distortion via the behavioral labor supply effect. So then we come to our comparative statics analysis, where we want to answer two central questions. So first, is the carbon policy under the carbon cap more redistributive than the status quo tax system? And second, what are the properties of the carbon tax rebate function? And as you probably know, analytical results in such a model are very complicated to derive, as everything in our model is endogenous. So to make the theoretical progress here, we impose three additional assumptions. So first, we assume that carbon angle curves are linear and that there are no income effects. Second, we assume that the carbon cap is only marginally binding. And third, we assume that the baseline labor income tax function is linear. Let me start with the impact of a carbon cap on redistribution. So for this, suppose that the government implements a distributional neutral carbon rebate where each household is exactly compensated for its carbon tax burden. And in such a case, the utility levels of households are unchanged, implying that the distributional gains term does not change. However, as I have explained to you just like a few minutes ago, the efficiency cost term now depends on the welfare relevant labor wage instead of the effective marginal tax rate. And this, as the welfare relevant labor wage is smaller than the effective marginal tax rate, the efficiency cost of redistribution decrease, implying that the efficiency cost curve shifts to the right. And then at the status quo effective marginal tax rate, the distributional gains term is now larger than the corresponding efficiency cost term. And to restore the optimality condition, redistribution has to increase. And this directly gives us our first theoretical results that under a carbon cap, the optimal policy is more redistributive than the status quo policy. And then let's move on to the properties of the carbon rebate schedule. For this, we start with a polar case where the gains from redistribution are constant. And in this case, the distributional gains term is given by a horizontal curve. And as before, the carbon cap lowers the efficiency cost of redistribution, implying that the efficiency cost curve shifts to the right. And at the intersection of the horizontal D curve and the shifted E curve is then the new optimum, and a carbon dividend is then the optimal policy that implements this new optimum. So here, the introduction of the carbon cap translates one-to-one into higher effective marginal tax rate. But this is just like a polar case because we assume that the additional gains from redistribution are independent of the initial level of redistribution. So in the more standard case, where the gains of marginal distribution are decreasing, a carbon dividend is no longer optimal. And the reason for this is that at the effective marginal tax rate at a carbon dividend optimum, now the efficiency cost curve is larger than the distributional gains term. And to restore our optimality condition, redistribution has then to be decreased by making the rebate schedule increasing in income. And this gives us our second theoretical result, which is that the optimal carbon rebate schedule is increasing in income. So now that I have derived our main theoretical result, we now take our model to the data. And in particular, we calibrate our model to the 2018 economy in Germany. And the calibration remains 5 main inputs. So first, we need to calibrate an income distribution, and we need to recover the current tax transfer system. And here we combine German administrative income tax data with the German income and consumption survey data. And then we need to compute the emission intensities of different goods. And here we use the environmentally extended input-output framework XEO-base. And then we also calibrate the carbon abatement technology by following the DICE literature. Yes?
Is it implicit assumption that the current tax transfer system is optimal, or it's a benchmark system that is possibly suboptimal?
And a more optimum approach. So we assume that the current tax transfer system in 2018 is optimal, and then we recover the loads. And then we finally need to calibrate the parameters of our utility function. And here we use again the income and consumption survey. And today I focus on the internal calibration of the utility function, as the other 4 objects are a rather standard exercise to calibrate. So for the utility function, we assume a nested utility structure with non-homothetic CS preferences over consumption. At the upper tier, preferences are represented by a non-homothetic CS aggregator over 9 broad consumption categories. And at the lower tier, each good is a non-homothetic CS composite of a brown and a green variety. And this utility function allows expenditure shares on different goods to vary with net income, which is what we observe in real-world consumption expenditure data. And then we calibrate the parameters of the utility function to match the expenditure share along the income distribution using a minimum distance estimation approach. And this figure illustrates the model-generated carbon footprint along the income distribution, and it compares it with the corresponding data moment. And as you can see, our model captures the overall income gradient and carbon emissions very well. Let's move on to our quantitative results, and we consider a carbon cap that targets an emission reduction by 25%. And we find that the optimal carbon rebate is increasing in income. And for example, households at the 19th percentile receive a 3.3 times higher rebate than those at the 10th percentile. And at the same time, the carbon tax burden is also increasing in income, but it does so more steeply than the carbon rebate. So for example, households at the 19th percentile pay 7.9 times more in carbon taxes than the 10th percentile. So overall, the carbon policy is strongly progressive. And then lastly, we can also look at the net burden of the overall carbon policy, defined as the change in the effective average tax rate. And here we find that the net burden rises along the income distribution. So the poorest households face a change in the effective average tax rate of around -10%. And then the net burden rises steadily along the income distribution up to around 1%. So then just let me briefly summarize. So we use the static optimal income taxation model with carbon emissions. And theoretically, we find that the induction of an aggregate emission and target increases through distribution, and that the carbon rebate schedule increases with income. And we find that the redistributive implications are substantial. So thank you very much for your attention. I'm looking forward to the discussion.
Right, thank you very much. Andrea Lanteri is the discussant.
This is not.
Yeah.
Thank you. Great. So thank you very much for inviting me to discuss this paper. I really enjoyed spending some time thinking about it. So what the paper does is really, it analyzes the interaction between the problem of optimal nonlinear income taxation, where we're trading off sort of incentives for redistribution with social cost from distortions, with the interactions of that with the carbon tax, sort of another instrument that is designed to deal with carbon emissions. And I think the main insight of the paper is really that once you have an aggregate externality such as carbon emission externalities, that changes the calculations for the social cost of distortions in an optimal taxation problem. Now, in the model of the paper, it changes it in a specific way. It actually, carbon emissions reduce the social cost of distortions. And I think the intuition is that reducing output is somewhat desirable, is whenever we produce and consume, we are also generating some aggregate externality through emissions. And so because reducing output is somewhat desirable, when I think about the distortions induced by labor income taxes, I'm a little bit less concerned. And as a result, the planner desires more redistribution, and so is willing to accept more distortions. And then one way to think about implementing the allocation that comes out of that optimal policy problem is that we could actually keep the same income tax that we had before worrying about carbon, but now we could give a rebate of the carbon tax that is nonlinear and is progressive in some sense. So rich people are gonna spend more on the carbon tax, but are gonna get a rebate that is less increasing in their expenditure. And so eventually we're gonna achieve more redistribution through that additional transfer. I think this is a very nice theoretical contribution. The paper makes the point in a very clean way. And then it has a rich quantification with many different sources of German data. So it's one of those papers that is where there's a lot in it, and you feel bad about sort of making comments and picking on things. But overall, I really enjoyed it. So my main comment is really trying to think about this insight, which I think is general inside the model of the paper, and then maybe outside a bit more broadly. Now, the model proposed in the paper is static in the specific sense that the technology is really exogenous with respect to the income tax schedule. And so the technology, including things like the emission function, as well as the opportunity for firms to abate their emissions, those respond potentially to carbon prices and taxes, but not really to progressivity. So in that sense, it's static. So in a world like that, it's somewhat natural that some of these emissions reductions are going to come from some sort of degrowth. You want less output. Given the technology, if you're going to reduce emissions, you're going to like a bit less output. And I think this is the main force why in this model we like more progressive income taxes. We don't really worry that high income people are going to be distorted a little bit more. In fact, we don't want them to work as hard. Now, taking this insight to the real world, it seems to me that a lot of emissions reductions are in practice not really coming from us consuming less, but rather from developing new technologies that allow us to consume more and emit less. Think about solar panels or heat pumps or electric engines and things like that. And so, again, this is beyond the sort of the model of the paper, but if you want to think about endogenizing the creation of this type of technologies and the improvement of this type of technologies, it seems likely that expectations of high future income are an important determinant of the incentives for scientists, engineers, and entrepreneurs to come up with these ideas. And so once you think about that, I think it's still true, it's still very true that the social cost of tax distortion is affected by carbon emissions, but it's not obvious that it would be necessarily reduced by the presence of carbon emissions, because now whenever I have a more progressive income tax system, I'm also distorting the incentives for innovation and sort of improvements of these technologies over time. In fact, I think one could envision sort of a dynamic version of the model where when people work hard, they're also, with some probability, coming up with ways to reduce the emissions per output. And in a world like that, I think that's sort of the key equation that determines the trade-off for the planner would be similar, except there would be an additional term that is really as an opposite sign relative to the ones that is discussed in the paper. There's an additional distortion coming from the concerns that income taxes would reduce innovation. My second comment is about sort of thinking about the preferences in the paper. So the paper shows that high-income households in the data consume more, of course, and also emit more carbon dioxide through their consumption. However, when you take the ratio, they're actually cleaner in some sense. So high-income households have a lower emission intensity. This has been documented in other contexts as well. The model rationalizes this through normothetic preferences over goods that are differentially clean or dirty. So in some sense, if you're high income, like inherently you care more about the environment. I'm going to offer a slightly alternative way to think about the same fact. I think you could have homothetic preferences, but in complete markets. This builds on some work I have with Adriano. And in that paper, we mostly talk about firms, but we also have a household model in the appendix. And so the way we think about this fact is that energy efficiency is to a large extent embodied in durable goods. Again, you can invest in heat pumps for your house or buy an EV and things like that. And typically, the way this works is that cleaner goods are going to be more expensive ex ante. You have to pay for the heat pump, but then you're going to save on energy for a number of years. And then on the other hand, dirtier goods or dirtier technologies are going to be cheaper, maybe in terms of financial resources that you have to deploy ex ante, but then you're going to have to pay for a higher complementary energy cost over time. And so in equilibrium, optimally, poorer households choose the dirtier goods because effectively, if you're financially constrained, you really like the fact that dirty technologies are cheap and you discount the future energy savings at a higher rate. And so this would give rise to something that is an as-if non-homotheticity. So we could sort of generate these sort of patterns of expenditure, at least over the wealth distribution, to the extent that income and wealth are correlated over income as well. The difference is that here technology adoption would be endogenous and potentially respond to tax policy. I think at a minimum, this could be like a micro foundation for something that we can model as a non-homotheticity as a reduced form, but it doesn't need to be. The third and last sort of set of comments is really about thinking about how to connect theory and data in the paper. The author do a lot of work in that direction. So these are sort of small things. So one is In the theoretical model that is used for the proposition, my understanding is that it's important that this mapping G of V, so that's the payoff for the planner of a given indirect utility V, is concave. Otherwise, it would be optimal to give a lump sum transfer to everybody of the carbon tax. And that was, I think Leah also showed it in the slides. Now, in the quantitative model, G is linear. However, other assumptions are changing as well. And then the lump sum rebate is not optimal. So I think maybe one suggestion would be to just change the assumptions one at a time through the compositions to show how to kind of connect continuously the theoretical model with the quantitative model. I think it's the other assumptions on preferences that are responsible for the result, but this could be made very transparent, I think. The second point is, again, thinking about the data, what is the right frequency to connect this static model with the data? Should we think of this as a long-run model, or should we think of this as a static short-run model? It kind of matters for things like the elasticity of substitution between different goods. On the supply side, the model has some kind of abatement choice from the firm. This makes me think that there is some margin that would adjust perhaps over a medium run. But on the demand side of consumers, really green and brown goods are pretty poor substitutes. And so I think, my hunch is if this is a long run model, these things are probably good substitutes. So it might be interesting to see that in a maybe an alternative calibration. Finally, here I'm really like picking on things, but again, connecting theory and data, of course, the model is static, the data have savings, the difference between income and consumption. So I can see the carbon content of your consumption, but how do I think about the carbon content of your savings? And really what the paper does is sort of assumes that income is constant, roughly. But I think there are some changes in income that are predictable because of life cycle considerations or mean reverting shocks. So I think in principle there could be a refinement of the measurement of the carbon content of your income, going from the income in the year that I see through some prediction for permanent income of the household, which would determine their level of consumption. Overall, I think there's a very nice theoretical insight, which I think is general, and I enjoyed that. I think that if you have an aggregate externality coming from production or consumption, you have to redo your calculations of the distortions from income taxes. In a static model, this means you want less output, so you're willing to accept more distortions. It will be interesting to generalize this analysis, maybe in another paper, to sort of endogenous technologies through innovation and technology adoption. Thank you so much.
Dominic, do you want to have a brief response before we go to question?
Yeah, I mean, thank you very much for all the comments. So I think they're like very good. So just like one very short answer. So for the elasticity between substitution elasticity between brown and green varieties. So we I think on Monday we just did another robustness check where we limit the substitution between we limit the substitution for heating and housing, because there we observe that households have a limited substitution possibilities, and then we find the results are very stable. So
one reply is, first of all, thanks a lot, very useful. For the first comment, right, about the labor supply reduction, I think it's a very good point, and we will think a bit more about it on how to think about this innovation incentives. One could say maybe in the first place, even without green technologies, there should always be incentives for innovation, and this was already captured in the tax transfer system, but maybe there's now an additional rationale. And then just one thing, I think it was not in the draft that we sent to you, but now, so the labor supply reduction that actually happened and the optimal allocation, they're pretty small. So for the 25% reduction in carbon emissions, right, the associated decline in GDP due to lower labor supply is 0.4% or so.
Great. So I have a quick question before we open up the floor. So you have, from what I understand, one-dimensional heterogeneity, so you can do everything income contingent. But I think in practice, a big problem also for policymakers is that there's sort of richer heterogeneity, even conditional on income, right? So some people live in the city, other people live in rural areas. They have the same income, but they have very different carbon footprint. And so the carbon tax hits the rural people much more because they have to drive to work, they have longer commute, they don't have public transportation, which politically I think is a big issue. And we have all these other policies to help people in rural areas. So have you thought about that? You know, how you would implement things? You would need some richer policies, I guess, in that case to compensate people, right, for the carbon tax.
I mean, so we have done one thing in the paper. So the MPP is like a key statistic for the additional scope for redistribution, and we compute a covariate standardized adjusted MPP. So we just like keep the demographics constant along the income distribution, and there we find that the MPP is by 23% lower. So it would just like limit the additional scope for redistribution. And then more for the policy part. So in like the example that you said, like in this case, we could think about like a tagging exercise and making designing rebates that are also conditional on, for example, living on the countryside and in the city. And then we kind of like know from the tagging literature that that would also entail welfare improvements.
Okay. I want to touch upon labor supply. So you have separable preferences and then a constant coefficient in there, being labor supply is constant along the income distribution, right? If I'm not mistaken.
Labor supply is constant.
Labor supply elasticity, sorry. It's constant. Yeah, my bad. And so that's almost certainly rejected by empirical evidence that elasticity is constant along income distribution. How important that assumption is for your results, and how would they change if you relax that?
We should check. It's a good idea.
Yeah.
It shouldn't matter too much. We do have a comparative static, like where we change the, frisch for everybody. There, what you get if you have for elasticity. Again, I got it. No, but I just wanted to say what we find there and then speculate what we find for the other case. But I agree, the shape is interesting to look at. We didn't, but.
And how do you pin down the income effect on labor supply? Because I think that ought to be important too, right?
I mean,
so in particular,
yeah.
suppose you start with GHH preferences, no income effects at all. Would then this additional effect even be present? This indirect effect? I don't think so.
Maybe briefly. So for now in the paper, we do have the income effects in the quantitative part. We have done, it's not in the paper, a version also with GHH. It doesn't make too much of a difference. So they play a role, but not a large role.
Yeah, I mean, actually, when we did this similar thing without the carbon stuff, we also found that income effects didn't seem to made surprising little difference. But I was going to ask a question about. So I guess Sebastian's paper this morning said, well, thinking about this distributional concerns doesn't change the level of the carbon tax that you want very much. But you're saying, well, maybe that's the wrong place to focus. Maybe it doesn't change that, but it does change the income tax you want, the amount of redistribution you want to do. And so that was interesting. I don't know whether, Sebastian, actually you found that too when you did your exercise this morning. But in terms of your paper, I guess, you could also do the same exercise they did and say, if you sort of shut down the income inequality in your model, would you get a different carbon tax? You set it up a little differently because you just had a given amount of carbon reduction that you wanted to achieve. But maybe the tax rate you need to achieve that is different in your model with this inequality and non-homothetic preferences. Maybe that's a different tax than you would need in a representative agent model.
So the results would certainly be the same if you just had a simple atmospheric externality. If the externality works on output, there could be some interacting effects which change it a little bit. We would have to think about it.
No comments about, again, about connection to carbon taxes, since I like titles. There's a literature going back 50 years in optimal tax about how does the optimal nonlinear income tax change when consumption generates a negative externality. It's there's formal papers, and depending on different assumptions of how it works, it's popularized in Robert Frank's books, his 1999 book, Luxury Fever, where he basically says here consumption, instead of causing carbon, it causes other people to feel bad as an atmospheric externality. But obviously the calibrations would be different, but the analysis, I think, is the same. And when you think about across different goods, it's not generally been done in that simple literature, but going back to Veblen and the like, and things like conspicuous consumption, if we have a consumption vector, some components are more conspicuous than others, thus cause a bigger externality. In this case, it may be that it's actually the richest certain goods of the rich are the most notorious in creating this. And, one would get all of these sorts of things. The reason I mention it, I think you can just mention it in literature, but the general structure of the problem of how does optimal redistribution change when consumption generates an externality is in a class that has been studied and understood before, can be drawn upon. And then what is it about carbon pollution in particular and the particular mechanisms that lead it either to play out differently or that interesting data to calibrate for the issue because it tells us something about the issue of the day in terms of just sort of the relative focus.
So my understanding is that the literature you're referring to, that we are in settings where we don't have an additional Pigouvian tax to address these externalities, so it's only the income tax that can do it, and then you would want to have it.
Yeah.
Exactly. But in our setting, the difference is
No, agreed. But for example, the result on we optimally want more redistribution because the normal dead weight loss is actually a good thing rather than a bad thing. Those kinds of things are similar. So it's really the last point that I said, focusing on what's similar, what's different, what is it about this problem that makes it different from that problem, I think helps build the overall structure more helpfully.
Thank you. It's very helpful.
Last question. Yes.
Okay. Reiterating a little bit on what John said, you start out from a situation where you say, okay, when the government has no environmental concern, it should have a environmental tax or emissions tax of 0, which I see when you have linear angle curves, but in your case where you have these non-homotheticities, I don't know what the assumptions are, whether this is sort of an optimality thing or not, because then sort of emissions contain some information about where you are in the income distribution, and that might relax your incentive constraints in the Milesian problem. So I'm not sure whether this is actually sort of the benchmark optimality case against which you should study this problem.
I mean, like in our model, still the actions and the Stiglitz assumptions are fulfilled, so it's not optimal to have the current tax without the environmental concern.
All right, thank you very much. So Matthias is the next.
Okay, so thanks a lot to the organizers for putting the paper in the program. So this is going to be a paper on optimal commodity taxation with rational inattention, and it's joint work with Mario Zangelettos. So, okay, the question that we're sort of after in this paper is how should we set commodity taxes when consumers are inattentive? Sorry, now you can see the question. And we sort of have lots of empirical evidence that has kind of shown that consumers seem to sort of misperceive or misunderstand taxes, right? So here I have in mind the papers by sort of Chet and co-authors, Tavinsky and Rhys-Jones, and several others who have sort of documented this extensively, right? So it seems pretty clear that consumers sort of underreact to taxes that are not fully salient, and they sort of use simple heuristics when they're facing a complicated tax system. Right, and sort of building on these findings or drawing on them, a sort of recent literature, behavioral literature has sort of offered 2 key lessons, right? So the first one is that sort of we should use these we should use commodity taxes to try to correct some of this inattention, right? And the idea is that inattention is sort of a distortion to market outcomes, and we should use taxes to try to alleviate this. And the second one is that we should perhaps use these taxes to try to sort of exploit some of this inattention, right? So to the extent that inattention mutes responses, right? It sort of lowers the effective elasticity and sort of the thinking of the inverse elasticity kind of logic. We should tax people more, right? And sort of the underlying assumption that sort of drives these lessons is that inattention is a mistake. Okay? And what I want to do today is sort of instead take a different approach and treat inattention as rational, right? And sort of by rational, I mean that the agents are going to choose this attention optimally by trading off the benefits of more attention against its cost, and the planner is going to internalize these attention costs. Okay, and the sort of main takeaway from what I'm going to show you is that basically inattention is irrelevant. So I'm going to be more precise about what exactly we mean by this throughout the talk. But the basic idea is that you shouldn't pay special attention to inattention. So, anyway, so let me go on to what we actually do in this paper, right? So we're going to introduce a general form of rational inattention into a flexible, into sort of a classic multi-good Ramsey taxation problem, right? Where the planner is going to choose some linear commodity taxes to raise revenues and redistribute, right? And so the consumers are going to make their choices based on some imperfect signals of fundamentals, prices, and taxes, right? And the signals are sort of a metaphor for costly information acquisition, costly cognition, or costly optimization, right? So our framework is kind of flexible enough to accommodate all of these interpretations, okay? And as I sort of already mentioned in the introduction, the key thing from our approach is that we're going to work with a non-paternalistic planner that's going to internalize the attention costs of the agents. Okay? And the sort of the strongest version of our irrelevance result is going to be under two restrictions on attention costs that I'm going to expand throughout the talk. But the first one is sort of this thing that we call invariance of attention costs. And roughly the basic idea is that attention costs shouldn't depend on the way we describe the world. So as long as we keep the underlying uncertainty fixed, the cost of cognition should be unchanged. Okay? And the second one is a sort of state separability condition, and it basically captures this idea that how much attention or the cost of attention in a given state of the world is independent of whatever I'm doing in a different state. Okay, so I can sort of separate the attention problem across states. Okay, and then sort of in the final part of the paper, we're going to relax these restrictions one by one to identify when and why inattention might matter. Okay. Very good. So as I previewed in the introduction, the sort of main result of the paper is what we call irrelevance. And now let me be clear what I mean by this is that in the benchmark that we identify, the standard optimal tax formulas go through. Right, so basically what we're saying is just look at the effective elasticities, ignore whatever is under the hood, right? So as long as you measure the effective elasticity on demand, you can just plug them in to the familiar optimal tax formulas. So in a sense, you don't have to take a stand on where inattention is coming from. And a sort of more minor point that we make here is that in contrast to this conventional wisdom, some forms of inattention can actually increase effective elasticities and perhaps justify lower taxes. Okay, and then the second part of the paper is when we move away from this benchmark, and the main insight there is that there's two different motives for state-dependent taxes. So by this I mean taxes that move with realized prices. And the first one is that when we relax state separability of attention costs, this is going to be due to a purely Ramsey motive, right? So the idea is that a state-dependent tax system is going to reshape the uncertainty that consumers face, right? So it's going to allow the planner to change the attention that agents are paying. And this is going to relax the usual trade-off, like the usual revenue versus distortion trade-off. Now, more interestingly, when we depart from invariance, this is going to introduce a Pigouvian motive, right? So the idea is that now there's some sort of cognitive externalities that people have, and you're going to use a state-dependent tax system to stabilize or simplify the price system that's going to help agents ease their cognitive burden. Very good. And then the sort of final, more conceptual point that we make is that salience, tax salience, so this idea that agents respond differentially to a tax change when compared to an otherwise equivalent posted price change can actually be interpreted as a violation of invariance. So this is going to allow us to make a bridge to this behavioral literature and actually add sort of two insights, right? So the first one is that salience, so accounting for salience is only going to matter when producer prices are endogenous. And the second is that still it can still be irrelevant for the relevant demand response with the right equilibrium elasticity, right? So I'm going to be clear about what we mean by this later on. But very good. So here's quickly the plan for today. I'm first going to introduce a simple model of rational inattention, which is going to allow me to talk about the simplest version of our irrelevance result. And then I'm going to ask, how general is this irrelevant? And then I'm going to turn to the what happens away from our benchmark, right? So emphasize what happens when we relax state separability, show how this introduces state dependence, and then connect a bit to the salience literature when we depart from invariance. Okay? Very good. So let me go into the model and like keep the goal here is to keep everything outside of the rational inattention I mentioned as simple as possible. So it's almost going to be embarrassingly simple. So bear with me. There's going to be two goods. There's going to be a tax good that I'm going to denote by X and an untaxed numeraire, which is going to be Y. Okay. There's going to be some representative consumer that has some preferences that are represented by a quasi-linear utility function over these two goods. And right, and Q is going to denote the after-tax price of the taxable good, and I'm going to normalize the price of the numeraire to 1. There's going to be some exogenous state, which is the fundamental, if you want, in this economy. So to fix ideas, think of this as a productivity or a supply shock, right? And this is going to be, there's going to have some, this state is going to have some exogenous distribution. This is the objective distribution, and then I'm going to denote pi. I'm going to use pi to denote this. So, right, so theta, this fundamental is going to determine the producer price. So effectively, I'm treating producer prices as exogenous in this simple model. And then the tax policy is going to set tau, the commodity tax in that state, and the true consumer price is going to be denoted by this Q of theta, right? And then I'm going to collect the price across all states into the what I'm going to call the price system, and it's just this bold Q. Okay, so this is how I'm going to introduce inattention into the consumer problem. Right, so I'm just going to say that the consumer has a prior over the set of possible consumer prices that can arise in equilibrium. Right, so this fancy Q of phi here is the support of the consumer's prior. The consumer is going to choose a stochastic rule. So this is kind of capturing the inattention, right? So for any given price, I'm going to say that the consumer, instead of choosing a deterministic level of consumption, there's going to be a distribution of consumption for any given price. And, right, and this is sort of capturing the inattention, right? Okay, and the individual problem is going to be sort of given ignoring this sort of more flexibility, it's going to be fairly standard, right? So the consumer is going to choose this distribution for any given price to maximize their expected utility net of attention costs.
Good question. This is like you're responding to the price, but potentially with error, and you're calling that rational inattention, right?
Not really, right? So let me maybe talk about this a bit, and then we can come back to this here, right? So the idea is that so this cost function, right? So I'm making this cost function very flexible, right? So if I make so depending on what restrictions I impose on this, I can talk about cost information acquisition. So the usual Sims idea that there's going to be a noisy signal of the price, and I'm going to make my decision based on that. Or what I think what you had in mind is costly control idea. So I see the price perfectly. I just have some difficulty mapping that price into the optimal action.
Yeah.
Right. So I can do both.
But it's never the case that the consumer violates the budget constraint, right? So the quasi-linear good always adjusts so that the budget constraints set it.
Exactly. So in the simple model, that's going to be where all the adjustment goes there, right? So there's this usual difficulty of dealing with budget constraints with inattentive consumers, and with the quasi-linear assumption, I can take care of that for now. Very good. So in the paper, we talk a bit about more expanding on how we can actually nest the two and how it reduces to a choice of F. But in the interest of time, let me go on. Very good. So a definition, the equilibrium of this economy is sort of going to be very simple. It's going to be a price system. It's going to be a stochastic choice rule and a prior such that the following two conditions are satisfied, right? The first one is the usual optimality condition. So this choice rule has to be consistent. It has to be optimal for the consumer given their prior. And the second is what we call consistency, is the saying that whatever this prior is, it has to be, it better be equal to, in equilibrium, the distribution of prices that is generated by the tax policy chosen by the government. Okay, so just to be super clear here, notice this consistency condition is an ex ante consistency condition, right? So I'm not imposing that the consumer perceives the realized price perfectly, right? Very good.
You sort of are the choice problem.
Yes.
Sort of seem to, right? Because you are conditioning the choice of X on Q. So I'm not quite sure I understand what you mean. That lead literally seems to say that I'm going to choose some distribution function, but conditional on Q, because you notice that you have that f of x given Q. So I'm not sure I fully understand the claim. This looks on the face of it as though I have the stochastic choice rule and I see Q, and based on that, I'm going to choose.
Right. So if I see it perfectly, then I would choose, if there's no costly control thing, then I would choose a deterministic level of consumption, right? So if I would, then that is the extra noise.
Choosing a deterministic thing might be very costly. That's what on the face of it looks like.
Yeah. So, but remember that this thing here also can be, right? So this is the whole family inside the cost function.
I understand.
Yeah.
But if it is very costly to choose a deterministic choice rule.
Yeah. So I agree that.
Cheap. So it's not obvious from this. I was just trying to understand the words you were saying.
Okay.
And the formulation of the problem. I didn't quite see them in that.
So in the paper we talk about careful, and so maybe I can come back to this later in the discussion. But it is sort of, I can still have a world where the consumer receives a noisy signal, right?
Sure.
Right, and then
that is okay.
Yeah, but then
Anyway,
okay.
There were some words that you used that confused me, so let's skip those words.
Okay, so the Ramsey problem is going to be fairly standard, right? The planner is going to choose some after taxes, or equivalently the after tax prices, to maximize consumers' indirect utility, right? So remember, this sort of incorporates it's kind of net of attention costs, and so this is kind of reflecting the non-paternalistic stance, and there's going to be the shadow value of tax revenue. Very good. So in this case, right, so here's the sort of, to make some progress on this question, I'm going to impose the following restriction on attention costs, right? So I'm just going to say that the costs are given by this object here, and here, the little f here is the density of consumption, right? And the sort of inner integral is telling me how costly it is to implement a given distribution of consumption. So, right, so this specification is really saying, there's some Q, I know it perfectly, and then I have some difficulty mapping it to the optimal one, right? And then the second, the outer summation is just telling me how I aggregate this across different Qs. And right, the K function here is convex, so right, that's capturing the idea that playing very precisely is going to be costly. Very good. So this is the two restrictions that are sort of the ones that are driving our general irrelevance result. The first one is this additive separability across states. And the second is that costs are invariant, right? So notice that they only depend on the frequency of prices, but if I quote prices in euros or dollars, this cost is going to be unchanged. Very good. So now in this economy, the sort of optimal tax is just given by the familiar inverse elasticity rule, where of course now I have to use the effective elasticity, which may be different than the fully attentive one. Okay, but the point is, as long as I measure this, I can just plug it into the formula. So to give you some intuition, let me walk you through the proof. I hope the proof actually helps, because at least it helps us understand what's going on, right? So the idea is that I'm gonna subsume all inattention into a modified utility function, right? So to do this, let me introduce this X bar, which is the average level of consumption that I'm telling the agent you must consume on average X bar. And then I'm going to consider this auxiliary problem where I say, what is the optimal way of getting a consumption on average that equals X bar? Okay, that's going to define this U hat function. Then I can sort of define an indirect utility and a demand associated with this modified utility function in the usual way. And then what we show is that you can the planner in our economy, like the Ramsey problem, actually collapses to a completely standard problem that is kind of separable across states, And it's as if the demand and the indirect utility come from a fully attentive agent whose preferences are U hat. Okay, so once you write it in this way, it's kind of not surprising that the elasticity of this demand curve, of this demand generated by U hat, is a sufficient statistic. Okay, very good. So now let me quickly tell you how general is this result. So we can actually accommodate a more flexible framework. So we can do arbitrary number of tax goods, introduce heterogeneity through these types H, and then also relax this restriction on exogenous production, right? So, but here I'm gonna focus on the case where the firm is fully attentive and competitive. Okay? And now I'm gonna capture a bit more flexibility now, right? So maybe this is going to address some of the Chair's concerns, right? So before I was saying the consumer is only looking at Q, right? And they was making their decisions based on Q. So now I'm gonna say be more flexible and say there's this object that I call the cognitive state that the consumer is paying attention to, right? And this cognitive state can include various things. It can include the fundamental, the producer price, and the consumer price, okay? So now the idea is like, and then of course, at first it may look superfluous for you that why do I include P and Q if in equilibrium, they are gonna be transformations of theta, right? But for an inattentive agent, it's very important to think about, to keep these objects separate, right? So it may be more difficult for me to think about the fundamental versus the producer price or the consumer price. That's the key point here. And now the prior is going to be over this object. Now, okay, the type, the sort of choice rule is going to be similar, except that now you're choosing a bundle, right? There's multiple goods. And the individual problem is the same, except that now I'm not going to impose quasi-linearity, right? This is so to allow for some form of income effects, but now I have to keep track of budget constraints, right? And here, notice that I'm writing the budget constraint in expectation. So that's sort of relying on this idea that the consumer is sort of insured against idiosyncratic variation in their wealth, right? So this is allowing me to sort of sidestep the issue of how do inattentive consumers satisfy their budget constraints. And the essence is that the marginal value of wealth is constant across different realizations of the signals, if you want, right? So this is in keeping with Diamond release idea. And if you don't like this assumption, then replace it with a quasi-linear thing. Very good. So let me go quickly on the two benchmark restrictions in kind of words, right? The formal definitions are in the paper, but I'm not going to bore you with them. As I mentioned, invariance is this idea that if uncertainty is unchanged and the behavior is unchanged, then the cost should be the same. This is sort of satisfied by the canonical specification in the rational inattention literature, and the idea is that agents can see through the price system, right? So it doesn't matter how I describe the uncertainty. This is going to be key to rule out the Pigouvian correction, and in some sense is the more substantial assumption. The second is this state separability, and it just means that me adjusting the choice in one state doesn't affect how costly it is to adjust my choices in other ones. And this is going to mean that the indirect utility that I construct in my modified utility thing is separable across states. So together, this is going to mean that the planner is going to face a standard state separable Ramsey problem. Under these two conditions, the same logic goes through. I now just have to define this sort of marginal social value of income for an individual of type H, right? So this is the object that Diamond introduced, and it captures not only the private value of giving an additional unit of income to type H, but also the fact that because of income effects, I'm going to affect the tax revenue. Okay, but the same logic goes through, and if you're familiar with the Diamond paper, this is exactly the same formula that he obtains, except that now the Slutsky matrix comes from an inattentive agent, right? So the first term is just the mechanical effect of increasing taxes is going to increase my revenue by a little bit, and I value that at lambda theta. Of course, that's going to take away some income from the consumers, and that cost is gamma theta H. And then this is going to trigger substitution effects that are summarized by the Slutsky. But again, it's as if demand comes from this X bar of H that I construct similar to before with its associated Slutsky matrix. Now, when can rational inattention actually matter? Okay, so the first case is when I relax separability. So I'm going to go quickly here, but the idea in the paper, we show that this is really not really changing the fundamental logic behind the irrelevance result. The only difference here is that when I construct my as if utility, I cannot separate the problem across states, right? So now changing the price in a given state is going to affect demand in all other states. So now I need this more complicated Slutsky matrix, but taking that off the table is kind of very similar to what I saw before. It's still a Ramsey motive. There's no Pigouvian correction. And it's the same formula that you would get in a fully attentive economy that sort of violates expected utility, if you want. Very good. So now let me quickly go to the one more interesting case, which is what happens when I relax invariance, right? So this means that now changing the way in which I describe the world is going to change the attention cost of the agent, right? So now in terms of the objects I constructed before, the indirect utility and the demand, I cannot construct them without taking into account this prior of the agents, right? So it's as if the prior acts like an endogenous paste shifter. Okay, so now this depends on the price distribution and therefore on taxes. So now the split between the producer price and the tax is going to be important, right? So this is going to reshape the cognitive burden of the price system, and it's also going to mean that the demand of the consumer is going to respond to this split. Right? Very good. So this is the general tax formula that we have in the paper for general attention cost and possibly endogenous production, right? So if you look at the left-hand side, it's almost the same as what you saw before. The only difference is that on the right-hand side, I don't have a zero anymore. I have this Pigouvian wedge due to the fact that changing the tax system is going to have a direct effect on the cognitive cost of the agent. And this is sort of introducing a cognitive externality that the price system should take into account. Now, that was the first point. The Slutsky matrices are sort of deceptively similar to what I saw before because I'm sort of abusing notation here. These Slutsky matrices are a bit different from the ones I showed before because now they are total equilibrium responses. So they take into account the response through producer price. And remember, demand response to the change in producer price, to the split, when the split changes, right? Even if I hold Q fixed. So let me unpack this a little bit more in the sort of 1 minute I have left. I hope I can do it. Let me specialize the general formula to the simplest version that still keeps the essence, right? So one good, state separable demand and no income effect. So that's going to mean that now this demand function just depends on my price in a given state, the producer price and the consumer price. I'm going to need to introduce these two elasticities. So the first one is epsilon theta of Q. It's just saying what happens if I vary the tax but hold P fixed. And the second one is let me vary the price, the producer price, but adjust taxes so that the after-tax price is constant. Okay? Under invariance, that should be zero. But because now the split matters, that's normally not zero. And you can actually show that the evidence we have on how people respond differentially to posted prices versus tax changes can be mapped to this epsilon theta P. Very good. That's what I say. And now the general, the formula in this simple economy looks kind of similar to the one I showed you before, except for two things, right? So now I have an epsilon theta GE here and this cognitive wedge. So the first one is sort of saying that now I have to take into account the effect of producer prices. That's just a key point here. Notice that this only enters with the supply elasticity. So that's the sense in which you should only care about salience when there's general equilibrium. In any case, let me conclude now as I'm out of time. I hope I convince you that rational inattention need not change optimal tax design. There's these two conditions that we identified under which all you need are the effective elasticities. And away from this benchmark, the key takeaway is that there's a motive for state-dependent taxation because this introduces non-separabilities across states. Finally, salience can be interpreted as a form of inattention, and it sort of builds a bridge to the behavioral PF literature. Thank you very much.
Right, Antoine Ferré is the discussant.
We're good. No, we're good.
Oh, this is the one?
Yeah, so thanks. Thank you. Perfect. Thank you so much for having me, and thanks. It's a pleasure to discuss the paper. So I learned a lot reading the paper, but I learned even more exchanging emails with Matthias and Marios, who've been very generous in exchanging. And I think we both learned quite a bit. So let me tell you what this paper is about. Let me tell you what we discovered, I think, building up this discussion. So the question is how you should do optimal commodity taxation with rationally inattentive consumers. Very classic question in public finance. general Ramsey setting for commodity taxation, multiple goods, general preferences, ex-ante consumer heterogeneity, and the focus is on linear taxes on each commodity to raise revenue and also redistribute, but redistribution here doesn't really matter. There is no income tax and transfer in the background. That's not the focus of the paper, so I'm just gonna put that away. Now, the second important building block is this rational inattention. Okay, so it's a general model of inattention to price P and tax tau. And basically, there is two things that are important. First is that given the priors and given your attention cost, you are going to choose a demand which here is stochastic because there is some uncertainty, and this is why you have to pay attention to what happens. Second, and I'm going to come back a lot to that, the equilibrium is such that you should have individual optimality, but also priors that are consistent with the distribution of prices and taxes. And this is key and completely standard in the rational attention literature, but that's totally non-standard in the behavioral public finance literature, to which I'm going to try to make a bridge. Okay? So the irrelevance result that we have, optimal taxes follow standard Ramsey formula. So here that's a reproduction of the simple first proposition. So simple case, one consumption good. That's the case I'm going to use in my discussion. The key sufficient statistics is the compensated elasticity epsilon, and the big lambda is how much you value tax revenue. The key insight is there is no behavioral correction. Mechanisms under the hood are irrelevant. This is the irrelevance result. And there is some more nuanced result in the paper that are very interesting, is that we usually expect that inattention dampens elasticity, reduce the elasticity. Here in this very nuanced rational attention framework, inattention might even increase the elasticity, which is very non-standard. Okay? Now the paper emphasis, and really to explain this result, by focusing on the attention costs, which is fair because that's a rational attention paper, so the key is the attention cost, okay? And so the key here is that the attention cost must satisfy separability and invariance, so separability with respect to the state theta, so it's the independence of attention costs across states, and the invariance with respect to prices and taxes, so relabeling how you divide the tax inclusive price into producer price or the tax is actually irrelevant, okay, which rules out tax salience. There are very interesting and nuanced results that are really novel contribution to literature, and I really like those results. I think they're very nice. So I learned a lot reading the paper, and the rest of my discussion is really going to be to try to relate that to the behavioral public finance literature. So my reading of the behavioral public finance literature is also that optimal taxes follow standard Ramsey formulas. It's just that behavioral corrections apply and only apply if behavioral models affect sufficient statistics, okay? And usually this happens in two ways. The first way is if inattention reduces the elasticity from epsilon to epsilon tilde, and then you just write the formula in terms of epsilon tilde. And maybe you write this in terms of the inattention, but in that sense, all that matters is what the compensated elasticity is with inattention. I think that's in line with the paper. And in that sense, I'm not sure the behavioral inattention says that you should exploit inattention. You should just use the compensated elasticity that arises with inattention. The second one is that biases break choice optimality. There is an internality if people have misperceptions, and this calls for corrections. But that's not in the paper by sort of design. Because in the paper, you assume consistent priors. You assume that the priors are consistent with the distribution of prices, then you get noisy signals or you have costly control, but which means that the posterior on average are going to be unbiased. So since there are no biases, of course there is no correction for biases. I don't think that's particularly surprising, okay? So my conjecture is that assuming consistent prior is key to rule out two. What I think we discovered during this discussion, that at least I discovered, even if you have biases, the result holds. Irrelevance holds. And so I think the result is much more general than implied in the paper. And I think that's what I learned during the discussion that I find very, very interesting, and I think is a much even bigger contribution than what the paper is implying. So to do that, I'm going to test this conjecture and show that actually the conjecture is false in a simple model of behavioral inattention. Okay, so I'm going to have a perceived tax rate, tau tilde, that depends on the true tax and some prior. And here attention is sigma. Okay? And you see that Of course, your perceived tax rate entirely depends on how you prior adjust to the actual tax rate. If your prior is 0, then of course you have biased perception and your elasticity is also going to be low. If you have consistent prior, if the prior is equal to the true tax, then you have correct perceptions. Okay? So I'm going to look at the optimal tax rule in a very simple model with fixed prior or consistent prior. This very simple model is the one that Matthias introduced at the beginning, so quasi-linear utility in Y and some curvature on X. The only thing that is kind of different from the standard model is this tau tilde, so you choose under the perceived budget constraint, the perceived tax rate, and so the choice is determined by this usual first order condition with the perceived tax rate. Attention choice with some attention cost. The marginal benefit from being attentive is that you're going to make a better choice because you get closer to the actual tax, but there is a cost, the cost of being attentive. Okay? Planner's problem, sum of welfare and tax revenue when you translate tax revenue into utility using the lambda factor. Okay? Disproving my conjecture. First result. Optimal policy with a fixed prior. Fixed prior, there is a bias. Still, optimal policy, irrelevance. The bias in perception does not enter the optimal tax rule. Kudos to Marius and Matthias, my conjecture was actually wrong. They were right to push back. What is happening? What's happening is that, of course, you have biased perception, but since people choose these perceptions, these envelope out with attention costs. And so when the planner actually sets the optimal tax, it's going to be relevant that there are biases. I think this is totally new to the behavioral public finance literature, and this is, I think, very, very interesting. But again, this is with fixed prior, so there is a bias, so it's not with consistent priors. So that goes away from the results of the paper. So when does the bias correction term appear then? Actually, it appeared when the planner does not respect the cognition process of the individuals. Here in this very simple model, it's akin to assuming that the attention cost of agents is outside of the welfare function, which here is a bit of an odd assumption, but that's a bit akin to what the behavioral literature is usually doing. And there you recover a modified rule, where actually in the optimal tax rule, you have here the bias that enters. And that says if there is a bias, you have a bias correction term. But that's only if you disrespect the cognition process. Okay? Now what happens to optimal policy with consistent prior? Well, you retrieve the irrelevance result if the planner respects the cognition process, as in the paper, but only if there is invariance. What does invariance mean in that world? It means that if you change the tax level, you don't change the technology of how costly it is to be attentive. So you don't change the attention cost. It's not more costly to be attentive to a 40% tax than to a 50% tax. This is what invariance means in this very, very simple setting. If that's true, you recover irrelevance. And that's the results of the paper. Second, you also have irrelevance of the results, an irrelevance result, if the planner disregards the cognition process. Why? Because if the planner disregards the cognition process, you should correct biases. But here you have consistent priors, so there is no bias to correct. Okay? And this is in the sense the conjecture that I had at the beginning. Okay? So what do we learn? We learn that the paper studies this case where there is a consistent prior and you respect the cognition cost of the agent, in which case there is irrelevance if invariance holds and state separability in the more advanced models of Marius and Matthias. But more broadly, there are other irrelevance results. With unbiased perception, there is an irrelevance result if the planner also disregards the cognition process. And I think the most interesting one to me, and I think the key contribution to the behavioral public finance literature, is that with biased perceptions, you also have an irrelevance result if the planner recognizes the cognition process of the agents. And I feel this is a very natural extension of the paper. And I really enjoyed learning that and doing that. Thanks so much.
Great. Yeah, so thanks a lot, Antoine. As you mentioned, we've been corresponding a bit. I've been working very hard to address your points. I think you made us think a lot, so I appreciate it. So I just want to clarify one small point. That's correct, right? So we mostly focus on the case because we are respecting the planner's attention cost. We focus on the top column, right? And what you I think this sort of the the key, what I want to clarify is that at least how we think of the assumptions is as follows, right? So a consistent prior is that consistency is just telling us how taxes move the prior, right? So in this deterministic world, of course, if you have only one possible tau, like the realized and the perceived once you impose consistency is going to be the same, right? But if you have the deterministic world, like Antoine's formula, let me just go here. This perceived thing, right? So for us, this would be like sort of the expected prior, right? So whatever you perceive is just going to be, it's never going to be exactly the truth, right? So the perception of the agent, this tau tilde, is never going to be exactly the truth, even if even if we impose consistency. And right, this sort of comes back a bit to what Charlie mentioned, that here, like if once you write it this way, right? So the agent is going to choose as if the tau is tau tilde, right? It's not going to be the true one. But no, and then sort of the second part is like invariance, what it rules out is that it's saying like whatever I do to this prior is not going to have a direct effect on the attention cost of the agent. But I completely agree that, you know, this second point here about what happens in attention cost excluded from W is sort of, and the fact that it's sort of delivering a sort of irrelevance result, that's kind of also surprising to us, and we need to digest it more and think exactly how it maps to our setting. But yeah, thank you very much.
Okay, super interesting. I have two philosophical questions for you. It's just something that's puzzling me about the rational inattention versus behavioral inattention. So one of my questions would be, is there even a possible empirical setting or experiment where we could actually properly distinguish what's rational inattention from behavioral inattention? Because it's going to have very different implications. My other question is, so in the invariance result, my reading of the empirical literature is that it's very likely not holding, right? Like Chetty's results or anything about how information is presented to people matters. So what is your take on, is this just a very knife edge case or is it possible in some situations? And then the third one is actually more to the point of policy. So do you view this as only applicable to very small purchases? Because you're basically assuming that people are sort of insured in their decisions, like, right? And what if it's a car? Clearly, there's a problem purchasing, you know, the car at the wrong price. So do you view this as just relevant for very small purchases, or how do you think about this, like, role of insurance of policy as well?
Great. No, thank you very much. So on the first point, right? So I think I haven't thought a lot about what evidence would allow us to distinguish between the two. What I do think is that the available evidence, as you mentioned, is consistent with both, right? So we could, so as I sort of mentioned, right, the gap between the posted price and the tax price, it maps directly to my epsilon theta p. And I think this is kind of a call for saying, like, maybe we should think more about what exactly is disciplining the two. And I see our paper as providing kind of like the benchmark. I think in the real world, like, you know, probably, you know, we're somewhere in the middle, and, like, you know, it's helpful to have both here. And then on your point, I'm sorry if I missed something else, but on this about whether I see it for sort of small decisions, so I think that's a fair point. I think it is true, like this sort of complete markets assumption against mistakes is ruling out this sort of kind of, or another way to see it is, like, think of this as a metaphor, like if you do a lot of these decisions frequently, right? So it's kind of going to wash out on average, and then sort of this is kind of a good approximation, but it's kind of a very interesting case for us, and actually some follow-up work now with Florence, so what happens now when this is not the case, right? So now when there's sort of this insurance against mistakes, if you actually think about, you know, the nonlinear income tax problem now, this could actually generate another motive to reduce.
Thank you.
Two comments, very unrelated. The first one, which is the spirit of your paper and Antoine's extension, is this is reminding me of Marty Feldstein's 1999 launching ETI paper, where it says, like, there's all these different margins people adjust, and the sufficient statistic is the end object, and we don't need to know the other objects, ... So I just think that I haven't thought through just while sitting here. I was rationally inattending to Marty's thing to attend to you guys. But I think it would be worth thinking through that analogy, whether there's similarities, differences, and whatever. The second one is I was also struck by what Stephanie was just mentioning in Dirk's question, which is really a way of putting it is the budget constraint. So you mentioned frequency, but like if I'm misperceiving the price high and deciding it's not worth my while to figure out the truth, if I frequently do it, I maybe perceive it as the same high repeatedly, constantly buy too little, have money left over, not have as much of the good, I buy the car and so forth. And it's been an issue since Raj's paper and even before that. So how the budget constraint is like a real world thing and not just a psychological construct. So if I'm constantly running out of money, like I have food stamps and at the end of the month, I have no food the last week, we think people have to learn, and they either learn from the fact or that shifts their attention and says like, I better go start figuring more stuff out so I don't keep screwing up or something like that. Now, I don't think this is necessarily the burden of your paper, but underlying a lot of this literature, we're sort of hand waving and closing the loop on the budget in settings, you know, going back to like some of the optimal tax literature with like ironing or, you know, average marginal. But if I'm making some of these mistakes, we would have people using some of these conventions, you know, overspending their budget 30,000 a year, year after year after year, and we're computing an optimal tax formula, assuming that behavior, which is just wildly implausible. So I do think it's a big question. I don't know how much intersect there is with your particular exercise, or that it should be your burden.
No, so I take a point on this. So it's kind of an issue that the literature has struggled with, like how do inattentive agents meet their budget constraints? Here we have a way of dealing with it. I think, you know, you could think of a world where if I keep making mistakes, I'm going to pay more attention, and that's sort of not there right now. And then I point out on the Feldstein thing. That's actually my way of reading the result here. I think so. You nailed it there. And then just to come back to Stephanie, I think you mentioned, how do I see my result given the evidence that sort of rules out invariance? I completely agree with you. But I still think this kind of like a very useful benchmark, right? Because not only it helps us organize what really is driving the departures, right? So and that's why sort of we go for what happens beyond it, and then sort of clarify exactly what assumption is driving the Pigouvian correction, if you want, versus the sort of the business as usual. Yeah.
There's only one response to what to Lewis's comment, which is, Lewis, you're spending too much time hanging out with rational. You should hang out sometimes the behavioral basis. They can go way up. But the more serious thing for you is, you know, there's a different way of thinking about what you're doing, which is attention is a commodity, except you can't tax. And I don't know how insightful that is, but that's something for you and Marios to think about. And I suspect it's something about the separability assumption that you're making, about the costs of attention, which make it okay, even if you don't tax that, can't tax that commodity. The usual formulas apply, the commodities that you can. I don't know how helpful that is, but the theorist in me says there's got to be some deeper statement like that.
So yeah, I have to, you know, think through it. I think you're kind of what you have in mind is true, right? Because if you think about the logic I explained before, this separability, like what happens away from separability, right? It's kind of the planner is using the tax to regulate the attention. So I'm trying to if I had the instrument to correct attention directly, I wouldn't play it with that margin. But we have to explore that.
Last short question.
Yeah, so I have a little bit of a more boring technical question. So the irrelevance result says that all you need to know is the demand elasticity, right? But that demand elasticity is not a structural object, right? It is policy dependent. So to the extent that the taxes themselves will increase ex post price variance, people will change their attention. And so I actually need to know how eventually the whole policy system changes people's attentions so that I know the elasticities and compute the formula. Is that correct?
Yes, so that's the yeah, so these are endogenous objects. So like to the extent that you change the the underlying tax system, the effective elasticity is going to be different. Yeah.
Right, thank you very much. So we have half an hour break and we'll be back at 3:30.
It's better.
It's not. All right, let's get going to the last session, which is broadly speaking on the intersection between public finance and finance. And the first paper is presented by Marlon, low risk-free rates and intertemporal arbitrage, 25 minutes, all yours.
Okay, thank you so much for being here. Thank you very much to Stephanie, Alec, Florian, and Dirk for including this paper on the program. I'm very excited to present low risk-free rates in the intertemporal arbitrage, which is joint work with Hal Cole, who is sitting there, and with Felix Kübler. So our starting point is the well-known observation. Oh, sorry. Oh, yeah. Our starting point is this good? It's the well-known observation that if you look at the real interest rate in the US economy and the real growth rate of GDP in the US economy, that often the real interest rate is below the real growth rate of GDP. And this well-known fact has sparked a debate on whether or not it is possible for a government to issue debt and then roll it over forever and never paying it back. And at least locally, without aggregate risk, this is possible whenever R is less than G. However, in a model with aggregate risk, things are more complicated because now there's not only one interest rate. The interest rate could depend on the state of the world, and sometimes it could be bigger, sometimes it could be smaller. Moreover, the government could have a richer set of instruments to implement such an arbitrage. And in particular, we will focus on the notion of intertemporal arbitrage. What do I mean by intertemporal arbitrage? I mean, intertemporal arbitrage is a strategy using state contingent assets that gives us money today and is self-financing thereafter. This is strictly more general than just the road for one-period risk-free bond, but it's a necessary condition because the government has strictly more options to implement this arbitrage. And so we can ask, okay, if we know that on average the interest rate is below the growth rate of the economy, does this tell us something about the possibility of intertemporal arbitrage? And the answer is no, it tells us very, very little. In fact, the answer depends really on the pricing kernel in the infinite future. So how do we price all possible states that can arise from here on out? And this is, of course, an object that is very hard to get at empirically. So what we will do is we're going to use a model to investigate this question.
Say never pay anything in the future. This is with probability 1.
Yes, this is probability 1. And what we will find is that in our benchmark calibration, such an intertemporal arbitrage is impossible. Okay, so the roadmap is I'm going to give a simple introduction, which also introduces the key objects that that are important for this talk. Then I'm going to introduce the full model we have, and then we're going to use it to study intertemporal arbitrage, and then we're going to do a policy experiment. So let's start with a very, very simple model. Let's assume there are finitely many states in the world. So there are n possible states. N can be very large, but there are only n possible states. And the states evolve according to a time homogeneous Markov chain. So when I'm standing here, there are n possible states that can realize tomorrow. And suppose there is a price today for consumption in each of these n states. So in total, there are n by n squared such prices depending on the state today and the n possible states tomorrow. And I'm going to denote those prices as a error price matrix P, or sometimes I also call it state price matrix P. And a well-known theorem tells us that intertemporal arbitrage is possible if and only if the largest eigenvalue of the state price matrix is greater or equal than 1. And this is equivalent to the price of a console being infinite. A console is just a perpetuity that pays 1 in the infinite future. Okay, so what does it mean? That means that we need to know the state price matrix, or at least the largest eigenvalue of the state price matrix, to know whether or not intertemporal arbitrage is possible. And it's also obvious that the average interest rate alone tells us very little, because there are n squared entries to this matrix, and the average interest rate is just one number. So what you want to do is you want to put restrictions. You want to use a model to put restrictions. And we're going to start with the simplest model, namely a representative agent model with constant relative risk aversion and patience beta, and let pi denote the transition probability between state I today and state J tomorrow. Then we have a closed form expression for the state prices. And what we find is that in this setting, the largest eigenvalue is always beta, independent of the consumption that we have in those states. What do we learn from that? We learn three things. So number one, we learn that indeed a model can put a lot of structure. In fact, now we pin down the largest eigenvalue exactly by one parameter. The second thing we learn is that, okay, at first sight, it seems like risk is irrelevant because no matter how risky this consumption is, the largest eigenvalue is always going to be beta. And the third thing that we're going to learn is that the representation model is a non-starter, a boring model to investigate this question. Why? Because in this setting, in the representation model, equilibrium can only exist if beta is smaller than 1. So by construction, we now ruled out that any existing equilibrium can have this possibility of intertemporal arbitrage. And this is what is going to motivate the model we want to write down. We really want to write down a model that gives intertemporal arbitrage a fighting chance. And that is going to be motivate the ingredients that we're going to put into this model. In particular, it must be that equilibrium needs to be able to coexist with the presence of intertemporal arbitrage. And this means that the model has to some extent tolerate some net present values being infinite. For example, if intertemporal arbitrage exists, the price of a disk console is infinite. So this should not prevent the existence of equilibrium. And so to deal with that, we put boring constraints on the household side. What this does is it ensures that household consumption will remain finite, even if the net present value of the infinite future labor income will be infinite. On the firm side, we will have firm exit. And what this will do is to make sure that the assets we can trade today are not a claim to an infinite payout stream, but to a decaying payout stream. And then what we want the model to do, we want it to ultimately discipline those state price matrix. So we want to we wanted to match some facts which we think inform us about the state price matrix. So what we want to match is on the macro side, the volatility of consumption and output. And on the asset price, we wanted to be able to be consistent with very low interest rates and a high market price of risk. And we're going to get this from idiosyncratic risk on the household side, together with boring constraints. This will push down the interest rate. And as a mechanism to allow us to match a high market price of risk, we're going to have segmented markets, where some households will be able to trade securities which pay out in exactly one state in the next period. So they will be able to trade a full set of aggregate state contingent error securities. And that means that those state prices are equilibrium outcomes of the model, and the model hence provides us with a theory of the state price matrix, which we can then use to investigate intertemporal arbitrage. So now let me go a little bit more into the model. We have a discrete time infinite horizon environment, and we have two types of agents. We have firms and households. There will be a continuum of firms, and there will be exogenous exit rates. The firms that exit will be replaced by smaller startups. Firms own capital and they accumulate it, and they hire labor on a competitive market. There's going to be deterministic labor augmenting productivity growth, and then there's going to be TFP shocks, AR1 TFP shocks. And the firm side can be aggregated, so what we will have, all equilibrium conditions can be written on the firm side as equations involving an aggregate firm. On the household side, we will have two types of infinitely lived household. Each type, you can roughly think of it as a kind of modified Ayagari-Grosset-Smith household. So they have idiosyncratic risk, and they will have boring constraints. The two types will be different in the assets they can trade. The larger set of households, which we will call bond traders, they can only trade a one-period risk-free bond. And the smaller set of households will be able to trade a full set of aggregate state contingent error securities. And markets are competitive, which means, and markets are competitive. Sorry, wrong button. Okay, so now let me talk a little bit more on the firm side. So firms produce from capital and labor, and we have capital adjustment costs. Incumbents survive with the probability capital gamma, and they are replaced by entrants. And here what I give you is the Bellman equation for existing firms. So the value of existing firms is the discounted present value of the aggregate dividend stream And the discount has kind of two components here. It has these state prices P. So this is exactly the price of those aggregate state contingent securities. So how do we value each of the possible states that can realize in the next period? And because some households can trade this, the stochastic discount of the firm here is well defined. Second, we have this additional term in orange, which arises from the exit. And this term, having this term is important for our model because essentially intertemporal arbitrage exists whenever the state prices P are not a contraction. But these firms are going to be traded, so this means for equilibrium to exist, the value needs to be finite. So the exit is going to give us an extra discount. But let me make one more point. So suppose that the entrants are exactly as big on average as the exiting firms. So entry-exit here is completely exogenous. Then the extra discount we're going to get is just capital gamma, the survival probability. But now suppose that the size of the entrance is 0, the other extreme case. Then the discount disappears. What does this tell us? This tells us that the crucial part is not just that firms might not survive. The crucial part is that there must be something of the future dividend stream which is not part of the valuation today. So this gives us this kind of extra discount. Okay, now on the household side, it's pretty standard. We're going to have two types of households, and here I'm going to give you this is the Bellman equation of the bond traders. So they receive idiosyncratic productivity shocks, and they inelastically supply those productivity at market wage W, and they're going to get the payout of the assets that have left periods, and then decide how many bonds to purchase. And in this case, the only asset they can purchase is a one-period risk-free bond. The measure of those will be 1 minus mu, which would be 90%. 90% of the households will be those bond traders. The remaining 10% of households are advanced traders, or sometimes they call them arrow traders. They are identical in the productivity process, but they can now two differences. One, they can trade a richer set of securities. They can trade exactly for every aggregate shock they can realize in the next period, a full set of aggregate set contingent securities. However, crucially, they are also subject to the borrowing constraints. And because of the entry and exit, there are some profits of startup creations, and we also give them the profits from startup creation. And then in equilibrium, in every period, markets have to clear. And this means that the financial wealth held by households have to add up to the value of the firm. And this has to be true state by state. So suppose that tomorrow there are 3 states that can realize bad, middle, good. And suppose that the value of the firm is lower in the bad state and higher in the good state. Now the financial wealth of the bond traders will be exactly equal across all these 3 states because the bond pays out exactly the same no matter which state realizes. And this means that in equilibrium, the advanced traders have to hold much more wealth in the good state than in the bad state. And why would they do that? They will do that only if they are compensated, meaning if the price for the good state is cheaper than the price for the bad state. And this is exactly the mechanism that will allow us to generate the market price of risk. In this otherwise very standard macro model, basically an RBC model. No, we wanted the baseline to be very standard, so there is no countercyclical volatility mechanism. It's also identical across advanced traders and bond traders. Yeah, we could modify it, yes.
Who issues the bond? Is there government?
So here in this model, we do not have a government. So essentially what you can think of is the arrow traders holding in aggregate, the arrow traders holding the whole firm and issuing the bond.
Are they in zero net supply or is there a government in the back?
There's
The answer, I think, is zero net supply.
Yes. The market clearing conditions we have is exactly this. So the total financial wealth has to add up to the value of the firm.
Because initially the motivation was that is it possible for a government?
Yes.
To
yes.
That. So
yes.
here might be the bond traders.
Yes, we're going to think of it as kind of a starting point where the government could think of, okay, what if I now fix prices and issue a little bit of that? Do I have to pay this back or not? This is kind of the exercise we're doing here, keeping prices fixed. But this is a kind of an important starting point, and we want to use it to investigate when or when not could we even hope to get this. Okay, so for the calibration, we fix most parameters to to values in the literature, our relative risk version is 5.5, which is within the realm where households could still leave their home. And then we have two parameters that we will vary. The two parameters that we will vary is the patient's beta and the adjustment costs gamma, the xi, sorry. We're going to choose these two parameters because they are related to two things that we want to vary across different calibrations of the economy. Number one, the interest rate, which is most directly related to the patients, and number two, the market price of risk. And the risk in this economy is very much governed by the adjustment cost on capital, because essentially it makes the value of the firm more steep between different realizations of the shock tomorrow. And varying these two parameters, we can generate different combinations of the average interest rate and the average market price of risk. And our baseline calibration is going to be such that on average, the interest rate is 0.8%. So the long run growth rate here is 2%, and the market price of risk is 0.5. Okay, and our next to the things that our model kind of matches by construction, the model we get at the baseline calibration is consistent with a smooth interest rate, with a standard deviation of aggregate consumption growth, and with the price earnings ratios, despite this very low interest rate. Okay, now we want to study this question of intertemporal arbitrage. And to do that, I'm going to take a moment to connect the theory we had to the quantitative model that I laid out. So in the theory part, we had finitely many states, and we saw that what really matters is the largest eigenvalue of the state price matrix P. And that is equivalent to the price of a gross console being infinite. So I presented a very simple example without growth. So there the console just pays 1. Here in this setting, the equivalent result, the console pays 1 in kind of gross normalized units. And in the model, we have this very large state space. So it includes the TFP shock, it includes aggregate capital, and then we have these two distributions, one for the advanced and one for the bond traders. And these two distributions, they really, really move around a lot in this model. So the first approach we can take is to just compute the console price, because once we solve the model, we know that for every state of the world, what are the prices, and now we can price any asset that is not traded in equilibrium. So we can take the price we get and compute the price of the console and check whether it's infinite. It's of course important that this console is not actually traded, because if it were, then equilibrium would again rule out an infinite price of that console. And then a second approach, which I will not go into much detail, is whether we can discretize the state. And we can discretize it very, very, very finely. So n could be, for example, all the double precision numbers I can store on my computer. And then we could directly apply the largest eigenvalue criterion. The only important thing to know is that these two criterion give the same result as we would expect. And yes?
Price of the console is depending on today's state, though, right?
Yes.
So you would have to ensure that this is finite for every possible state that's visited in equilibrium, right?
What we are going to do in practice, we're going to compute the price on the ergodic distribution, and then we're going to take the average. But if it becomes infinity, we do very, very long simulations. We do like 50,000 periods of simulation. And if it becomes infinity, you will see it's very clear.
You can take a long finite horizon economy. So they go
Yes.
up infinity and see what converges.
Yes, exactly. Yes, okay. So now I hope you're as excited as me. The result is on the next slide. So what we are doing here, we're choosing different values of patients and different values of the adjustment costs. So we have different calibrations of the economy. And then at every of those economies, you're going to compute the average interest rate. So you can see on the horizontal axis, the average R minus G in the economy. And we're going to compute the average market price of risk in this economy. And then we're going to also compute the console price. And you can see two regions. So the red region is where intertemporal arbitrage is not possible. And this blue region is where it is, here intertemporal arbitrage is possible. And in the blue region, it's impossible. And the color within that region gives us the price of the console. So we can see holding the market price of risk fixed. As we decrease the interest rate, the price of the console goes up until it goes to infinity. And what we see here is that at which interest rate we can implement this arbitrage really depends on the market price of risk. If the market price of risk would be as low as 0.25, then already at R minus G equal to minus 1%, this interval arbitrage should be possible, but at the baseline value of market price of risk 0.5, it's impossible even if R minus G is as low as minus 3.5%. And the benchmark calibration is this cross here. So this is the benchmark market price of risk, this is the benchmark interest rate, the cross is the benchmark calibration. So now let me give you a little intuition of why is it. So it seems very clear the market price of risk is pushing against the possibility of arbitrage. Why is that the case?
What are you varying? I mean,
I'm
what
varying
parameter-
two parameters, the patience and the adjustment costs. Yes, but I'm plotting it in this space because that is the one that is has meaning outside the model. Yeah, yes, remember the rep agent result, the largest eigenvalue is always beta. So this is similar here. It's not exactly the same, but the cutoff really depends on beta. But if you calibrate it, the beta you infer to match a given interest rate is the lower, the more risk you have, which is very intuitive. So that's another way you can think about risk. What risk does here, it makes you infer a lower beta for each given interest rate. And the rollover in the end depends on beta, but not one. So here it's of course, but it's mostly it's beta. Okay, so now what is it that the market price of risk is pushing against this? So consider what the government wants to do. I'm standing here, yes, and I have a certain debt. Now I want to roll it over. I want to implement arbitrage. And now suppose I have two states tomorrow, low interest rate, high interest rate. What I want to do is I want to roll over more of my debt into the low interest rate state. I don't want to wake up with a lot of debt in the high interest rate state. And what does the market price of risk do? The market price of risk tells me exactly how much more expensive is one state versus the other. And it turns out that the higher the market price of risk, the cheaper is the low interest rate state. So this means the less money I can get today for issuing debt against that state. And that is why it is pushing against the possibility of internet arbitrage. Yes. Okay, and now given we have this kind of calibration that looks kind of reasonable in the settings where the interest rate is very low, and with the R minus G as low as in the benchmark calibration minus 1.2%, we may wonder about dynamic efficiency and whether capital is too high. Whether it would be good if the government can issue some debt and reduce the level of capital, whether that would make households better off. And here I'm going to do two things. So we don't want to introduce a full fiscal system into the model. So we're going to do a very simple experiment that gets at that kind of question. We're going to relax the borrowing constraint. Relaxing the borrowing constraints will implicitly increase the supply of risk-free assets. And then we're going to compute the interest rate, which goes up, the level of aggregate capital, which goes down, and then we're going to compute welfare equivalent consumption. If the number is smaller than 1, welfare decreased relative to the baseline no borrowing constraint. So here what we find is that, and I should say, this ergodic steady state to ergodic steady state comparison, it's not a transition path. We could do it, it's just that I didn't do it yet. We could do it. So the second thing we can look at is dynamic efficiency in the sense that could we decrease investment today by a little bit without having to decrease consumption in future states of the world? And there's a well-known statistical criteria that tells us whether or not this is possible. And we have a modified version for adjustment costs, and the answer for all our calibrations is no. We cannot do that. Of course, this is not an optimal debt exercise. It's not an optimal level of capital exercise. There are other papers, including by people here, that deal with this issue. That's not what we are doing here. It's a very local question, given we have this kind of interesting calibration, which yet looks quite a bit like what we see in the real world. Okay, so to conclude, what we have is a tractable production economy with heterogeneous agents, which is consistent with facts on the macro side and on the asset pricing side. In particular, we designed this model to give internet arbitrage a chance. And then we're going to use it to provide us with a theory of state price. And what we find is that risk pricing is very important. So aggregate risk is kind of a first order important for this question. And what we find is that in the benchline calibration, internet arbitrage is not possible. And with a baseline value of a market price of risk of 0.5, even at R minus G as low as minus 3%, it is impossible. There's more things in the paper. In particular, we do robustness with respect to permanent shocks. So here we had kind of a deterministic growth with transitory shocks around it. We get the same picture with permanent shocks instead. And then what I also think is very nice here, which I didn't have time to talk about, but we have what I call a simulated path Grosser-Smith algorithm. So you might have thought about it, but we have these two distributions and we have to solve jointly the aggregate equilibrium conditions, which is not only market clearing, but also the firm has to make optimal choices together with the household problem. And we have a way to do all of this only on simulated part of the economy, which I think is very important as soon as you have several Crystal and Smith summary statistics. Okay, thank you so much.
All right, right on time. Discussed this Wendy Morrison.
Thank you. Well, thank you so much to the organizers for allowing me to discuss this very interesting paper. So I think this was a really nice paper, and in my mind, it's going to make two big contributions. They solve this very rich but ultimately tractable production economy model that hits key macro moments and finance moments, and they use this obviously as a laboratory to study debt rollover. One really nice feature about both having borrowing constraints and having these finite life firms is they're going to be able to compute equilibria even when the arrow to brew prices are not summable. So that's very nice. And then Marlon didn't talk so much about them, so I'm going to focus a little bit more on them in my discussion. They also start the paper with some analytical results, which I think really help interpret their verdict. And the big takeaway is that in their laboratory, debt rollover is not possible, despite sort of this naive criterion that average interest rates are lower than average growth rates. So my plan for the next 10 minutes is I'm going to try to motivate all of these sort of rich model ingredients that they include. And the way that I'm going to do that, which is pretty typical for a discussion, is I'm going to try my hand at getting average interest rates below average growth rates and also violating their spectral radius criterion. And I'm going to do it in like a very stupid way, in a very simple, stupid model. And the model that I generate is going to produce these sort of crazy counterfactual finance moments or sort of macro moments, and that's going to sort of motivate why they need all of these rich ingredients. And I think along the way, hopefully, as we go through my very stupid model, that's going to give some intuition for their theorems that help interpret their results, especially sort of the importance of beta, which Marlon mentioned, and then I'll end with some comments for the authors. So this is a paper about debt rollover. So Marlon talked about a console. In the paper, they phrase it in terms of a growth console. So I'm interpreting that as a fiscal authority that starts with some initial debt. And with the growth console, they want to maintain a constant debt to GDP ratio. They don't just want to keep rolling over debt. But if you prefer just the rollover interpretation, you can set this G to 0 if you'd like. But they want to be able to do this, and they want to never, ever run any surpluses. So they never want to tax their constituents in order to pay for this debt. And so if you plug this fiscal policy into the lifetime budget constraint, you'll get this condition once you sort of run it forward, that essentially the expected present value of the future debt way off into the future, this A term here, can't vanish to 0. And so when you put this in terms of like the growth console, the price of this growth console, so Marlon talked about issuing $1 every period. This is issuing 1 plus G every period. When we stack those all together to get the price of this console, A not vanishing is the same thing, I guess, as the price of this console being infinite. So they're trying to assess whether or not this is possible. And it turns out you can write that A term, the thing that can't vanish, in terms of a big matrix of the arrow prices. So think about a matrix whose ijth element is the state price of a single dollar in state I of a dollar in state J. And so their characterization or their first theorem is that rollover or sort of intertemporal arbitrage, meaning this growth console having an infinite price, is the same thing as the largest eigenvalue of this matrix being greater than or equal to 1. And so what does this have to do with R versus G? Well, you can think that if we were in a model without any aggregate risk, then this matrix of prices would just collapse down to a scalar. And when you solve out for the largest eigenvalue of the scalar, it's just 1 plus G over 1 plus R. So the big question of the paper is, can we kind of fool the R as greater than G criterion? So can we generate a model in which a naive person looking at R and G might conclude that debt rollover is a go, but the spectral radius criterion is going to fail? So I'm going to try to do that in this very dumb model. So I'm going to write down a representative agent endowment economy model. There's going to be two states, a normal state and a bad state. In the normal state, the consumption endowment is high. In the bad state, it's low. And I'm going to assume that there's a bond that's traded, but this endowment can't be stored. So I'm going to put sort of what I think are pretty reasonable parameters in this, at least for preferences and growth in this silly economy. And I'm going to try to find parameter values. And by that, I mean, I'm going to ask Claude to try to find parameter values that the naive criterion is going to pass. So I'll have Claude run this economy, 100 years, do 100 simulations, and collect the average interest rates and growth rates. And I get that the naive criterion passes, but their spectral radius criterion is going to fail. And that relates to their second analytical result, which is really that average interest rates are not really going to tell us much about their spectral radius criterion. So the lowest realization of the interest rate and the highest realization of the interest rate are going to bound this spectral radius. But I've sort of cooked up this example where those realizations are going to lie on either side of one. And so these averages themselves are not going to tell us anything. So that's just sort of this numerical example, but what's going on intuitively, what's going on under the hood here. And this leads me to their third analytical result, which is really about the primacy or the importance of the beta parameter. So recall what we're trying to do is we're trying to come up with a world in which this A term, this expected present value far out into the future is not going to vanish. So I'm going to go ahead and I'm going to derive this term in my stupid baby model. And as we keep, applying our matrix of arrow prices and we roll it forward, these realizations as we go between, in the first state are going to cancel, in the second state they're going to cancel, et cetera. So we end up with an expression that looks like this. And the key idea here is that because I have these kind of nice properties that are in their theorem, so I have the rep agent, I have nice preferences, and importantly, I have transitory shocks, so detrended consumption is going to be Markovian. There's only so big the difference between these terms can be. So in expectation, let's imagine we're in sort of the most different possible states. ZT and C0 can only be so different. And so this term here is going to be bounded. So another way of thinking about that is with transitory shocks, as we bounce between different states, the effect of those changes is not going to accumulate. But the one thing that is going to accumulate in this model is the beta and the G. That's going to sort of accumulate as we go forward in time. And so really the verdict of whether or not this thing vanishes or not, and therefore whether or not the growth console has a finite price or not, is really about this sort of growth modified beta, this beta tilde here. And that's exactly what's going on in my example. I've sort of cooked it up where essentially I've added all this aggregate risk, and that aggregate risk is going to push down the observed interest rate, but I can get a really low interest rate without having to go too high on the beta. So you can almost interpret their paper as searching for a model in which can we get a low average R? Can we get a low interest rate that's going to kind of fool the naive R versus G criterion without having to resort to a high beta? Resorting to the high beta is the thing that's going to give us the infinite rollover. So in my example, my stupid example, you might think, well, Wendy did it in like a super simple, 5-minute rep agent economy. So why do we need all of this, interesting machinery? My example gave me R average less than G average with rollover and feasible, but the aggregate risk that I needed to pump into my stupid model was like insane. So I tried to hit the about 1% interest rate that they have in their calibration. But doing that created these like insane aggregate moments in the first case. I try one more time with sort of like a disaster risk scenario where maybe instead of a frequent mediumly high recession, let's do like a catastrophic recession, but that occurs only a very small amount of the time. So when you run the economy, you might never realize the disaster state. So the aggregate R and the aggregate consumption might not be that variable. So we have a typical sample that's calm. So I'm not going to violate the aggregate moments, but I'm going to have this like insanely high market price of risk. So really the achievement of their paper is that they're going to be able to sort of fool the R minus G criterion. They're not going to have to resort to a high beta. That's how they're going to sort of not get the rollover. But they're also going to hit realistic variance in aggregates and a realistic marginal or market price of risk. And this is the set of ingredients that they use to get that. So they're going to hit all of these key moments in the data, and they use this set of ingredients to get that. So I'm going to speed through the discussion of the ingredients because I think Marlon already did a good job of that, and just move on to my comments. So my first comment is that, you know, we just saw it, I just did it. It's possible that a very naive model can achieve this no rollover despite R being less than G result. But it's rejected by counterfactual macro moments and counterfactual finance moments, and so we kind of discard that. And the authors are going to propose this segmentation where only 10% of the traders are trading anything other than short-term bonds with these capital adjustment costs. And my question is, we kind of discard my stupid models because they are sort of disciplined by the macro moments and the finance moments. But I'm just wondering if this channel, which the paper really relies on, is itself also realistic? Is there a way to discipline it with other moments in the data? So is it possible to validate this empirically? So the adjustment costs are going to generate this sort of market price of risk for these advanced traders, but that's also going to imply something about the empirical investment elasticity. So can we compare the elasticity of investment to the interest rate to the one in the data to see if these adjustment costs are sensible? And then also, as a result of this, to get the sort of high-ish market price of risk without crazy volatile aggregate risk, the trader's consumption volatility is like 4 times the volatility of other agents in the model. So I'm wondering if there's a way to kind of like validate or discipline that. And then, sorry, I'll conclude very quickly, but my last comment is Marlon talked a lot in the paper about the welfare effects of debt. And I'm just wondering, a fuller decomposition of the welfare impact of increasing debt could be helpful. So the paper currently focuses on, or they interpret their results through the lens of how does debt potentially relax borrowing constraints. Debt's obviously going to crowd out capital, and that's what they're talking about with the capital overaccumulation result as well. But it's also going to change factor prices, and that's going to have a dampening effect on the welfare cost of uninsurable labor income risk. It might amplify the welfare cost of capital income risk. It's also going to redistribute towards the advanced traders who are capital heavy rather than labor heavy. And so I think these channels could potentially be very big and might be contributing in the background to the welfare numbers that you're getting. And with some of the work that I've done with Philip, we think we have a framework to potentially decompose the contribution of these forces alongside the kind of typical dynamic capital trade-off. And that might really help both interpret your welfare results and also figure out how sensitive they are to some of these like adjustment cost parameters as well. But I really enjoyed reading the paper, and thank you so much for the opportunity.
All right, thanks a lot. Maybe you quickly respond and then we collect questions.
Okay, thank you, Wendy. This was a great discussion. I think I learned something more about the theorems in our paper. My first kind of comment is that, of course, it's not a stupid model. It's a wonderful model, and I think there's a lot to be learned from that model. My second comment is that if we make some simplifying assumption, we can get closed form solutions similar to what Wendy did, how the market price of risk is really pushing against rollover. And from the baseline example, it may seem that this is really crucially hinging on the transitory shocks. But this works exactly the same way for growth shocks. That's my second comment. Then one thing that I would kind of slightly disagree. So it is not our goal to achieve a low beta with rollover. It was more like the opposite. What we wanted is we want to have a model that even has a chance of equilibrium existing in a setting where the world doesn't, where it would be possible. So it's not, I feel like in terms of what we try to do, it was not kind of a little bit different. Then about the adjustment costs and if the number is crazy. So in this model, you can think of varying the adjustment costs as going from kind of a production economy to an endowment economy. In the limit where the adjustment cost is infinite, output is equal to consumption because you can never adjust anything. So one thing that disciplines it is kind of the volatility of aggregate consumption. And this is kind of in line with the data at the benchmark calibration. Of course, the higher we make the adjustment costs, the larger this consumption volatility is going to be. Lastly, about the volatility of consumption of the advanced traders, which is 4 times larger than of bond traders. This is true only as a group. So if I treat the advanced traders as a group, so integrating out the idiosyncratic risk, then their consumption is much more volatile. For an individual trader, it will not be 4 times more volatile because they have much more wealth. So they're not exposed to idiosyncratic risk as much. And the bond traders, while their group has pretty stable consumption, they are much poorer and they are much more exposed to the idiosyncratic fluctuations. I think that was all I have to say. And thank you so much. It was a great discussion. Thanks.
First of all, you set a very high bar, which given my situation, in the next talk I don't like. So that was an excellent discussion. Exactly, Marlon hit it. It's basically a mechanism for concentrating aggregates. Yeah. And so then, we can have people who say, hold, just hold the whole portfolio, debt and equity and support the issuance. Those people are neutral, and it's basically how much aggregate risk is being created by the bond only. We've had a hard time measuring that. If you have an idea how to do it, I would love it. Excellent discussion. Thank you.
All right. Other questions? I mean, I have one. So as a naive person, not knowing too much, how do you get bond prices and market price of risk right without Epstein's in and with a risk aversion that's relatively limited?
Yes.
That seems.
That's a great question, and that's a combination exactly. So given 2009 econometrica, what this tells us is you need 2 things. You need adjustment costs on the firm value to make the firm risky in the first place, and then you need something second to kind of concentrate that risk a little bit, which in our case is the segmented markets. So there's a small set of households that basically have to hold all the financial risk. And so for them, the financial risk is very risky. Their consumption is not as risky relatively because they are rich, but they are exposed to those aggregate shocks.
But then in a way, it's absolutely crucial what Wendy said. I mean, you need some empirical discipline to see how volatile these people's consumption is, right? I mean, if this is very counterfactual, then sort of this mechanism.
Yes. I mean, but we do see it as an achievement of a very standard macro model with very standard preferences to get this high market price of risk. So that's something we like.
Part of the answer to Pat's question may be, as we get more of this Norwegian and Swedish data on individual portfolios and incomes and so on, maybe we'll get, because I'd like to think that a lot of these rich households are in some sense households that have in the bad language of the literature, entrepreneurs, but really people who have concentrated portfolio risk, and might be useful. That might help.
I'm going to express some pessimism on that. So first of all, what you want to think about is if you look, we have another paper with Hanno and you, where we looked about the fact that people are very inactive. If we go over to Wharton Finance and ask them how many of them adjust their portfolios and their 401ks and all that, the answer is Abel told me he never adjusted it. And so what you're really looking at is a very small subset of people who are actively adjusting their portfolio in response to the pricing of risk. I'm very pessimistic about that.
Other questions, concerns, issues? Well, if not, then it's up to the last paper of the session, Paul Belder is presenting. Thanks a lot.
Some trading.
All right, 25 minutes, just take it away.
All right, so hi everyone, Paul here. It's a pleasure to be here today presenting my paper on capital gains taxation and asset price volatility. Dirk might not remember, but several years ago when he came to Autonoma, we already had a conversation about what was back then a very preliminary idea. So this is a way of updating him on how it turned out. So, a long-standing question in public finance, as formulated by Somers in 1948, is whether a capital gains tax accentuate fluctuations in asset prices and promote economic instability. So there are two opposing views. The conventional view holds that realization-based taxes are destabilizing. Right? The idea is basically this: by taxing gains upon sales, taxes might discourage investors from selling appreciated assets in boom, and they may accelerate the sale of depreciated assets in bust, amplifying therefore price swings. There is also another view that argues in the other direction. So by reducing after-tax expected returns, taxes can dampen the response of prices to shifts in expectations, thereby stabilizing markets. Which force dominates remains unclear. So recent econometric evidence from Dye and co-authors supports the stabilizing view. What did they do? They exploit differences in tax exposures around the 1978 and 1997 tax reforms, which affected basically long capital gains taxes, and find that volatility increased by approximately 9 to 18%. However, this reduced form evidence identifies the total effect, but not really the mechanism. So it cannot tell us much, how much of this comes from changes in trading frictions, how much of this comes from the transmission of expectations into asset prices, or potentially other mechanism. So answering this question requires a structural model, but this is difficult because realization-based taxation creates asymmetric trading incentives, no trade region, path dependence, and so on. Right? So, a broad view of the literature would be that existing analytical models are highly stylized, while quantitative models with realistic capital gains taxation have generally focused on portfolio choice rather than equilibrium asset prices. So the goal of this paper is to explore this issue in a general equilibrium quantitative model. For that, I will proceed in two steps. So first, I'll develop an analytical model that can be viewed as a microfounded version or extension of Stiglitz's 1983 framework. And in the model, I'm going to characterize in very detailed way, both mechanisms. And I will emphasize that for understanding general equilibrium, how expectations are formed is really key to understand the effect of taxes on volatility. Then I move to a quantitative model, which I will estimate using US stock market data. And I will use it to quantify the effect of capital gains tax cuts since 1975 in the US stock market valuations volatility. So the headline result would be that the total effect is somewhere around a plus 35% increase in the volatility of the stock market. And most of it comes from the increase in the pass-through, which is this higher sensitivity of prices to investors' beliefs. Then in the latest part of the talk, I will cover two policy experiments. First, I will implement a revenue neutral regime change from realization to accrual-based taxation. And I will show that the model implies that will reduce volatility by about 20%. And then I will include two supplementary small taxes, one on unrealized capital gains, the other one on trading. And I will show that the model suggests that a small tax on unrealized capital gains is a more reliable tool to regulate, to reduce excess volatility in the stock market. Let me skip this and let's go to the model. So there's going to be an economy in discrete time, two states of the world, high and low, boom and bust, as you prefer, that follows a Markov chain. There's going to be a single risky asset, S, that pays dividends, which are state contingent. So in the good state of the world, DH, in the low state of the world, DL. And there's going to be a tax, tau, which is a tax on realized gain In this section, I'm going to simplify some of the things. I will recover them in the quantitative part. One of the simplifications is that for now, there are no carryover losses. So the budget constraint looks like this. The left-hand side is very standard. You've got consumption and savings. In the right-hand side, there is a big endowment, which is not state dependent. Then there are the payoffs to your stock holdings. And then there is this red element in here, which tells you the following. If your current stock holding SIT are lower than your previous, if you sell, if your SIT is lower than your previous stock holder, and if your gains are positive, so you will pay taxes. And finally, you will get a tax rebate, right? So investor problem is a simple consumption savings problem subject to this budget constraint. An element that I will discuss more later is that agents will will take expectations using their subjective probability measure. I'll explain that more in a second. And the truly relevant constraint is that short selling is not allowed. If I allow short selling, there is a well-known result by Stiglitz that you can basically undo all the effects of taxes.
Just a clarifying question. The only risk is the aggregate risk you've given?
Yes. So I'm using internal rationality following Adam Marcet. This will be especially important when I show you general equilibrium effects. The only idea of internal rationality is that agents are perfectly rational, so they solve this problem subject to the subjective views of the world. Right. So for this analytical part, there will be two groups of investors, A and B, that they agree to disagree about the state transition probabilities. So group A believes current times last longer, and that makes him optimistic in the boom and pessimistic in the bust. Therefore, this is the motive for trading. This can be microfounding using Bayesian learning. The price objective probability distribution, I will specify them later. For now, just assume they have abundant support and they are Markov. And for the analytics, I'm going to assume risk neutrality and that the basis price, the cost that determines the basis to compute your capital gains is equal to the previous asset price. I will be very specific when this plays out. So the first object that I want to pay attention to is the stock demand. So I'll move quickly over the dynamic programming setup. The investor state includes the current aggregate state and price, tax basis, the transfer, and her inherited stock position, right? So given this state, she solves a standard recursive consumption portfolio choice problem. So the key object is QTI, which is this object over here, which is the subjective marginal valuation of one additional share. So as it standard is the discounted expected payoff from carrying the share into the next period. Without taxes, this is the standard dividends plus next period price. Right, but the interesting thing is in red again. So if her valuation is below the proceeds she would receive after selling and paying the tax, she sells her position. So the interesting case is the region between, let me explain this again. So these are the next period payoff, right? So you have the dividend plus its future market value, net of capital gains tax that they will pay. So with this Q, okay, this is not working. Right. Okay. Thank you. So the stock policy function looks like this. So if the subjective valuation, this QIT, is above the current purchase price, the asset is undervalued from the investor's perspective. So she will buy, right? Second, if her valuation is below the proceeds she would receive after selling and paying the tax, she will sell her position, right? The interesting case is the third one, which is the region between these two thresholds. So here the investor would not buy at the market price, but she also doesn't want to sell because selling would trigger paying taxes, right? So she therefore keeps her initial position. So the realization-based tax separates the buying and selling threshold and creates an endogenous no-trade region. So without taxation, the two thresholds coincide, With taxation, investors can remain locked into appreciated position even when their valuation is below the market price. And this is exactly the picture that illustrates that. So consider that prices are above your cost base and they expect to have positive gains in here. If prices are high enough, they would like to sell everything to hold nothing. If they are low enough, they would like to say as much as they can. In the middle, we have a trade region where they are in some of these, in this interval, depending on their previous holdings. So we have just seen that the realization-based tax creates a no-trade region. So here I want to characterize how large this no-trade region is. This first line simply restates the inaction condition. The investor doesn't trade when her valuation lies between the full market price, which matters for buying, and the after-tax sale price, which matters for selling, right? So now focus on investor which embedded gains. In this case, I can rearrange the condition and express the no-trade region as an interval of market prices. So this next expression gives the width of this interval, and it depends on two objects. First, the tax rate, and second is the difference between the investor's valuation and her tax basis, which measures the size of the embedded gain relevant for the selling decision. So this derivative below establishes the individual lock-in result. Holding the valuation and basis fixed, a higher capital gains tax unambiguously widens the no-trade region, right? So economically, the investor becomes willing to tolerate a larger gap between the market price and her own valuation before selling, right? And well, you can see that this effect is state dependent, right? It's stronger when the valuation is far above the basis, which is particularly likely after sustained increases in prices, typically during booms, right? Very good. So the next step is to translate the individual lock-in effect into an equilibrium implication.
At this point, you haven't said anything where the PIB, the expectation of the price is coming from, right?
So we were still.
Will it respond to the tau in particular?
Yeah, under some conditions, yes. I will discuss that. So let's look a little bit into the equilibrium implication of this. So I'll go to general equilibrium. In the model, I have a lot on general equilibrium. For this presentation, I wanted to do an intermediate step covering a temporary equilibrium. So I'm going to assume beliefs are fixed for this next slide. So suppose the price is determined by the valuation of the marginal buyer, M here. So, this buyer is just indifferent at the market price. And now consider an incumbent seller with positive embedded gains. So this seller is willing to trade only if the price she receives after paying the capital gains tax is at least as high as her own valuation of keeping the asset, right? So substituting the marginal buyer's valuation for the market price gives the key disagreement condition here. So in the left-hand side, you have the difference between the buyer's and the seller's valuation, right? This QMT, QST. The right-hand side is the additional wedge created by the tax. And it is therefore kind of the minimum amount of disagreement needed to induce trade. So the derivative in here shows that this minimum disagreement rises with the tax rate. So provided the seller has a positive valuation relative to her basis. So the tax selects which investors are able to trade. For instance, a moderately optimistic buyer might no longer value the asset enough to compensate the seller for realizing the gain. Conditional on a sale taking place, the marginal buyer must therefore be more optimistic. So the tax kind of acts as a selection device on marginal beliefs. When trade occurs, prices can reflect more extreme beliefs, potentially widening the distance between boom and bust prices. Now I turn to the second mechanism. Well, okay, the pass-through effect. So for lock-in, I held the investor valuation fixed and examine how tax changes the trading threshold. So here I will hold the future trading configuration locally fixed and ask how the valuation changes with belief, when belief change. So this first expression introduces a simple belief shift. The parameter in red shifts the investor's entire subjective distribution of future capital gains. So an increase in this parameter means that the investor becomes more optimistic about future price appreciation. So this next expression shows how this belief enters the investor's marginal valuation. So the investor's values the future dividends and future result price, but she subtracts the capital gains tax that will be due if the two conditions that I explained below are satisfied, right? The future price is above her tax basis and she sells the assets. So this derivative in the next line summarizes this trade-off. Away from points at which small belief change alters these future trading decisions, the sensitivity of valuation to beliefs equal the discount factor multiplied by 1 minus tax rate times this realization probability, this math called R here. So this R is the joint probability that the investor has a taxable gain and sells. So it measures how exposed the marginal future payoff is to capital gains taxation. If that probability is 0, the tax doesn't affect the pass-through locally, right? So if it's positive, this is the interesting thing for understanding the effects of the tax. And the cross derivative formalizes kind of the intuition here. Increasing the tax rate reduces the sensitivity of valuation to investors' capital gains beliefs. So this is what I call the pass-through effect. Now, moving from the sensitivity of marginal valuations to prices is particularly direct in this example. So before the marginal buyer prices the asset, the equilibrium price is therefore equal to the investor's marginal valuation. For the marginal buyer, the future tax basis is the current purchase price, right? So substituting that into the valuation equation gives this temporary equilibrium pricing equation that you have there. And in here, if I repeat the next step as before, it's immediate to see that this cross derivative will be non-positive, right? It's just one extra step. The only thing that changes is that the fraction in front of the math color. So the idea is this, that higher capital gains taxes weakens the pass-through from beliefs to equilibrium prices. This was a temporary equilibrium. What if I move to general equilibrium? I won't have time to show you all the equations, but basically in general equilibrium, the effect depends a lot on how taxes form price expectations. In the paper, I show three kind of examples. First, imagine they know the pricing function, so this will be a Bayesian rational expectations equilibrium. In this example, prices in each state are constant. You have a price in the highest state, a price in the lowest state. They don't fluctuate. Beliefs in each state don't fluctuate. So the only effect that operates in this extreme example is the lock-in effect. Now, in the paper, I show an intermediate case when they know the pricing function, but they have imperfect information about the dividends. So beliefs in each state fluctuates a little bit, and then there emerges this pass-through as a static effect. I think a more interesting example is this one in here, where the pricing function is unknown, for instance, because they just don't know each other beliefs, and they learn about prices. So in here, the pass-through effect becomes dynamic. In this economy, there would be a feedback loop that generates excess volatility in markets, right? Higher expectations generate higher demand, higher prices, then that feedback loop into higher beliefs, and taxes are eating part of this pass-through in each round. So this will stabilize prices, this will stabilize beliefs. The overall effect is ambiguous. Lock-in raises the between-state volatility, pass-through lowers the within-state volatility. So it's a quantitative question that I'll take in a quantitative model. So the quantitative model is exactly the model that I show you, plus a bunch of things. So there will be stochastic taxes, carryover losses. The basis price is no longer equal to the previous price, so there will be an accumulated gains here. They are relative to an average historical basis. There is risk aversion, a continuum of states of nature and growth. There is a largest population of heterogeneous groups. There is learning about both dividend and price growth. And I'm gonna include shocks to the discount factor and stock supply that will help me to introduce stock repurchases and the decline in sales rate. So let me show you a little bit how the model fits the data. This is the data I'm gonna look like. You have the kind of standard statistics in the excess volatility literature. So mean PD, mean stock returns. I'm gonna have a bunch of second moments here. This is the variance of the log PD ratio, the Campbell share decomposition, standard deviation of returns, the persistence of the PD ratio. I'm including some extra statistics. This is the 1 year ahead response of the PD ratio to a price shock today. So this also helps to measure volatility in asset markets. This is one set of statistics. The other statistics I'm including is this tax elasticity of realization, which is kind of the central the central statistic in the literature on capital gains taxation. So these are the data. This is how the model is estimated via the simulated method of moments. The bottom line is that the model fits the data pretty well. I'm particularly happy that it fits very well this long run tax elasticity of realization. And even though this is excluded from the SMM, it also matches well this elasticity at the medium run. So it seems like the term extract of these elasticities is well captured by the model on top of all the statistics related to the volatility in the stock market. Sorry, this is multiplied by 100, so it's minus 0.6. Yeah. So now with this estimated model, let me go to measure the effect of tax cuts. So I'm going to call still the model statistic under the historical tax path. And I'm going to build a counterfactual fixing these long capital gains taxes to the highest level in the sample, which was at the beginning, which is around 16%. Right? And I'm going to take the difference between these two trajectories. And I'm going to normalize that by the observed statistic. This is how it looks, for instance, for the variance of the log PD ratio, which is the central statistic here. So the model generates 99, about 20. If I keep taxes at a high level, it's about 13. So the effect of tax cuts in the model is around 35. So I wanted to decompose the model between the two channels. So for that, I'm simulating the same economy, reducing the trading frictions, and that gives me an economy that taxes capital gains without this friction. I measure the pass-through, and then the lock-in is a residual. So this gives me this decomposition of the pass-through. Lower taxes increase the pass-through sensitivity of prices to believe by 50%. The residual is about 15%. So the net effect is 35%. This is a historical calibration. What happens if I, instead of calibrating the stock supply shocks to match the series of stock repurchases, I calibrate them to perfectly match the PD ratio here. So this is what the model spits out. You can see that the volatility of the aqua line is much lower than the data. Finally, let me have a couple of words on the new tax instruments here. So first, I'm going to play with a tax on unrealized gains. Right, I'm gonna keep the fact that you only pay taxes on positive gains. The key thing of this is that they don't distort the selling decision, so there is no lock-in effect in this economy. But the pass-through effect will still be there. So this is a way of getting the pass-through without getting the lock-in effect. On the other hand, I'm gonna play with a financial transaction tax. This is a standard that affects trading. So this is very similar to a tax on realized capital gains in the sense that this is going to have the two effects. So it distorts trading, there's going to be the lock-in effect, and there's going to be also the pass-through effect. So experiment one, I'm going to implement a revenue neutral accrual capital gains tax, which I'm going to, in each period, I'm going to replicate the amount of revenues that I would get if I would implement the observed realized tax. Let me show you how it looks like. This is in each period how tax on realized gains would give you the same revenues as a tax on realized gain, right? So the effect, there are two things I want to say. The tax is relatively small, and it reduces volatility in the stock market by about 20%. So it goes along the lines that a tax on a lower tax in a less distortionary way kind of pays out, at least in terms of lower volatility in the stock market. The second experiment is, okay, let's assume that we keep the current system with realization-based taxes, and we include a small supplementary tax either on trading or on unrealized gains. So let me show how it looked like. First, the FTT is the tax on trading, the CGTA is the tax on unrealized gain. So as you can see, the tax on trading has non-monotonic effects. It seems that if it's relatively low, it can reduce volatility, but if you get it wrong and you put it a bit too high, increase volatility. Importantly, the reduction in volatility is mostly driven by the reduction in the persistence of the PD ratio. If I compute the variance of the changes, the short-run changes in the PD, this doesn't go down. Instead, if you look at the tax on realized gain, it reduces volatility consistently along all the relevant statistics, right? So let me wrap up here. So capital gains taxation affect asset prices through these two opposing forces, lock-in versus pass-through. In the estimated model, the pass-through channel seems to dominate. So the kind of headline result is that capital gains tax cuts since the 70s increased the valuation volatility in the stock market by about 35%. And you know this final comment that since Keynes, at least since Keynes, economists have advocated for financial transaction taxes as a way to curb excess volatility. The model would suggest that a supplementary small tax on unrealized gain might offer a more reliable alternative. That's it. Thank you.
All right, discussant is Helco.
There's the one. Okay, thank you. All right, well, thank you for asking me to discuss this paper. You know, this is a very interesting and challenging paper. The main point, obviously, we got the fall in capital taxes since the early 1980s is a first order cause of the rise in asset price volatility. And, you know, the method that Powell is going to use, you know, breaks with the standard rational expectations machinery, following in the lines of some papers by Adam and Marcet, along with some subsequent papers. I want to admit that I had not previously read those papers before being asked to discuss this. So, you know, there was a lot to try and, you know, figure out here. And so, you know, the challenges this paper faces is how do we generate plausible asset prices with what I'm going to call a semi-representative agent? You're going to see using belief differences, how to generate strong transaction motives so the capital gains taxation bites with limited heterogeneity. And then we got to introduce capital gains taxation in a tractable fashion. And I'm going to try and understand, and that's exactly, I'm going to trace through the footsteps of what I did, which is try and understand sort of this new modeling setup and figure out what's going on. And, you know, let me just say, Powell added a lot of heterogeneity relative to what was in the prior literature. So that's going to make things, you know, challenging. Okay, so before I start, you know, the first thing I ask myself is, you know, what would I have done? You may not think that's the right place to start, but that's where I did start. So, you know, the obvious thing to do is to write down a heterogeneous agent model along the lines of the work that I did with Yili Chen and Hanno Lustig. And, you know, we'll get some Lucas trees in there, one for wage and another for dividend income. We're going to have this heterogeneous trading technology, of course, so we can concentrate aggregate risk and get reasonable pricing. You know, we're going to have a marginal investor who's going to effectively be more risk averse than any, you know, other agent because he's got a lot of consumption volatility. And, you know, we're going to naturally, with reasonable income risk, we're going to have a lot of asset trading. So stuff is going to go on. Layer on this capital gains taxation, you know, and then I'd have to find, you know, Marlon or Yili to help them, you know, help me compute this thing. Sadly, Marlon, as you saw, was very busy and rejected my calls. Yili, as it turns out, I have a paper, What About Japan? You know, I tried to call him, but somehow, you know, anyway, you get the drift. It didn't go well for me. All right, so what you can get is, at least out of this method, you kind of have well-specified fundamentals and G effects, but it's a complicated computational model. And, you know, the mapping from assumptions to results is hard to see. I'm going to try and use this in a very conjectural way to you know, think about what Powell is going to get out of this. Okay, so the main source of heterogeneity comes from beliefs. And so to understand this, the machinery, I had to dig into its lineage, and basically there are two key papers, Adam and Marcet in JET 2011, and then Adam, Marcet, and Botel in the AER. Okay, and that's basically a quantitative version of the original paper. And then what this paper is going to take the AMB, set up, add in a lot of heterogeneity and shocks, and then also add in capital taxation, and then we're going to see what they get out of it. Okay, so fine. So the starting point of Adams and Marcet, and I probably mispronounced the gentleman's name, but let's just say A and B. Anyway. Market data show a volatile and persistent PD ratio. Survey data show expected capital gains rising with valuations. If you look, we have some stuff, where basically people always trade, indexes at the wrong time. Right before the market rebounds, they bail. Right before the market crashes, they're investing like crazy. So any kind of representative agent model can struggle with these kind of facts. Okay, so I'm going to go back to the original setup by chance, because I forgot that Dirk emailed me the paper. I actually went and looked, hunted around for the website, and I started off the old paper, which is actually simpler than this paper. And so I'm going to work off kind of a simpler version to try and understand things. That's hopefully going to be helpful. Okay, so we're going to start with an endowment economy. We're going to have a unit mass of identical investors. We're going to have one stock in unit supply that pays, a stochastic dividend. The investors are also going to receive stochastic income, and in equilibrium, there's one unit of the stock. Okay, fine. And so what are our fundamentals? We're going to think about, the dividend process here being in logs, just like a nice little AR1, except, it's got a unit root on wherever the dividend was. And then consumption is equal to your wage income plus your dividend, because in the end, everybody's got to hold the stock, so there's no trading. And then we're just going to look at the log ratio of consumption to the dividend, call that little CT, and they're going to posit a process for that. Okay, so that's going to be an AR1 with some persistence. And the wage process, as they refer to, is really an assumption about the capital dividend ratio, and that's going to kind of be the critical thing, because the dividend thing, whatever. All right, so we have this concept of internally rational. You're going to posit a probability distribution over P, D, and the wage. And what they're going to do out of this is they're going to have the Euler equation is going to hold, but the agent doesn't realize the representative agent, and so the law of iterated expectations doesn't hold here. And so pricing sort of stops one period ahead, and that kind of gives a way for, your beliefs about future prices to map into current prices. So you're going to get a representative agent who does not know she is representative. And, if we thought about this as a rational expectations, the price is a function of the state, so it's kind of degenerate, but that's not going to be the case here. And what's kind of cool here is this is a lot like robust control without the max-min aspect. So it's got sort of a Bayesian smoothing. I really like that. I don't like max-min. I feel like it's confusing and unpleasant. And so there's a lot to like about this model. And they're going to sort of center beliefs on the rational expectations equilibrium, and then everything's going to be normal, so you can use common filtering, and we're off to the races. Okay, so here's sort of their beliefs. They're going to think that, the price tomorrow, the difference between the log price tomorrow and the log price today is going to be some, log beta term plus a shock. Okay, fine. And then where are we going to get, where we think the beta is today, because, things are noisy, we're going to have some whole common filtering type aspect. Now, later on, we're going to use, there's going to be heterogeneity with respect to this common filtering gain term G, and he's actually going to have 100 different types, but for right now, there's one type. But what this gives you is sort of a feedback loop, optimism and price, when optimism is high, prices rise, and then the realized gains beat expectations, and then so forth. Okay, so you can get some booms or endogenous and self-fulfilling. And, you've got, now we're going to layer in this capital gains tax thing, and you've got the price relative here in blue to whatever your basis was, and then the tax is going to come in there. Okay, so fine. He has a bunch of other stuff going on there. I'm not going to talk about that. Obviously there's the lock-in region. I think we sort of get that. 2 minutes. I can talk faster. All right, so if we go linear here, you've got this expectation that is different from the rational expectations, but everybody holds it because in this world, that's the way it is. And you sort of think that, what do I believe that the price tomorrow will be? It's some, sort of drift up in terms of these beta coefficients from what it is today, and similar for the dividend. And so if the guy's actually risk neutral, you get this nice little equation for the price dividend ratio from looking at the one step ahead Euler condition. And then if you think, oh, there's some probability pi, I'm going to have to pay the tax. And so now you're sort of looking at this thing, and now you can start to ask yourself, what happens? So this is determining the price dividend ratio. And I can think about what's the sensitivity and stuff like that. And I can take the derivative. Now, if I take the derivative here, so d log PD, and I take the derivative with respect to your belief parameter, beta, I'll get this coefficient, and you can see that, it turns out it's positive because the PD ratio has to be positive. But then I can take as another derivative with respect to the tax factor and find out that that second derivative is negative. And so you see how the tax factor is sort of decreasing the impact coefficient as to how beliefs feed back into the price dividend ratio. That is the fundamental mechanism that's going on here. And there's a nice exercise in the earlier paper where he also does it with respect to dividend prices. And there you don't get this cancellation. I mean, you don't get this reduction in cancel. So this mechanism is really, critical for what's going on. Okay, it's a very surprising result. I was surprised that, beliefs are so powerful. One thing that I was sort of thinking about, coming out of, CCL, there are no bonds in the model. So you got no portfolio choice. You do have some differences in the marginal rate of substitution with the wealth distribution. Great thing is you don't have to worry about the risk-free rate because, as we know, from prior, work on the, Mera-Prescott puzzle, it's really the risk-free rate that generates very, very bad facts. And so, with a capital gains tax here, it would be natural to use bonds to try and, avoid the capital gains tax. I'm done. Okay. A lot of stuff going on here. It's really kind of wild that this belief mechanism ends up triumphing. I was very surprised about it. Naturally, I asked myself, would we get the same result in CCL? And I think no. I would think in our thing, the lock-in would triumph. And so what's kind of cool here is, this is a model. He puts something in, and you really see that is critical to what he's getting out of the results. And then the only thing I would say is, very interesting paper, challenging paper. I'm still digesting it. It derives a very surprising result. But I think the thing that's in the result is he puts in a bunch of stuff to sort of match data like stochastic taxes and discount rates and a bunch of things. My conjecture is that the result actually holds up very starkly. And this is just a massive fact. But the fact that beliefs have this powerful effect, I think, is really kind of hardwired in. Anyway, enjoyed reading the paper very much. Excellent paper.
All right, thanks a lot. You want to briefly respond? Then we collect.
Yeah, thanks a lot for the discussion. Let me say a couple of things regarding the bond market, which I think is the main thing that you brought up. The bottom line is, I don't think this changes the mechanism, so it doesn't allow you to avoid taxes. It might change some of the numbers. So let me unpack that a little bit. So again, I think the reason it doesn't allow you to change taxes was already explained by Stiglitz in his 1983 papers. Well, what you need to avoid taxes is to be able to short sell the stock, right? So a realization tax would still discourage an investor with embedded gains from switching out of equity into the bond, right? So the lock-in would still be there, and the pass-through mechanism, I think, would still operate through the after-tax expected excess returns on equity, right? So lower capital gains tax would make the desired risky share more sensitive to heterogeneous beliefs. So what I think the bond gives you is, of course, that allows you to adjust your total savings as an investor, but it doesn't let you as an investor reduce your existing appreciated stock position without realizing the gain, right? So again, I don't think the mechanisms rely on this absence of the market. The point is that it might change some of the numbers, so I'm very happy to explore the same model with the second asset. However, I think these estimates are very disciplined by the statistics that I showed you, right? The tax elasticity of realization, which the model matches very well, and all the volatility moments. So I'm a bit skeptical that putting the second asset here is gonna change in a massive way the numbers that the model spits out. This was regarding the bonds. I also liked the old version, which was somewhat simpler and it was faster to get the mechanism. But I also think this second version gives you a bit more action. It characterizes the lock-in effect, so that's why I'm sticking to it. Thank you so much.
Two quick questions. So the first, you have this upper bound to how much stocks an investor can hold, this S bar. So even if you're super optimistic about stocks in terms of your beliefs, there's this upper bound, which is a bit strange. So I was just wondering, is this because here with heterogeneous beliefs, otherwise like one type of belief in the long run would hold all the stocks, or why do you introduce this? The second is, you know, your baseline conclusion that the lock-in effect is not as strong as the pass-through effect. When you quantify the lock-in effect, you don't have step up in basis at death because you have an infinite horizon model. And I think in practice, most of the lock-in effect is in fact coming from the step up in basis at death. It's not really coming so much from the within lifetime deferral advantage, especially if interest rates are not that high. So I was just wondering if you had some more OLG structure where there was step up in basis, whether that might actually flip.
Should I respond? Yeah, regarding the upper bound, this was just included for completeness to ensure that you have a compact set. Simulation never hit, right? So this upper bound is super high. In simulations, know that beliefs in the quantitative model, you have the heterogeneous G, and that makes that the identity of the optimistic and pessimistic keep changing through fluctuation. So there is no one agent that wants to eat the whole market. So this is a very innocent kind of assumption just for completeness to prove the existence of a maximum in this model. So there is nothing weird there. Point to this step-up basis. Yes, I mean, you're right, the model abstract from mortality, bequest, the whole, step up at death. And it's true that keeping everything else constant, this might underestimate lock-in, right? Because that's where taxes play a larger role. You can not only defer, but entirely avoid the tax in there. In general equilibrium and quantitatively, I don't think the bias is that clear, right? So the step up resets the inherited assets basis to its market value, eliminating accumulated gains in there. So it might strengthen the lock-in for surviving low basis investor, but at the same time kind of reducing the mass of positions subject to the change in the realization base. So it's going to change the ownership, who owns the assets with the basis, with the cost basis, and the effect on equilibrium prices might, I think, further upset this direct effect. So if you go for everything else constant, of course you have that. In general, equilibrium is something that I'm very happy to explore quantitatively, but my prior is that this might not be that huge here.
When I saw those waivers, they lack great taxes. So that's a lot like Shank and John 2003. If you've seen it, because their one point is, yeah, there's a bubble, and the bubble can be quashed by essentially increasing transaction taxes, because the higher transaction tax, the further the distance in beliefs has to be. They said, well, it's very easy to show that. And then second, just from a practical perspective, if you have multiple risky assets, you might have tax harvesting. I might be selling some assets, buying others, like that goes into my overall capital.
Yeah. So the point regarding the financial transaction tax, I think in the paper I try to distinguish very well these two taxes. The cleanest way of understanding that is if you look at a tax on unrealized gains, and you see very cleanly this pass-through effect, right? When you reduce this sensitivity of prices to beliefs. The trading tax in the simulations, what does is reducing the persistence of the PD ratio, so it generates jumps in the PD ratio, but it doesn't really stabilizing the medium and long run fluctuations in the PD ratio. So at least in these simulations, it appears to have mixed effects, and if you calibrate it wrongly and put it a bit too high, it directly increases volatility. As opposed to that, the attacks on unrealized gains systematically reduce all the relevant statistics related to excess volatility. So I think it's intuitive that it reduces one friction, and that helps you to stabilize prices.
Maybe you tried to add another class of investments here who are not taxed. So think of these as, universities or institutions that don't face any lock-in role. And then think about how stable the equilibrium is to having those folks. I mean, the information flows are similar, available to the taxed investors and non-taxed investors. Does that change anything about this, or is it just that the information still will not be fully incorporated because you got this group of investors who block it?
So let me say two things about that. The effect of non-taxable investors is try to take into account when I calibrate the series of taxes, which take into account the massive change in the ownership structure. So the level of taxes is already adjusted by that. I think it would be interesting to see whether you can generate endogenously in the model this change in the ownership structure when you have these two different sort of sectors of agents. One is untaxed, the other is taxed, where you see these changes in who holds the taxes, and this is a way of avoiding taxes, and therefore you get the reduction in the effective tax rate that I use to calibrate these numbers. So that would be like one step further in the endogenization of this reduction in taxes.
Since we're out of time, I'll just phrase this as two comments. One is, I think all of us seem to be struggling a little bit with the size of the lock-in effect relative to the pass-through effect, somehow it goes against intuition and some empirical evidence. So I think it would be great to motivate the lock-in effect a bit or discipline it more perhaps directly. You don't need to estimate your own parameters, but I think there's quite a bit of micro literature. So based on, end of year trading or short-term versus long-term capital gain switching. So I think you can probably discipline it a little bit more, especially because your pass-through effect is very reliant on your specific model of expectations that sort of amplifies this. And then the other suggestion is, once you do these policy analysis, it kind of begs the question of welfare. What's good volatility? People trade just because they disagree. So that's sort of good volatility. What's bad volatility? So I think it would be great to say something about welfare too.
Yeah.
But terrific paper. This is super, super impressive. Yeah.
Thank you very much. Regarding more discipline to the model, I'm very open to that. Let me say that getting right the term structure of the elasticity of the tax elasticity of realization is hard, right? If you get the same model, just the standard Adam Marset kind of thing, this is extremely high, right? So this imposes a lot of discipline in how you get the pass-through and the lock-in already. But of course, I'm very happy to get more micro data on the lock-in effect, and discipline is better. Regarding welfare, super interesting. I fully agree. The paper now is 130 pages, so I will leave that for another paper. But I'm very interested in going that way. Yeah.
All right, thanks a lot. We are out of time. So thanks a lot to all the presenters, especially heartfelt thanks to all the discussants for all their tremendous work. Thanks all for coming. And some of us will consume some liquid assets outside.
Before we disperse, Jim is left. So a depressing fact is that I'm the senior person by age. So on behalf of all of us, I wanted to thank Dirk and Florian and Stephanie and all the presenters, all discussants except one, all did a great job. Thank you very much.